today's lows or yesterday's lows to see an important support. Yesterday's low of 25,905 is extremely crucial to track, especially when the GIFT Nifty is indicating a 70-point downtick. You have the 20-day moving average, which we need to close above for a firmer uptrend as we move towards the end of the year. And below yesterday's low, we have the 50-day moving average, which is rising, so closer to 26,800 is the next leg of support as well. The cash market flows, no real problems out there. The DII outbuying the FIIs by about a couple of hundred crores. No problems there. And interestingly, the FIIs bought in index futures. Remember, on Friday when the market moved higher, the FIIs sold. Yesterday, the market recovered from lows. The FIIs bought about 500 crores. They covered about 1,500 short contracts and added about 1,000 long contracts. With that, their net longs increases marginally from 10% to 11%. It is weekly options expiry today, and the options which are extremely active come up. We have 26,100 call, 2650 call and 26,000 call, all of them active, along with 26,000 put and 25,950 put as well. What does all of this mean for the Nifty in terms of a range? Resistance that the option writers expect is between 25,910, rather 26,070 to 26,130, and support is at 25,910 to 25,950. So that's the broad range that the street is working with today.
Okay, we'll keep an eye out on that range as well. But moving on, and let's get you the latest update from Delhi NCR. The national capital continues to choke with the AQI in the severe category due to low visibility amid a thick layer of toxic haze. At least 228 flights, including 131 departures and 97 arrivals, were cancelled in Delhi, while 5 others have been diverted as of last night. Now, GRAP stage 4 measures remain in force. Truck entry into Delhi is restricted and construction activities remain suspended. The Delhi government said that students from nursery to class 5 will attend classes only in online mode as air pollution worsens. So, important update coming in there from the national capital. But on that note, we're going to slip into a very short break. We'll get to all the action on Wall Street after this break. Welcome back to Power Breakfast on CNBC-TV18. Now let's move on and talk about the US markets because Wall Street ended marginally lower with Dow closing and losing almost 41 points. S&P 500 was down 11 points and the tech-heavy Nasdaq that fell 138 points. Let's go across to CNBC's Christina Paternevelos, who's here to give us a wrap on what happened on Wall Street.
U.S. markets were down marginally across the major indices in Monday trading as concerns about the AI trade really just continued to hit tech stocks. The Dow lost about 41 points, the S&P 500 just down 11, and the tech-heavy Nasdaq was down 138. Kevin Hassett's candidacy, though, to head the Federal Reserve, once seen by the market as almost inevitable, is now receiving some pushback. Sources familiar with the matter tell CNBC that high-level people who have the ear of the president are concerned the National Economic Council director is just too close to Mr. Trump. The president surprised the markets on Friday when he told the Wall Street Journal that former Fed Governor Kevin Warsh had moved to the top of the list alongside Kevin Hassett. And New York Attorney General Letitia James on Monday sued UPS for allegedly cheating seasonal holiday workers out of millions of dollars by failing to record all hours worked, requiring off-the-clock labor, and manipulating timekeeping systems to reduce paid hours. UPS wrote in a statement that it is thoroughly investigating the matter, that it offers industry-leading pay and benefits, and is committed to following the law. That's what's happening here in the U.S. Back to you in Mumbai.
And staying on with the market, let's hear what Savita Subramanian from BofA Securities had to say in terms of the current market situation.
We're looking for a pretty good year when it comes to earnings, when it comes to broadening out. The economy looks okay, but I think it's going to be a year where we see some significant multiple compression. So we're actually forecasting, our year-end target is pretty lackluster at this point. It's 7,100 for next year, not this year. Next year's year-end target. And, we've got 15% earnings growth penciled in, but, I think we're going to see a chunk of multiple contraction. And the reason really is the stocks in the S&P right now that are the bulk of the market are not the economically sensitive companies. They're really the AI plays, the kind of the buy the dream companies. And those we see as maybe headed for a little bit of an air pocket in 2026.
Amazon, Meta and Microsoft are underperforming the broader market despite leading the AI race. Here's the view coming in from Ruchir Sharma on over-concentration on AI.
That these companies were being valued a lot because of the amount of free cash flow that they were generating. But that free cash flow growth is now declining sharply. And I think that that's what they're paying the price for. And, at this time last year, I had said that the big trade was going to be that American exceptionalism was about to come to an end. And I think that's what we are seeing as well, which is that America's spending so much on AI. But it's very interesting that the rest of the world's stock markets have done far better than America this year. Possibly the widest gap since 2009. So I think what's happening is that, yes, in America, we are spending a lot on AI, but I think there is a quiet questioning going on as to whether all this investment is actually going to pay off. And also a realization that the American economy has become very dependent on AI. As I've discussed here previously on your show, there's become one big bet on AI.
Now let's move on to our Trump Watch segment and get the latest update on what is coming in from Trump's side. Now Trump has declared the war's end is closer than ever, and after talks, he's saying after today's talk with them, he told the reporters that Russia wants a normal way of life. Ukraine has already lost territory, and he's recently spoken to Putin as well. Trump also highlighted and said that, this is the word also coming in from Zelensky. Zelensky himself is echoing the progress of very close to a strong security guarantee, discussing territories with no consensus yet, and backing a Christmas truce alongside the US and Germany. Ukraine team is eyeing US visit this weekend. Zelensky is ready for elections if ceasefire holds. Listen to what he had to say.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever. And we'll see what we can do. We want to save a lot of lives. We sell equipment to NATO. We don't spend any money, but we do want to see if we can save a lot of lives.
Also, President Trump has signed an executive order labeling fentanyl and precursors as weapon of mass destruction. Lastly, to the last update for today, we have Trump administration who unveiled new initiatives dubbed the U.S. Tech Force that will work on AI infrastructure and other technology projects. The corps of about 1,000 engineers and other specialities will report directly to agency leaders in collaboration with top technology companies such as Amazon Web Services, Apple and Microsoft. Also, do not forget the final update coming in on the geopolitical front. Trump has stated that Washington is looking into whether Israel violated the Gaza ceasefire with a strike, killing the senior Hamas commander Rad Saad over this weekend. Trump also has denied any rift in terms of his relationships with the Prime Minister, that is Prime Minister Benjamin Netanyahu, or Israel more broadly. Also, Trump expressed his continued confidence in the Syrian president and said that Trump is saying the ISIS and will hit hard following the recent Syrian strike as well. Now, that's all the time we have for Trump Watch, but we're going to zip into a very short break and get you the cues in the world of commodities. Stay tuned in. Welcome back to Power Breakfast on CNBC-TV18. Now let's go across to Manisha Gupta, who's here to give us the latest update in terms of what's happening in the world of commodities. Manisha, good morning.
Morning, and thank you for that. Well, I'll start with the crude oil prices, where we're looking at prices at the lowest since early 2021. Crude oil prices have been facing expectations of a supply glut. Markets also are looking at optimism over potential Ukraine peace deal. And then you also have OPEC plus producers restoring idled output, non-OPEC producers also increasing production, and the weak China economic data, all of that weighing onto the crude oil prices, which are now trading nearly 19% lower for the current year. What we have seen gains, though, come in is for the silver prices, back above $63 an ounce, up at 120% in 2025. We also are looking at strong support continuing in case of the copper prices on the back of short covering, position rollovers ahead of the contract expiry, and then you are looking at tight supply conditions, low visible inventories on LME, all of that continuing to support copper as well. So silver and copper are top on the list as far as gainers are concerned.
Okay, Manisha, thank you so much for that. Surely we'll be keeping an eye on all those updates in the world of commodities. But moving on, Congress leader and Lok Sabha MP Shashi Tharoor weighs in on the ongoing US-India trade deal negotiations and what more can India do to expand their partnership with other nations. Listen in.
On multiple occasions, some people say 3 times, some people say 5 times, the two delegations have actually come to an agreement, and it's been rejected at the White House. So ultimately what Mr. Trump wants, only Mr. Trump knows. And I think, there will certainly be some red lines on our side where we cannot oblige them. And in a democracy, politics is an important factor. The farm interests of our farmers are not a negligible factor. 67% of our population still lives off the land. You can't put them in a position where, for example, they're swamped by wheat imports from America, to give you an example. There are some areas in which perhaps we could show some greater flexibility. We need to. There are many markets we could have done more to develop, that our private sector could have done more to develop. We could be selling very much more in Africa, parts of Southeast Asia, certainly in Central Asia than we've been doing. Europe, now we have an FTA, though people have overlooked the fact that it still has to be ratified by 27 countries. That could take a year. So we don't actually have it in force yet. We've concluded the deal, but it does have to be ratified, and then we're going to end up with I think, a significant impact on Europe. And all of these things are indispensable equally, as you said, strengthening our domestic system, both in terms of our own regulatory environment, the way in which our companies have been perhaps in some areas somewhat complacent. They've got to get their act together. We've got to be more robust.
Okay, let's move on. The Maharashtra Election Commission announced the election dates for Mumbai Civic Body and 28 other corporations. The polls will be held on 15th of January in a single phase, and the continuing will be held the next day. The nomination process is expected to begin on 23rd of December and will go on till the 30th of December. The last BMC polls were held in Feb 2017. So after a very long time, we're seeing these elections come in. But a quick look at what the Asian markets are doing as of now, right? Because they've opened up in the red, and that red seems to be continuing on the street as well. Taiwan index still continues to see a fall of 1.3%. Hang Seng has seen a furthermore decline from when we started the show. Now it's down almost 1.5% as well. Overall, the Asian markets are indicating a red start. And Nifty implied open, let's look at that, because when we started the show, it was down 66 points. Now it's down 75 points. So furthermore decline coming in for the Nifty implied open, and Indian markets could open up in the red as well. But with that, we're going to wind down this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, a Bazaar Morning Call.
countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. Tuesday morning, yesterday was quieter, except, of course, the rupee, which hit a new all-time low. Let's hope that there is stability, continued stability as we count down the last, 10, 12 days of 2025. I'm Prashant, with me, my colleagues Nigel and Surbhi. Guys, good morning.
Hi, morning.
Hi, morning, folks. Markets today, actually, Asian markets not quite feeling the love because there's a big slide out there between 1% to 2%. But let's see, because the bulls did prevail yesterday. Yes. They did manage a 26,000 close. So maybe they'll continue to be in this magic market.
Well, that's right. India outperformed yesterday. So we hope that we continue, because for the year we've been underperformers. But off late, last 2.5 months, India's actually outperformed or performed in line. Pretty good times.
Absolutely. And I think let's see if 2026 can be built on the back of this underperforming year in a better way, in a better setup. It is certainly a better setup. I mean, how much of the, so to speak, poison is out of the system in terms of high valuations and all of the excesses, etc., is, of course, up for debate. But certainly, it's been a tough year, and we look ahead. Now, let's just quickly take it from the top in terms of what you need to know as we begin this new day. So, U.S. equities paired early gains, and that's the final close. Nasdaq down 0.6, S&P down about 0.16%. Continued pressure. I mean, these are the two names I put out yesterday as well. So, and both reported on different days on last week, Broadcom and Oracle, and both on their respective days when they reported fell 11%. Oracle down another 3%. So 11% last week, 4.5% yesterday, 3% today. So that's a steep cut for Oracle. Broadcom was down another 5.5% after Friday's 11% sell-off. iRobot was down 70% after the company essentially filed for Chapter 11 bankruptcy, and basically decided it's kind of proposed that it sell itself to its Chinese suppliers. In terms of just some news about who's ahead, and this is very, very stark, it was almost as if the prediction markets were betting on the fact that Kevin Hassett will be the new Fed chair and that Trump would pick him. But guess what? It's complete U-turn, and prediction markets are now favoring Kevin Warsh as their new favorite Fed chair. So two Kevins in the race, and we'll see, who comes out on top. But in terms of what market perception is, it's Warsh who's now ahead. 10-year yield was down 1 basis point, not very much by way of change. Oil prices are about 60, so they've lost about $5.5 odd dollars from the highs. And this, of course, is on the back of expectations once again that this time, and there'll be many this times, the Russia-Ukraine war comes to a halt, pressured, of course, brokered in that sense by President Trump and the United States. Zelensky essentially saying that they're going to drop their ambition to ever join NATO is a big one. It was the crux of the issue, but there are still territorial aspects which need to be settled. And, whether Ukraine will cede territory, which Russia says it now occupies and it will not give back. So those are things which will need to be resolved. Tonight, you get the U.S. November jobs data. Consensus expects 50,000 job additions. There'll also be October retail sales and weekly ADP print. But the big one, of course, is the November jobs print. And, now, of course, we're back on track. It was all over the place because of the government shutdown. Usually the data comes out on a Friday. Rupee all-time low against the dollar, 90.78 is where we made that low, and we left off at 97.3. So, again, focus on this one. It's been a bit of a worry, right? Currency, losing on currency, even as you're looking to make capital gains, has been problematic. Now, just the levels, not very much changed because, hardly any change at the index level yesterday. The 20-day is 26,031, almost unchanged from where it was as of Friday's close. The Nifty Bank 20-day is 59,292, and we're very, very around these levels as of yesterday's close. The downside level, 25,750 on the Nifty and 58,850 on the Nifty Bank. So that's the overall picture. Yesterday, as we put out, the insurance amendment bill did not go through. In all likelihood, perhaps it gets to the Parliament today. The Cabinet's already cleared it, so keep an eye out on that. we'll get you when it's tabled and when it's cleared. F&O positioning, F&O stats, how are we looking? Nigel is standing by with that. Nigel, over to you.
Well, a quick word first on the cash market flows. And yesterday you had the DIs that bought while the FIs sold. And there was a marginal net buy number coming in from the institutions. You know, the DI buying outweighing the FI selling yet again. But the bigger point was in terms of volumes. The volumes yesterday from institutions, both the FIs as well as the DIs, were relatively lower in comparison to the average that you've seen in December. It's that holiday, season that's picking up, and also lack of any large trades, actually. Both those two could have weighed, but there's going to be a declining trend from here on as institutional participation does dry up for a couple of weeks or so. Moving to what the FIs did on the future side, well, they covered some mild shorts on the index, but they added some shorts on the futures market itself, though they continue to remain net long on the stock futures and they're net short on the index future side of things. In fact, to put a percentage to that, the FI net short positioning in percentage terms on index futures is at around 89%. Moving to the options data, then the PCR, that's gradually moving towards the 1.2 odd mark, more or less in the middle of that range that we have seen. 1.1, 1.2 is what we've seen for the last few trading sessions. So you had action both on the call as well as on the put side. And yesterday's trade, actually, writers made money. The 26,100 call, there was massive writing being seen out there, with the premium declining to less than 30 rupees. Even if you look at the 25,900 put, well, out there as well, there's a big amount of open interest built up, and that premium's down to around 20 rupees. So just punching in both these premiums and the kind of action that you saw in the options market, you get a broad range. Remember, today's the weekly expiry that plays out as well. So the broad range you're looking at is 25,850 on the downside and 26,150 on the upside. That's the range for the day itself. But the Nifty Bank, that found its form yesterday. It's trading above the 20 DMA, which is the crucial mark that we're seeing out there. And that one will have to lead the way. Remember, the recent high is at around 60,115 odd. But I think the index to track, not just for now, but for the next few months, is going to be the tech index. Because that AI bubble gradually seems to be losing a lot of interest out there. That AI trade that was very, very strong all through 2025. In the NASDAQ as well, it's replicated out there. But the IT index, after underperforming, for majority of the year, it's gradually been showing signs of outperforming. So let's see whether or not the tech index can give up its recent underperformance for the year and actually go by the trend that we've seen in the last 3 months, when tech has outperformed the Nifty and outperformed most indices. I think that's the index to watch for the next couple of quarters.
Oh, absolutely. Tech it is. And tech is getting beaten up quite badly across Asia, actually. Most of the screens are flashing red, like we mentioned. And the cuts are as much as 1% to going up to 2% in the South Korean markets in their mid and small cap indices. So it's pretty much a all fall down kind of a morning. Can India buck the trend? By the way, yesterday's trade numbers were quite encouraging, because not only did our trade deficit reduce, India's exports to the US, by the way, have shown improvement. And much, much better in November compared to what we saw in October. So overall, the trade numbers are looking good. Whether that offers any respite to the rupee or not, we will have to see, because that's been the biggest problem point for the market, the clear slide. Now, this is what we're getting because of this overall weak global sentiment. Will probably start gap down once again. It's like a repeat of yesterday. Yesterday, the bulls managed to prevail by the end of day's play. Let's see how today shapes up. 70 points lower. That's the indication on the GIFT Nifty, at least as of now. Well, let's move on. We have independent emerging market expert commentator Jeffrey Dennis joining in. Mr. Dennis, thanks so much for being with us. Season's greetings to you. Hope you're getting all set for a great holiday season. So that's really the thing, right? As we enter this end of the year period, the question on the AI trade and whether what is right now a bit of a rotation. It's a rotation away from large US AI stocks into other parts of the US market. Whether this rotation is going to gather momentum in 2026, and if yes, what does it mean for global equities?
I think you're seeing a mild rotation now. You're not seeing it being very convincing yet. I mean, the S&P itself is only about 1 to 1.5% off its high. So there is the beginnings of some rotation. I suspect you'll get some more rotation if you look at next year, but I do not want to turn bearish on the AI story, the technology story. So I think the amount of rotation you get will be relatively small, but yes, it's obviously to a certain extent it's underway. Now, what does it mean for global markets? Well, if you look at some of the giant winners this year in global markets, obviously Taiwan in particular, Korea as well, in particular Korea, which is up 80% in dollar terms this year. Were you to start to see significant rotation, those markets would come under pressure. I mean, TSMC, for example, in Taiwan, is over 10% of the EM index, is more than double the weight of any other individual stock. So obviously that market would be vulnerable. And I think if you were to get a more significant rotation into some of the consumer names, for example, the more defensive names perhaps, I think India, having done so poorly this year, would be a logical beneficiary of that.
Dennis, hi. Morning. Prashant here. Now, you saw the headline, right? I mean, I don't think there's any market signal from it, but Elon Musk hitting a new high in terms of his wealth and his fortune. Of course, I mean, pushed by SpaceX's latest round, right? It's just a signaling thing, right? And so much in the US, so much of all of this in the US is happening actually in the private markets, right, Dennis?
Yes.
Not really available to public investors. I mean, it's actually exactly the opposite here in India. I mean, public markets are booming. Actually, if anything, in the US, public markets are shrinking.
Yes, that's true. And obviously, if you look at Elon Musk himself, he's got obviously a lot of ownership and a lot of different businesses. It's clearly not just a Tesla story for Elon Musk anymore. And you're right that you are seeing a lot of private market action. I think ultimately some of the private market action will turn itself into IPOs down the road. Whereas, as all your listeners and your viewers know, India's had a very, very strong year in terms of IPOs. Now, this could be one reason why the Indian market is underperformed, because you've had big new supply of stock, whereas you're not getting that as far as the US is concerned. Frankly, if the latest numbers suggest that Elon Musk is yet more wealthy than before, I don't care about that, frankly. I think the issue is, are you going to see these stocks, of which Tesla's a good example, are they going to deteriorate and weaken next year? And I tend to believe this is completely different from the 2000 tech bubble that burst, when you had so many companies that had poor business models, hardly any revenues of any at all, no profits. These companies are running real businesses. And so this is why I don't think you should get too bearish about that. On the contrary, Musk is doing very, very well. A number of other companies are doing well. And at the end of the day, I think any rotation out of these technology names, the AI names, the Mag 7, will probably occur next year. But as I said earlier, will be limited. As far as I'm concerned, and that will obviously impact global markets as well.
No, I mean, that's absolutely fine, Dennis. I don't think anyone is suggesting that this is the end or anything. And you'll go through these, because I guess no one has the answer, right? People have opinion, but no one has an answer. It's too tough a question to answer, whether all this investment is going to eventually lead to where the value will settle, et cetera, et cetera. But it's a real thing. I mean, just think about it. 3 weeks back, 4 weeks back, the CBOE VIX was at 40. And there was this entire correction which happened with NVIDIA and all these stocks which sold off 10, 12%. We're all back, as you said, within a couple of percentage points from a new high. So yeah, I mean, looks like another phase of this in and out, but I think that will continue into 2026 as well. Nigel.
Well, hi, Dennis. Good to see you. I wanted a quick word in terms of that trade deal. We waited a few months. I think the last few months we've chatted numerous times, and the expectations were it's coming in the next month. I mean, what are your expectations on that front? And do you believe that that's going to be one of the driving factors to bring this FI money back to India, which, we've seen billions of dollars move out of the Indian markets in the secondary market. In the primary market, actually, there have been inflows. But net, there have still been outflows coming in from the FIs. So your comment, both on the trade deal as well as the FIs coming back?
I don't have any inside track as to whether you get a trade deal in the next month or so, but I suspect the answer is yes, because at the end of the day, the US has come to a trade deal with so many other countries over time, and I think India will probably be part of that. So that would be my first suggestion, but as I say, I don't have any particular inside track on that. But were that to happen, I think it would be a significant catalyst for India to do much better in 2026. Now, However, I think the biggest catalyst for India to do much better next year will be the clear evidence. We had some more data on this yesterday, your time, is of the weakness of the Chinese economy. The economy is slowing further. Very weak retail sales, very weak investment figures, very weak IP numbers. And I think what you're going to see here is a definite rotation from China towards India as you head into 2026 and beyond. And of course, given how poorly India has done in relative terms compared to China and Korea and Taiwan, there's hardly a valuation case for India, but the very high valuations that you had, let's say 12 months ago, have come in significantly in relative terms, and that's going to be a factor as well. But no doubt the trade deal will help. I think the relative valuation narrowing versus other Asian markets will help. And don't forget also the oil price. Brent is pushing down towards $60 a barrel. I think that will help as well. And as I've argued many times in this show before, there's still scope, in my view, for the RBI to cut interest rates again, as they did, of course, the other day. So I think it's a much, much brighter outlook for India next year, which I think will presumably bring the FIIs back. But for me, the biggest driver of this is probably going to be a little bit of, what should we say, a little bit of exhaustion about the Chinese rally in the face of what is a continually weakening economy there, which the government doesn't seem to know how to bolster and get growth back up again. That's going to be a factor pulling money out of there and pulling it back into India.
Well, that's an optimistic note, and it's good to have that after what's been a really challenging year. And I mean, who knows? I mean, there's so much talk about Russia-Ukraine, right? With the US president now saying they're closer than ever to a deal. And if that gets done, then maybe the additional punitive 25% on India, maybe that goes. So yes, fingers crossed for 2026. Mr. Dennis, thanks very much for joining in. And once again, wish you a very Merry Christmas and a Happy New Year in case we don't speak again till the end of the year. Thank you for joining in.
Very much.
Okay, all right. Well, with that, let's move on. Tell you what else we have lined up for you on the show today. At 8:30, we'll have Dharmesh Kant joining in. We'll discuss a couple of fundamental stock ideas with him. At 9 a.m., Karan Torani of Elara Capital joins in. We talk about the big surge in PVR's stock price. They've launched some new screens in the south, and plus there is the weekend release of Dhurandhar, which has been very well received. So more on PVR in a bit. At 9:20, JP Morgan's Rajiv Batra joins in. He's our market master of the day. At 9:35 a.m., the management of Narayana Health will be with us. We'll discuss the impact of price hikes and the revised CGHS tariffs on the hospital's revenue. After that, the management of Kaplan Point Labs is going to be with us. We'll talk about the business outlook, looking at the next year. Towards the end of the show, in our special segment, It's the Economy, Lata will be speaking with Santanu Sengupta of Goldman Sachs and Madhavi Arora of MK Global Financial Services.
Time to slip in a short break. Got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Talk Time segment. I give you a sneak peek. Britannia, Delivery, Zydus Life, Kim's, Synor's Pharma, all of them will be reacting to positive news flow. Add to the list HCLTech, Intellect Design, GOCL Corp, Geojit Financial, while the lone stock that will be reacting to negative news flow is Zota Healthcare. Take that break, come back into further detail on all of these names.
Welcome back. As we've been telling you, it's going to be one more opening, probably on the downside because of the way global cues have shaped up. It's a bit of a sell AI kind of a morning. That's what we had from Wall Street, and that's how Asia is pretty much reacting right now, down between 1 to 2%, depending on which Asian index you're looking at. And in the midst of all of this, the implied open is telling us that we'll probably start lower. Now, it's actually improved. It was 90 points lower. Now it's about 75 points lower. So let's see how this shapes up. As always, lots of independent individual stocks to watch as well. So let's straight away get to it with our research team. Here is the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Mangalam, let's start with Britannia. There are some changes in terms of the top management.
Well, you know, it's small developments, but important ones. Why do I say that? Because Subhashish Basu has been appointed as the head of their dairy business. Subhashish was earlier CEO at Anik Milk, and alongside that, he's also been earlier associated with Pratap Snacks, Mother Dairy, and PepsiCo. So brings in a fair amount of FMCG experience too. And the current head of dairy, Abhishek Sinha, has been elevated to Chief Sales Transformation Officer. Remember, dairy accounts for high single digits to low double digits of their overall revenue. It has been a growth driver for the company. So management change is expected to boost that business as well. Additionally, remember December 15th was yesterday when Rakshit Hargave from Birla Opus took over formally as the MD and CEO of the company. So which is why maybe some leadership transition happening out there with changes to the overall leadership portfolio.
Okay, all right. So we'll watch out for this. And yeah, that's a good one to remember as well. There's a new MD and CEO finally officially taking charge as of yesterday. But Mangalam, you're also watching out for delivery, I think. Tell us why.
Yeah, incremental small changes in both Britannia and delivery, but important ones at that as well. Delivery, remember, has now been mindful of the quick delivery for a lot of the e-commerce, small commerce players as well. So they've launched on-demand intra-city offering in Mumbai and Hyderabad. So if you have the delivery app, and if you're a small business, if you're a D2C person or an individual, you can get your parcel picked up in 15 minutes of booking, and that gets transferred or transported intra-city. So basically, their version of QCOM logistics for people who want to take note of their services. They will expand this service to more cities. Remember, in cities like Mumbai and the metros, there is a model like this for individuals in the form of Borzo and WeFast, along with the others. So let's see how delivery competes with all these players out here.
Mangalam, so I can order food from Delhi?
You can't order food from Delhi. It's intra-city. So you can probably,
if you can get food from home or parcel from home picked up.
Yes. So if you are making great food at your house, yeah. So if you're making great food at your house, you can get it picked up and delivered to our office for everyone. Within 15 minutes, they'll pick it up, and maybe around 30 minutes.
That's not even a hint. It's so direct, it's not even a hint.
Mangalam, please tell mom that palak rice hasn't come for a while. So, just
we don't need delivery for that, Nigel. I'll bring it myself.
Thank you. 2026 missed it, bro. I hope auntie is watching.
But this is more the dabba wala, right? I mean, basically.
No. It's I've done it. I have forgotten parcels, clothes, here and there, a charger left at a friend's house. You simply use it used to be what Dunzo was once upon a time, which was known as Bangalore. Borzo, as Mangalam said, in Bombay. You just get your small parcels picked up. Very helpful.
Okay, all right. Mangalam, thanks very much for that. Well, more stocks with news flow. Ekta is here with details. Ekta, morning.
Well, yes, I'll start with Seneris, where they've acquired Apnar Pharma for 91 crores. They have a US FDA, UK, a Canadian approved facility in Gujarat. 91 crores will comprise of 76 crores of total debt. Remaining will be 15 crores via 2 tranches. KIMS is in focus because they've commenced operations at a new hospital in Bangalore. It's a 350-bedded multi-speciality hospital offering advanced care in cardiac, neuro, robotic sciences. Zydus Life is in focus because US FDA has accepted Sentinel's resubmission of a new drug application for a particular drug under development, which is CUTX-101. Remember, Sentinel is Zydus' biopharma arm. This drug under development is used for pediatric conditions. And remember, they had received a complete response letter, or basically some questions from the US FDA with regards to this particular drug. And they've responded to them, and now there is a target date which is set by the US FDA where they will respond to this particular application by the 14th of Jan. Zota Healthcare, there's a QIP launch, total size 400 crores, base size 300 crores, green shoe option 100 crores, indicative price is around 1,535 rupees per share, which is a discount, 9% discount to its last close.
Okay, all right, Ekta, thank you very much for that. So keep an eye out on some of these names. Well, more stocks with news flow. Upasana is here with the details. Upasana, morning.
Good morning. First up, let me start with HCLTech. Orobay Technologies expands a digital transformation partnership with the company to boost the manufacturing excellence and innovation. Next up is Intellect Design. The company partners with 35 Canadian credit union across 8 provinces. And the second news flow here is that it has called off its JV, which was signed between the company's wholly owned subsidiary in UK and ITI XA for the establishment of a joint venture entity in GIFT City, Gujarat. GOCL, also in focus, as board has approved a scheme of merger by absorption of HNPCL into GOCL. Now, HNPCL is engaged in the business of power generation, transmission and supply. And if we look at the half-year revenue, it stands at 1,400 crore. Now, GOCL promoter holding to rise from 67% to 75% after this. BL Kashyap also in focus on the back of order win. The company secured an order worth 1,616 from Satwa CKC Private Limited. And lastly, we are looking out for Geojit Financial Services as well on the back of the block deal. BNP Paribas SA has sold nearly 14.7% stake in the company. And the promoter holding of the BNP Paribas as of September 25 stands at 22.1%. Bajaj Allianz Life Insurance has bought on the hindsight 1.3 crore shares at 38 per share. So overall, we are looking for all these stocks in today's trading session.
If you say we must look, Upasana, thanks a lot for joining in and filling us in with that complete list. Well, that's a good time then to do a quick recap of all the stocks we just covered. The ones with positive news flow: Britannia, Delivery, Zydus Life, Kim's, Synnors Pharma, HCLTech, Intellect Design, GOCL Corp, as well as Geojit Financial. All of them will be reacting to positive news flow, while the one that will be reacting to negative news flow is Zota Healthcare as well. Okay, all right. Well, let's focus on the commodities market then. Manisha Gupta joins in to tell us about exactly that. Hey, Manisha, good morning. Well, commodities is always an interesting space, and I think the Bitcoin as well grabbed your attention for the last few hours. What a sharp decline we saw out there.
Oh, well, yeah, absolutely. Bitcoin, another story. Actually, it's a story of two halves in the year. The first half has been such strong gains and such friendly numbers and framework coming in from the U.S. markets, but the second half has been totally different, and sharp declines is what we are looking at. 90,000 also giving away in sense of Bitcoin in the Asian markets right now. But the other thing in commodities, which also seems to be giving away, is the crude oil prices. A third straight year of decline, and now we are trading at the lowest level since 2021. Well, there is an expectation of supply glut, optimism also over potential Ukraine peace deal, and not just OPEC Plus, which is increasing their production, but non-OPEC countries like Canada, US also seem to be increasing production. And then you have the weak China economic data, all of that weighing onto the crude oil prices, which is down by 19% so far into 2025. But where everything else seems to be gaining higher. So when you look at the gold prices, we are not too far away from its all-time highs, trading above $4,300 an ounce. Silver is surged up back above $63 an ounce. It's up by 121% in this year. You have copper prices trading at around 4-month highs as well, short covering there and position rollovers ahead of the contract expiry. Aluminum not too far away from its 2022 highs. Zinc is trading at around 6-month highs as well. So as far as the metals as a space goes, precious and base metals, all of that seems to be trading firm.
Okay, all right, got that. Thank you very much, Manisha, for all of the details. We do need to take a quick break on that note. Come back on the other side. We'll have Dharmesh Kant of Chola Securities joining in. We'll discuss a couple of fundamental stock areas.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. Well, let's welcome Dharmesh Kant, Head of Research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Good to speak to you this morning. Dharmesh, what are you making of all the news flow we're getting on these tech names? You know, in the last 3 months or so, IT has actually started outperforming. Though year to date, it's a big underperformer. From that space, what do you like?
Yeah, good morning, Nigel. I mean, most of the news flow is only a hope in nature that things should pan out. And the entire IT trade, if you look at last 2 years, the talk was always that interest rate cut will lead to discretionary spending. We have already seen 175 basis point interest rate cut in US, and still, most of the IT companies are not very, confident about giving a upward guidance or revising the guidance. So this quarter will be very critical from that point of view. How they are looking at, AI as a product rather than, it's in the making stage. So that has to be seen, and currency tailwind is definitely playing out in favor of IT companies. I think as a trading opportunity, there's definitely merits attention out there. And from the large cap, we are liking Infosys and TCS. From the mid and small cap, Persistent and Coforge have delivered consistently good numbers for last 2-3 quarters. We continue holding them. And there has been a new one in the staple, that is Orient Pro Solution Limited, which we have discussed earlier as well. So that's a fundamental buy, and 1-year target is around 1,600 rupees. And we are seeing traction happening in the banking suite. Data center stack is likely to pick up going forward in mobility space. So expecting a few orders in coming quarters to combine that company as well. So overall, you have to be very selective about the space. But yes, with the currency tailwind into a play, trading budges around, and I think one should be biased out there.
The stock that Dharmesh was talking about was Orient Pro. Yeah, that's the one, which I think around the time of Diwali is when Dharmesh essentially, I think, initiated coverage, and of course has been positive on it for a while. So 11:30 or so is where Orient Pro is at. Dharmesh, coming to you in just a bit, but we want to address some of the brokerage calls as well. And Gaurav is with us today, and banks are in focus. Gaurav, take it away.
Well, as Citi met the management of multiple banks, and first let's talk about HDFC Bank. During the management meet, what they have highlighted is that they are actually efficiently managing the cost of funds through borrowing, refinancing and TD repricing, which is term deposit repricing. Apart from that, bank said that over the medium term, deposit growth is expected to be higher than the credit growth. Now, this is actually important given that the CDA ratio was high for HDFC Bank. They have also reiterated that in FY26, they will be growing in line with the system in terms of credit growth, and in FY27, we will see bank outpacing the system. And lastly, they have also highlighted that the acquisition of new customers is something which is helping their deposit growth. When it comes to ICICI Bank, what the management of ICICI Bank is highlighting is that Q2 saw a bit of a slowdown in credit growth because they saw corporate growth, which was tempered by accelerated PSU loan repayment. But from here on, the management seems to be confident on capturing market share in a profitable way. Apart from that, they believe that the net interest margins are going to be range bound. We will see some kind of slippage increase in third quarter because of the agri loans, and we will also see some kind of repo rate cut impact in fourth quarter. MSME and other businesses, they do not see any kind of stress rising there. And lastly, what Citi has highlighted that the clarity on the appointment of MD and CEO is a key thing to watch out for when it comes to ICICI. Lastly, when we look at Axis Bank, the management said that the corporate segment is actually gaining some kind of traction. Retail is also being a little healthy. They do not see any kind of stress in cards. In fact, they are seeing stabilization in the personal loan segment and no visible stress in the MSME segment, which is export oriented. Apart from that, they believe that the slippages are going to be a bit higher in third quarter again because of the agri segment, and they have also revised their net interest margin guidance. Now they believe that the net interest margins will improve from fourth quarter or first quarter of FY26. Remember, this is because of the rate cut that we saw in the December meeting. Lastly, what Citi is saying that the optimization of the fee to asset ratio is presently constrained. So definitely watching out on all these banks and how they perform in a trade today.
Okay, all right. Dharmesh, thanks very much, Gaurav, for that. Dharmesh, wanted your view on some of these banks, but before that, I believe it's your birthday. So happy birthday from all of us.
So thank you so much, Prashant, Nigel. I mean, it makes my day
Well, what makes your day, Dharmesh? Happy birthday. Wishing you well. All the very best. We were talking about some delivery and all. We won't let you do that. We'll come across. Prashant, me, Surbhi will do a cheers to a drink, Dharmesh, but wishing you well. Thanks, sir.
Dharmesh, and let me take a moment of gratitude as well. It's great to always have you with us on the shows because you bring so much of clarity. You give so much of specific stock advice, which would be useful to many, many viewers. So cheers to that. Cheers. Have a fantastic day.
Should I ask him, Dharmesh, if you don't mind me asking, what's the number? Or forget it.
So, okay. As long as ever. As Prashant asked that, I think Dharmesh wanted to do the Durandar entry,
Okay. So enjoy your day and, I guess celebrations later. Dharmesh, just a quick view on banks. I think you have a view on some of the smaller private sector banks. I'm not sure if the list that Gaurav mentioned is on your radar, but just a quick view.
Yeah, Prashant, I mean, we have been constructive on the banking space and the private sector bank. We have been more constructive on Axis Bank. The reason being the last quarter numbers were quite good. And I think they have come out of the retail problem, the personal loan credit card segment and the microfinance problem which they were having. And last quarter, they delivered 11% kind of a growth on the credit side. And I think going forward, retail and the SME segment and microfinance should pick up from there. As far as asset quality and NIMS is concerned, there's a general problem with the entire space, so that should augur well. IndusInd Bank is what we have been liking of late. I think the problems in the IndusInd banking space is done with new management into place. Things are likely to turn around from here, and it's available very cheap. So these are the two banks which we are liking from the private sector banking space, and from the public sector banking space, Bank of India has been a pick from 107-8 levels. And we think that going forward, around 10-15% gains are likely there in the near term. So 155 is the price target we have been guiding with, slated for revision post Q4 earnings.
Okay, all right, Dharmesh, stay with us. Got that view from you. We'll take a quick commercial break here, continue the conversation with Dharmesh. But before we do that, here is, veteran diplomat, Shashi Tharoor. And this is part of a conversation that my colleague Parikshit had in Delhi yesterday. And his views on US-India trade deal negotiations and what can we look forward to. Just want to play out a soundbite. Mr. Tharoor, of course, is in no way involved in any of the negotiations, but I mean, he's someone that I guess he's widely looked to for these kind of things. So just wanted to play that soundbite out, take a break, and we'll come back with Dharmesh with more questions.
On multiple occasions, some people say 3 times, some people say 5 times, the two delegations have actually come to an agreement, and it's been rejected at the White House. So ultimately what Mr. Trump wants, only Mr. Trump knows. And I think, there will certainly be some red lines on our side where we cannot oblige them. And in a democracy, politics is an important factor. The farm interests of our farmers are not a negligible factor. 67% of our population still lives off the land. You can't put them in a position where, for example, they're swamped by wheat imports from America, to give you an example. There are some areas in which perhaps we could show some greater flexibility. We need to. There are many markets we could have done more to develop, that our private sector could have done more to develop. We could be selling very much more in Africa, parts of Southeast Asia, certainly in Central Asia than we've been doing. Europe, now we have an FTA, though people have overlooked the fact that it still has to be ratified by 27 countries. That could take a year. So we don't actually have it in force yet. We've concluded the deal, but it does have to be ratified, and then we're going to end up with I think, a significant impact on Europe. And all of these things are indispensable. Equally, as you said, strengthening our domestic system, both in terms of our own regulatory environment, the way in which our companies have been perhaps in some areas somewhat complacent. They've got to get their act together. We've got to be more robust.
Okay, welcome back. There's 13 minutes to go for the pre-open session to kick off. Hormuz is here with the big movers from yesterday and the kind of action we saw on some of these names. Hormuz, good morning.
Good morning, Prashant. And the good part for the bulls, at least in yesterday's session, was that the advanced decline was firmly in their favor. A lot of the movers in the small cap space were beaten down names. Look at Praj Industries, the biggest single day gain since November of 24. The volumes were the highest in well over 6 years for Praj. 2 crore shares were traded yesterday. The 20-day average of just around 6.5 lakh shares. But out of those 2 crore shares, only 15.5 lakh shares were marked for delivery. And the 20-day average here is less than 3 lakh shares. And why I mean beaten down, stock is down 60% this year, turning out to be the worst calendar year that it has had since 2008. Now, Reflex Industries, it saw a intraday recovery of almost 40% from the lows in yesterday's session. The stock ended around 18% higher after being down almost 20% in the pre-open trade. The stock has regained almost all that it lost last Friday. Now, Monday's volumes were the highest on record with over 4 crore shares traded, the 20-day average of just around 21.5 lakh shares. Out of those 4 crore shares, 33 lakh shares were marked for delivery, 20-day average of around 3 lakh shares. And Monday's turnover was around 60% of its free float market cap. Jai Balaji Industries was one such mover as well, snapped a 3-day losing streak. It was only the third day of gains that the stock has had in the month of December. Close to 2 crore shares traded here as well, the 20-day average of around 18 lakh shares. And out of those 2 crore shares, close to 30 lakh shares were marked for delivery, the 20-day average of 9.5 lakh shares. And this stock too is down around 65% from its 52-week high levels. And lastly, a word on the new listings. Corona Remedies had a good trading debut. Shares worth close to 2,000 crore were traded on the stock. Wakefit had a bit of a quiet debut, ended below its IPO price. And here too, shares worth almost 950 crore were traded.
Okay, all right. Thanks a lot, Hormuz, for joining in and filling us in with that. But we can't let you go so far, right? Tell us about the brokerage calls you have for us.
Some interesting brokerage commentary that has come in, Nigel. The first one being Morgan Stanley's note on Bharti Airtel. Maintain their overweight stance, but they have raised their price target to 24.35 from 2035 earlier. The revised target is a potential upside of around 18% from Monday's close. Now, what they're saying is that they see multiple levers for ARPU to grow in mid-single digits over the medium term, and that in turn will facilitate the India business's EBITDA to grow in double digits during the same time frame. And they expect a tariff hike to take place in the first quarter of FY27, but the stock should start reflecting that in the upcoming months, is what Morgan Stanley has said. And an initiation coming in on Arvind Fashions from Motilal Oswal. It's a buy recommendation, the price target of around 725, implying a 46% upside from current levels. They say that it has evolved into a lifestyle category, almost 15% revenue coming from adjacent categories. Their shift to a consignment-led model has improved pricing control and margins, and their asset-light structure is driving a faster scale-up and a strong cash generation as well for the company. Now, over FY26 to 28, they are expecting their revenue, EBITDA and PAT to grow at a CAGR of 13%, 25% and 32% respectively over that time frame. And on the bull case scenario, they are saying that the price target goes up to 1,065, which implies a 114% upside from current levels. The EBITDA margin improves to 16.5% from the 15% that they have projected in the base case. And the strong brand mix and high full price sales will drive a 14% revenue CAGR compared to a 13% CAGR in the base case. So keep an eye out on Arvind Fashions.
Okay. Interesting names there. Bharti, of course, I guess, huge wealth creator over the last couple of years. And Arvind Fashions is the other one. One from Morgan, the other one, of course, from Motilal Oswal. Thanks very much, Hormuz, for those. Dharmesh, I mean, any thoughts on either of the two names, Bharti or Arvind?
Yeah, I mean, Bharti Airtel, we have been constructive on so for quite some time. I think the valuations are now, priced to perfection. But you have such a limited play in the space that even if you are holding it, 15-16% kind of a compound is likely to be there. But the best way to play that, I mean, the entire space, the telecom space, to my mind, is still Reliance Industries because of its eventually when the Jio platform, have carves out, so the valuations, there's a 15-20% discount out there compared to the Bharti Airtel. So SOTP based, we are very bullish on Reliance Industries from a long-term perspective. To my mind, in the next 3 years time frame, around 70 to 80% kind of a gain should be there. Taking into account the retail division business, the Jio platform division business, and the new energy will start trickling in from FY27. So these are the, plays out there. But Arvind Fashions, I have not tracked for quite some time, so difficult to comment on that.
By the way, there was one more brokerage call. Arvind Fashions reminds me. There's one more broker this morning that's sounding very optimistic on Avenue Supermart, talking about how free cash flow will only improve from here on, as a lot of the newer stores start maturing. I'll just get to the details of that call as well. But would you look at this, Dharmesh? If you want to buy a retail/consumption stock, there's Avenue Supermart, there is Trent. Trent is a very different story altogether. We know this year was the year of undoing of Trent, so to speak. But now at these lower levels, does it make any sense?
Yes, Sumi, the problem with all these companies is not the business model. The business model is doing well, and after the supernormal run of the initial years, they have returned back to the normal growth trajectory, which is likely the case with any businesses going forward. So I think from here on, getting 15 to 20% kind of a run rate for next 2-3 years would be a challenge for them. And the competition is also hitting up across the segment, be commerce or same store sales growth or the new store. So but that's a challenge out there. The only point why people were invested in these companies in the initial years was the super growth trajectory which these companies were offering at that point of time. Now that has been done away with. So even now, if you look at the valuation multiple of say Trend after 50% correction from the top line, or Avenue Supermarts, which has never crossed 2021 levels, is still valued around 50 to 16 times P multiple 2 years forward. So, but that's the problem with these companies. I think trading plays can still be there, but fundamentally wealth creation kind of a play from here on, to my mind, it's difficult to come through in these companies.
This was CLSA, by the way. I'm just looking at the call again for the benefit of our viewers. And they have a big price target on Avenue Supermart. They say it's a high conviction outperform call. Target price of 6,300. That's a big one. So we'll keep this stock in mind as well. Let's see if the market is willing to side with CLSA's opinion that free cash flow is going to improve as the stores start maturing. Got that. Dharmesh, thanks very much. We need to take a quick break. Come back on the other side. We'll have the pre-opening rates. Also, Karan Torani of Elara Capital will join in to talk about what's behind the surge in the PVR stock. Welcome back. Well, we still have a couple of minutes to go before we get pre-open rates and, of course, the actual market opening. The indication is it's going to be a cautious start. The big question is that just like yesterday, will bulls come in to buy the dip and defend the lower level? It's been a very range-bound market, and perhaps we'll have more of that. Right now, it's about a 90-point dip that we are getting. Our technical experts are with us, Sudarshan Sakhani and Mitesh Thakkar. So let's ask them what is the best way forward. Gentlemen, morning. Mitesh, let me come to you first. So if you get another 90-point gap down, what would you do?
Morning, Survi. To be very honest, I think, the index hasn't been a very rewarding instrument because it's basically consolidating between 25,750, 800 to about 26,200, 300. So I think, if you get a 90-point cut, it's still in the middle of the range. But in case the decline intensifies, we, test about 25,800, 825 zones again. I think that's the time when you would want to look at long opportunities because that's where the support comes in. And then around the upper end of the range, you would want to take some profits and exit.
Okay, got that. Sudarshan, let me come to you. What is the approach? Any trades, Nifty, Bank Nifty?
Yeah, good morning. See, the level that is being defended by the bulls is 25,900 approximately. So if the Nifty were to slide below this level today, a short trade would open up because then that defense has failed, at least for the time being. If you get that level, if you see a slide below 25,900, professional traders can go short in the Nifty, keep a tight 70-point stop loss, and then take profits at around the level which Mitesh was talking about, 25,800. So it's a short-term trade, but the only trade today is on the short side.
Okay, all right. Let's get to individual stocks then. Sudarshan, you go first.
Well, it's a mix. The market is doing nothing. Chambal Fertilizer is a buy with a stop under 430. Muthoot Finance is a buying opportunity with a stop under 37.80. I have two intraday shorts, DLF, where you can consider an intraday short with a stop above 705, and IRCTC, which has a miserable chart, intraday short with a stop above 679.
Okay, all right. Let's come to Mitesh as well. Mitesh, what about stocks for today? What ideas?
A mix of buys and sells today. I have a buy on UPL with a stop at 753 for targets of 790. On the FMCG charts, good breakouts have taken place. In fact, I like a lot of stocks from the sector, but what I've chosen today is Godrej Consumer. Keep a stop at 1149, look for targets of 1200. And on the selling side is LIC India with a stop at 871. Look for targets of around 825. And KPIT Tech is a conditional sell if it breaks 1200. It's closed at about 1207. So below 1200, sell with a stop at 1221 for targets of 1160.
Okay. All right. By the way, in the next couple of minutes, we'll have Karan Taurani of Elara joining in, and we'll be discussing PVR and trends there in more detail. Before that, let's just pull up PVR. I mean, the 1 year, this has not been anything great for the stock. It's been very, very range bound. It's down about 25% in the last 1 year. Today it's up a little bit. And the last flutter of excitement, last 2-3 days, is because of the phenomenal box office collections of Dhurandhar, which I think at last count had already crossed 300 crores.
351 crores as of the weekend. This is the third film that's managed to hit 300 crores in this year. Sayara, Chhaava, and Dhurandhar.
So it's been good going for the box office. A bit of a comeback to the theatres to watch the movies. Very quickly, let's ask our technical experts if there's any, technically, if anything is shifting here. Mitesh, PVR Inox, any interest?
PVR yesterday had, obviously, because of some kind of positive news flow, it's had a very strong price action, though it kind of tapered off towards the end of the session. But I think if it starts closing above 1130, then I think, you would see a sustained rally beyond 1200.
Okay, all right, got it. Gentlemen, thanks very much. We'll come back to you a little closer to market opening, then we'll get some more ideas. But right now, let's find out if PVR Inox can indeed become a Dhurandhar in terms of the share market. We've got Karan joining in. Karan, morning. Always exciting to be talking the movies, right? And obviously with PVR, there's a longer-term picture. There's southern expansion. They announced 5 new screens in Hyderabad as well. But like Nigel was saying, this year has not been that bad. We've got some of the bigger movies back, and Dhurandhar has been nothing short of breathtaking the way it's been received. I mean, I watched it on week 2 when the theatres were completely packed, and apparently there's a sequel coming in March. But the point is, does it shift the needle enough for PVR Inox? The stock has been suffering in a range for the better part of the last 2 years.
Hi, Silvi. Good morning. I think this will definitely get some kind of respite for overall occupancy levels for PVR Inox in this quarter. But this was largely expected. Q3 generally is a strong quarter because of the festive season. We have got the likes of Pushpa 2 and Bhul Bhulaiya coming last year, wherein you saw a very big jump in terms of occupancy. This year as well, we've got Avatar coming in the last week of December, and this month actually started off very good because of Dhurandhar. I think in terms of the numbers, if you look, what exactly is happening is that the larger budget films are doing well on a selective basis, but there's a long tail of small, medium budget content which is failing to perform. So in terms of broad box office numbers, where we are today, in terms of Hindi net box office, we're at about 4,000 crores odd annual run rate. And in H1, we did about 2,000 crores of net box office revenue, which can potentially go to 4,200 crores towards the end of this year. So this kind of a delta will actually not lead to a big jump in terms of overall box office, but nonetheless, it's a small respite as large budget films are doing well on a selective basis.
Yeah, absolutely. So like I said, I mean, it's coming back from the brink, so to speak. But, you know, with PVR, the story is their own stated objective of diversifying away from purely being, you know, driven by box office revenue, what they're doing on the F&B side. And then there was some talk of trying to, you know, open these lifestyle hubs where they're looking at liquor sales, perhaps in the NCR, you know, arena. Tie-up it was with, I think, with Devyani or Sapphire, I forget which one, with the QSR chain as well. So they've been trying to do a lot to reduce their dependence on just BO collections. How do you, you know, sum up those efforts?
So I think that's a different business proposition altogether. They have to really create a brand in the F&B side and be competitive over there, because that market is going through its own set of struggles. If you look at most of the QSR companies today, the global QSR chains rather, most of them are struggling in terms of lower SHG growth. And competition is very high from the casual dining side. So this business can actually do well as an ancillary to support box office revenue and footfall and as a value-add services. But the moment you want to shift gears and probably make this as a core business, things have to be very different here in terms of strategy. So how do they actually execute that is a key monitorable to watch from here on. But as I said, it's not going to be easy for them to scale up on that side.
Okay, so all those efforts may be still challenging. What about their strategy? And in the last many quarterly interviews, they've been explaining to us why they're very big on the South. Because they feel that in general, movies are doing better there. There's a better occupancy. And they're opening more and more screens in the South. How do you look at that and the kind of money that they're putting to work? And what's your overall call on the stock?
See, South overall has been strategically very important for these companies in the post-COVID era. What's worked well for the cinema audience, or in terms of getting footfalls and occupancy back into cinemas, is, you know, a franchise type of content. Now, South is kind of known for creating a lot of franchise type of content. With you look at Kantara, KGF, RRR, Pushpa, these films have done phenomenal in terms of box office. I think Hindi is also getting there. We've seen the likes of Animal, Dhurandhar, Bhul Bhulaiya 3. If you look at all the franchise films in the post-COVID era, most of them have actually done well. So I think South is a very good strategy. South, it definitely is the future. Cross-selling of South content in Hindi dub markets is another very big opportunity that PVR Inox can actually leverage upon going ahead. In terms of stock call, I think we have an accumulate rating on the stock with the target price of 12.25. So as mentioned, films like Dhurandhar definitely will add some respite, but on a structural basis, consistency of films doing well needs to improve from here on if you were to see a big re-rating of valuation for the company.
All right, Karan, just to get the numbers straight, I think they're at around 350 crores. What are you estimating in terms of collections? What does it wind up at? I think most were in the vicinity of 400 crores. I think that'll have to be upscaled. So what are you working with? And an Avatar, the one that releases on December 19th, you know, the first part was very good. I think collections were 350, 360 crores. What are you working with in terms of collections for this one?
So in terms of, if you look at Dhurandhar, in terms of collections, we are pegging about 45 crores of net box office collections. This film has actually picked up in the second weekend. Generally, in the second weekend, you see collections falling sharply. Here, the fall has not been extremely big because the film has done well in terms of word of mouth. So film could breach 500 crores of net box office on overall basis. In terms of Avatar, the second part, which released about 3 years back, then also the collections were very strong at about 400 odd crores in terms of net box office as far as the Hindi dub market is concerned. We estimate similar numbers for Avatar Part 3 as well.
You know, by the way, have you seen the Avatar trailer? I saw the Avatar trailer. I have not watched Durandar or Avatar, but I watched the Avatar.
You've not watched the first Avatar?
Is it Avatar or Avatar? I used to call it Avatar, but anyway. The Avatar trailer, there are avatars fighting avatars. I mean, in the first one, there were avatars fighting human beings, right?
For the sake of the planet.
Yeah, for the sake of the planet. That made it, I mean, that was fantastic.
That was a brilliant message, yeah.
But this one, I mean, you can't make out who's the...
AI avatar.
No. I mean, yeah, there is that bit as well, right?
I'm
when
sure.
the first one came out, there was none of this AI-generated stuff, right?
Yeah.
And now when I thought, well, as I was watching this, I mean, production costs, etc., would be...
So weekend homework, and in your upcoming holidays, Durandar, Avatar, line out a whole slate of movies that you have to watch. But Karan, by the way, on your target on PVR Inox is 1255, you said. Which are the big... 1225, correct, sorry, 1225. What are the immediate triggers that you'll watch for? So occupancy is rising to how much by end of the year? Margins going to what level? Just give us the key triggers and the financials that you're looking at.
See, for the cinema business, for actually the growth to pick up both in terms of revenue and in terms of EBITDA growth, occupancy level is a very important measure here. Occupancy levels in the first half have been in the range of 24-25% on an average because Q1 was extremely weak, Q2 was strong because of Sayara. Q3 also will be strong in the range of 27-28% occupancy. That's the expectation as of now. But Q4, again, the Hindi content pipeline is not very great. We just have one large franchise film, which is Border 2, which is coming in. Apart from that, there's nothing which is promising, which can actually do a collection of 405 crores in terms of net box office. So annualized basis, we have taken occupancy levels of 26% as of now, which may not see a big upgrade. As far as EBITDA is concerned, they've done 350 crores of EBITDA pre-Ind AS in the first half of FY26. We do estimate a jump in the second half because of Q3 being strong and Q4 also kind of adding to some kind of momentum. Our EBITDA estimate on a full year basis, FY26 pre-Ind AS is about 850 crores. The jump could be in the range of 4 to 5%, not in a big manner, which means that the target price could actually move towards 1275 in the best case scenario.
Okay. All right. Karan, before we let you go, so that's a lot about the films and the movie business. But there's one stock that's completely dazzled in terms of the new listings, and that's Meesho. Phenomenal, right? Phenomenal reception by the market. What did you think of it? And now at around 160, last I checked, yesterday was around 160 when I checked it at least. Does it fully factor in the potential upside, the improvement, the profitability, the break-even that's being expected? What's your call now?
We don't have coverage of the stock, but just to give you a broad perspective on Meesho, I think in terms of growth rates, one should not assess growth rate of more than 20-22% for the company as of now, because the value fashion segment is definitely high growth in terms of the nature within the e-commerce market. But many of the large conglomerates, like of Amazon, Flipkart, are chasing this market very aggressively. Meesho does have a clout because the number of sellers are large. It really appeals in a very big manner in terms of zero commission model and going deep dive into the non-metro markets, the tier 3 and tier 4 markets put together. But I think from here on, if growth rates were to be at 22% over the next 2 to 3 years, with probably no respite in terms of profitability or a break-even or large margins, I think valuations are slightly at a premium in terms of EV sales for the company.
Okay. Karan, before we let you go, any other tactical or otherwise trades you have for stocks under your coverage from here?
So I think we're pushing Jubilant FoodWorks within the QSR, the segment basically, and other stock topic is Eternal. Jubilant primarily because it's a consumption-led play. I think GST benefit will see raw material benefit and also flowing on to gross margins for Jubilant FoodWorks. You are seeing price wars coming down as far as pizza category is concerned. And with 75% delivery exposure, Jubilant is the best place here to report better SSG growth rate versus peers.
Okay. Jubilant and Eternal are the two names which Karan is pushing. Karan, good conversation. Thank you very much for joining us. Appreciate your time here on CNBC. 3 minutes to go for the pre-open, for the market open, beg your pardon. And we'll just do a quick revision of the stocks that we put out in the morning. But 9:10 call, Sudarshan, morning, what do you have?
It's Chambal Fertilizers. Buy Chambal with a stop under 430.
Chambal from Sudarshan. And Mitesh, what about you?
I'll go with a buy on Godrej Consumer for targets of 1200.
Okay, Godrej Consumer from Mitesh. Okay, well, that's essentially what we are watching out for with regards to specific trades. 2 minutes now. and counting down. Britannia is what we want to shine the spotlight on. Mangalam is here with details on this one. Mangalam, over to you.
Well, we have Subhashish Basu, who is the ex-CEO of Anik Dairy, who's joined in as the CEO of dairy business for Britannia, a business that accounts for less than about a tenth of their company's overall revenue, but they are looking at growing this business earlier as well. The current head of dairy, Abhishek Sinha, has been elevated as the Chief Transformation Officer. All of this may perhaps be a part of the new management's strategy going forward, where Rakshit Hargave from Birla Opus has taken over as MD and CEO with effect from yesterday itself.
Okay, all right. Those are that's Britannia, which is in focus. Just a quick, look at stocks which we've put out since the morning. So Britannia, of course, with Mangalam there, 1/3% higher. Delivery will come up on your screen. Zydus Life is another one, which should come up. Kim's, Sonoris Pharma. There is HCLTech, which we should look at. Intellect Design. There's Geojit Financial. Geojit had a big move yesterday. Was I think up about 15% with large volumes. Zota Healthcare is of course doing a QIP. Zota, of course, has been a multi-bagger in a short time span, 3-4 years or so. It's gone up a few times. So that's the list of stocks. Smaller names, really. IIFL Finance is another one where I think there is an upgrade. And I think from S&P, stocks actually flat. And I'm seeing the stock at the bottom of the screen, BL Kashyap. I've been seeing that since the morning. There's a large order. And I think for BL as well, there is a ratings upgrade from CRISIL. And stocks up about 8% or so. So 57 now on that one. Just a couple of seconds. First rates anytime now. And we will have the opening level. So 25,966 is where the Nifty is starting, about 1/4% lower. The Nifty Bank is down about 1/3%. 59,200, 59,300. The small cap index is down about 1/3%. The mid cap index is down about 1/4%. And that's the overall picture. So, I mean, it's slightly lower, slightly sideways. Something similar, actually. We all yesterday as well opened about 1/3% lower, and by close we had pulled back and ended absolutely flat. So let's see if we will see something similar today as well. And lots of stocks opening up. Nifty heat map in terms of how the 50 stocks are starting. Quick sense, and then we'll move on. So you got about 45 odd names which are lower, and a few which are higher. Bharti, which we've been highlighting in terms of brokerage calls at Morgan Note, etc., starting strong. There is Indigo and Apollo Hospitals. And on the other end, there's Eternal, Axis Bank, and Shriram Finance, which are coming up right now. So that's the Nifty heat map. It's about almost 100 points lower on the Nifty with about 30 seconds in. Rupee.
Okay, by the way, the stock that we were just discussing with Karan, Meesho is off to the races. 4.5% up on Meesho. But at the same time, look at Eternal and Swiggy. Both these stocks have started lower. Eternal quite decisively so, down about 2.5% as the day opens up. So watch for some of these quick commerce / food delivery players. On the downside, what do we have? On the Nifty, Axis Bank, Infosys, there's M&M on the way down, there's Geo Financial, there is Hindalco, across the board really. HCLTech is also weak. IT is definitely weak. TCS is weak. That's what we have. Let's see what the bigger banks are doing. We had that big city call on a lot of the frontline banks. Check ICICI Bank, it's down about 1/4% right now. Check HDFC Bank, also down about 1/4%. So banks are down but not fully out. The weakness for the Nifty is largely because of IT and a clutch of other consumer stocks. There's also Titan, which is on the lower side of the screen. Nestle is about 0.5% lower. Reliance itself is 0.5% lower, dragging things down this morning. Let's see what's happening on the other end of the screen. Bharti Airtel, thanks to positive brokerage commentary this morning, up 1%. There's some buying on Apollo Hospitals, up about 0.3%, but that's it. By the way, beyond these two stocks, there's hardly any other Nifty gainer worth counting right now. It's an overall, down, gap down, full across-the-board profit-taking kind of a session. 100 lower on the Nifty. Nigel?
Well, that's right. A few stocks that are coming up on the radar with regard to top volumes. You have Transformers and Rectifiers. The stock is down close to 3%. One of the top volume losers on the downside. Hindustan Copper as well as seeing some profit-taking. That's down close to around 2.5%, as is the case with Hindustan Zinc. Remember, metals have had a big run. You'll have to say this is profit-taking, not a change of trend, at least as of now. In terms of other stocks that are doing well, Meesho. Just take a look at that stock, up 5.5% in late in trade yesterday, I observed that the stock in the final hour of trade went up close to around 4.5%. So put yesterday's last hour of trade and today's first few minutes of trade, the stock has actually gained close to around 10%. What else is doing well? You have BL Kashyap as well as Atlanta. Both of them have some positive news flow. So both of them, in fact, up in today's trading session, 4 to around 5%. I think Atlanta as well should come up for you on the screen. Corona Remedies, yesterday it's a big run, on listing day. Today it's come for some mild profit taking, I think so, or at least for starters. But that's another stock that's on the radar. So net, it's a negative start, but the Nifty has moved closer to around the 25,900 odd mark. And the last few trading sessions, dips have got bought into around this 25,900 odd mark. So let's see how it goes. Prashant.
Well, I think, 90 points lower, 92 points lower, settling down is where we are at this point in time. So that's the market for you. Plus, we'll come back and look at some individual names, etc. in just a bit from now. Rajiv Batra is with us. As, head of Asia and co-head of Global Emerging Markets Equity Strategy at JP Morgan. Rajiv, good morning. Welcome back. I suspect this is the last conversation of the year, at least.
Morning, Prashant.
And then we will be 2026. So, a tough year, right, Rajiv? But I guess after a tough year, maybe comes a slightly easier year. Not easy or a great year, but maybe an easier year. You think that's the broader kind of view out there as well? You think that'll be the case?
That's a very good phrase. When things get tough get going, and that's what Indian equities is all about. In a tough year also, we still try to get to the new highest level over there and didn't give a big drawdown. Yeah, relative term, we are underperformer, 25 odd % relative to EM on a 12-month basis. But on absolute term, we still protected investor capital who still parked their money and stayed with India overall. Yeah, going into next year looks pretty exciting to us. The market is getting more worried about trade deals or the global AI environment. What keeps us excited is that policy is working at forefront, be it on the monetary term, fiscal term, and most exciting is on the regulatory easing front. We are also seeing discussions on FDI, be it in insurance and nuclear sector. So all this is coming as a music to the ears of long-term investors, who exactly want India to work on policies, reforms, and regulatory easing. And that's what India policymakers are rightly addressing at this juncture.
How is this rupee weakness playing out? You can look at it. I mean, if you buy now, you're buying at a better level. But I mean, if it continues to slide, then you are at a loss. You lose if you put in money. So I mean, is there a level of anxiety there among foreign investors?
Obviously, there is some loss of confidence, and we can see in terms of flows also, net outflows from India equities, India debt market. Month to date is close to $1.6 billion. That shows up in form of profit booking in some of the trade ideas also from investors. Again, I will say one environment is not conducive for a risk on trade. We can see what's happening in the dollar environment. People are nervous this week because we have 11th central bank meeting, data points coming from US, job CPI, then China. And this is the reason why it's a risk-off environment, and that's where rupee is reacting. But beyond that, I will say rupee depreciation is inevitable and desirable too, taking into account the macro environment where you not only need to offset the differentials on US tariff, but also needs to make Chinese imports expensive. To discourage importers importing from China. So I do believe it's a calibrated move to depreciate rupee to keep economic growth going and not hurting your exporter in this environment. Beyond that, I will say we should not worry much about economic effect because inflation is already low. External debt levels are also low. So the only hurt which is there is on the equity investor confidence at this juncture.
And that's a big question, Rajiv, isn't it? Good morning. Great to have you in and wish you season's greetings. And I was exactly coming to that, this foreign investor confidence, right? And it's fine. Domestic flows have been so resilient that we've managed to hold the market on our own, which is a huge achievement. But we also realize that foreign participation is important if this market is to get its mojo back. Now, looking at the data out of your report, I think you folks are expecting 13% earnings growth in 2026 calendar year and 14% in 2027 calendar year. Now, will 13 to 14% earnings growth, along with a depreciating currency and the tax that we have here in India, will it still be enough to get the foreigners back when they're getting attractive bargains in deep tech, AI, etc., in the rest of the Asian region?
Thanks, Rupee, for having me, and happy holidays for coming weeks also to you.
Thank you.
Again, the base case does not take into account a massive rupee depreciation, which has just started overall, but a much more calibrated one, which keeps you in the range of around 81, 89 to 91 or max 92 over there. That is still welcome because it also gives entry point to the new investors also who think that this is the right level. You are right at the trough in terms of an INR and you get a good entry point per se. But any depreciation beyond that, will be definitely become a huge amount of a concern pertaining to investors who have been long into India, maybe for not just decade, but 2 or 3. But if it's purely coming to the growth perspective, saying that rupee remain at a current juncture, and despite that you get 13% earning growth, it will still be higher than what you are getting in AI part of the world. Remember, AI still is a hope trade. It has not translated into revenue so far. Like altogether, globally, if you look at the AI revenue, it's only $50 billion on a lot of capex that is being done. Earning growth is very different story. That's where if doubts start arising on AI trade, on earning growth term, that's where India emerges as a safer haven, which is still offering you a 12 to 13 weeks, or you can say anemic from our own history side, but quite decent and good compared to an environment what other countries or region are. And it's also important to remember, again, entry point over here. India is not trading at now 100% premium to emerging market. We are trading at a 50% premium only. So valuation gap has narrowed. And when you start your book at the start of the year, you have a brave decisions to make. The brave decision is, will you buy the markets and the play which are already up 80-90% last year, or you will look into the market that is giving you some value and a hope of a growth coming back. And that's where India fits the bill right now when you enter into next year as one of the big 4 emerging markets.
Hi Rajiv, good morning. Good to hear your thoughts as always. You're sounding a little bit more optimistic on 2026 from the time we last spoke. So that's heartening to hear, because otherwise our portfolios haven't done much just in the near term. Talking about AI, I have a 2-part question. One is on the global AI trade. Do you think that's peaking out? I wouldn't go as far to talk about, term it as a bubble. But do you think that's some signs of it peaking out? And you'll still continue with your underweight stance on tech, I think so. And that index actually is showing signs of coming to life. However, growth is still going to be very, very tepid. So how you all placed out there? Global AI and Indian tech.
Yeah. So in terms of an AI at an Asia level, we are neutral on that particular theme. We are no longer overweight on that theme, and that means we are even neutral to marginal underweight on Taiwan, which is heart of that particular theme. Our bigger concern is we think right now AI lacks moat. That's a key thing. Like, is it your AGI or it is your commodity, like your electricity? If it is a commodities, then definitely it will be more difficult to monetize. And that brings me to the next point, monetization. If you take all revenue, circular, direct subscription into account, there is only $50 billion revenue to support, on which there could be $650 billion capex next year and could be $5 trillion capex in the matter of next 5 to 6 years over there. But if revenue is not coming, monetizations is not coming, then the value does not lie on the AI generator side. The value lies on the use case side. So that's where our concern is, when adoption will come at a faster pace, how it will monetize. So that keeps us on the sideline, and you can say neutral on overall Asia IT sector, and even underweight on India IT. Coming to India IT, our bigger concern is, like, even though they are now started rebounding from September level, good 13-14% odd up, but year to date it is still down 15%, and the bigger concern still lies that valuations are not that dirt cheap enough to even become a neutral kind of a case. Coming back to the growth, 12-month perspective, trailing terms, which is in the bag, it's still very anemic, 2 to 4% only. So that makes the whole IT sector PEG ratio quite uninvestable. You need close to around 10 to 12% kind of an earning growth that makes a PEG ratio less than 2 for Indian IT, and that will bring the case back for the Indian IT sector. For now, it's too early, according to us, to considering all the AI-related disruptions, valuation expensive, and consensus still not significantly underweight yet. That keeps us at a bay on India IT sector.
Okay, that's India IT. So Rajiv, then leave us with your best themes here in India. You're clearly very optimistic on the market, and it's good to hear that. We've been through a rough patch. But as you expect the market to revive, earnings to revive, foreign participation to revive, what would be your, say, top 2 or 3 themes here in India?
Definitely, number one, domestic demand. That's the theme we need to go in because we have a tailwinds of policy easing. More is yet to come. 4 state elections, so social welfareism will continue on that path. Premiumization has been in a play. So I will stick with the domestic demand. And in domestic demand, I will say financializations of saving, premiumization, CapEx transition from older CapEx to the newer one, that is your EMS, robotics, defense. That's the one important to watch. And how we are playing at a sectoral term, materials, financials, and consumer discretionary. So these are the 3 ways we are playing it. And yes, not just India, global equities going into next year, JP Morgan is very bullish.
All right, Rajiv, what about on consumption? That's been a theme you like, right? Discretionary is still over staples, or if you're allocating fresh money, what would the proportion be in discretionary and staples, which have actually been rank underperformers, and some of those companies are very high quality companies?
Yeah. So in terms of a discretionary store, rather than making a broad jig sector call, we will say we are overweight on both discretionary and staples. But within staple, the preference is for food and beverage over HPC. And in case of a discretionary, the focus is more on auto, your QCs, retailer. These are the buckets which we like.
Yeah, no, absolutely. By the way, I just want to make a quick mention that market breadth is now, it may be a little early still to look at market breadth and things start to settle, but 15 minutes in, right? It's 2:1 in favor of declines right now. So 1,700 stocks lower and about 850 stocks are higher. And Eternal and Swiggy are down 3% and 2% respectively. We had a discussion with the Bernstein analyst, and the question is whether, there is a bit of a war brewing in terms of who's going to outspend to kind of regain, especially from a Swiggy perspective, to try and regain market share. So in that sense, everybody is sitting on a lot of cash. Some raised recently, some raised earlier. BSE is down 2%. BSE, by the way, is the number 3 volume-led loser right now. And by the way, this comes after yesterday's sharp cut as well. BSE was down about 3% yesterday. So that's about 5% in 2 days. High on Friday was 2750, and it's come down to under 2600 now. So that is Bombay Stock Exchange. Axis Bank is down, a full 2.5% this morning, 1253. There is Transformers and Rectifiers had a very sharp move from 240 levels to about 300, 315 in 2 days. It's giving back some. And so it goes GMDC, BHEL, Capillary, which is a recent listing, Corona, which listed yesterday, which is a formulations pharma company, is down about 2%, had a very good 30% kind of pop on listing day. So yeah, I mean, it's, a lot happening, but it's more down than up. And of course, I guess you guys pointed out Meesho, right?
Meesho is the only one.
Meesho is up 9%. Yeah. And we had a quick view coming in from Karan this morning.
Yeah.
So Meesho is 185, 186 right now, and on humongous volumes right now, mind you. And by the way, number 2 volume-led gainer is Shakti Pumps, which is, definitely displaying some Shakti because it's come up from, 550 levels 4 days back to about 780. So had a painful, almost 50% decline from the highs, and is now coming back on the back of some orders, etc. they've got recently. Wakefit is another one, which is up 3.5%. So that's Wakefit, recent listing. Yesterday's listing, by the way, Wakefit. And Iron Exchange is up 8%. Iron Exchange also, by the way, the recent low was 330. It's moved up 100 rupees in a few trading sessions. So that is some of what we are seeing out there at this point in time. I think we had Chambal Fertilizer, as Mitesh has called. Chambal is up about 2.5-3%. Actually, all these fertilizer companies, right? Look at Chambal, look at Paradeep and Paradeep, of course, non-urea. Fact, that is fertilizer Travancore, 6%. And a bunch more on the fertilizer side, which are doing very well.
By the way, just pointing out, Axis Bank is seeing some very decisive selling this morning. Yeah, it's down about 3% right now. And the selling on the others, while Meesho is rising, going to the skies, the others, Swiggy and Zomato, continue to be under
And
pressure.
just one more stock, BSE. Yesterday the stock was under pressure. And today
5%
as well,
in 2 days.
Yeah, it's, and currently it's at the low point of the day as well. I don't know whether the street is sniffing something, but a stock that was 3,000 rupees just a few days ago, that's come down to around 2,600. We'll keep an eye on it.
16.
There's a SEBI meet, right?
Yeah, I think it's on 18th, I think. There's a SEBI meeting, a board meeting, and some chatter that we reported, by the way, that SEBI is essentially looking at exploring, sort of defining eligibility criteria to access F&O markets. So will this board meeting take it up? Will there be a discussion paper? We don't know, but I can't think of anything else on the back of which BSE is correcting, unless there is something else. But there you go, 2,600 on BSE. Arvind Fashions is what we want to focus on. Rajiv, by the way, if you're still there, thank you very much for joining us. Good speaking with you. Wishing you a fantastic 2025 New Year, and see you in the new one. Thank you.
Thanks, Prashant. Same to you.
Okay, Arvind Fashions, right? Buzzing. Motilal has initiated coverage. Vinny is here with more details. Vinny, over to you.
Hi, good morning. So yes, they've initiated coverage on this one with a buy rating, target price of 725 rupees per share, which implies a 46% upside, right? Now, in terms of the view, why are they positive? Overall, they believe Arvind Fashion is one of those companies, they've moved in to that lifestyle category, 15% revenue growth that one has seen, adjacent categories, from this adjacent categories, which have seen such a good growth coming in. Also, the company has shifted to more of a consignment-led model, which has led to improved price controls. Margins have started improving as well because of this change that has come in to the consignment-led model. Other than that, asset-light model is what they are following in terms of structure, which is driving up faster scale-up for the company, stronger cash generation as well. And overall, Motilal is expecting in terms of CAGR growth over the next couple of years, FY26 to FY28, for revenue or CAGR growth of 13%, EBITDA growth, which is pre-Ind AS growth, is around 25%, and PAT growth at around 32%. Overall, the bull case scenario is even higher, right? When you look at it, they have given a target implying around 1,065, which is a 14% upside that one could watch out for. But yes, a good performance that the company has seen, 5 power brands which the company is focusing on, which they believe will lead the growth for the company going forward.
Okay, all right. Thanks a lot, Vinny, for joining in and giving us that update. Clearly, the stock excited on the back of that note. But let's focus on Bharti Airtel. That's as well doing well in trade. Rima joins us to help us out with a brokerage note out there. Rima?
Thanks so much for that. So, Bharti Airtel has been a big outperformer. It's up 30% so far this year. In the last 3 years, there's been a rally of 150%. In the last 5 years, it's gained by more than 300%. And Morgan Stanley sees more upside in the stock. So they have an overweight rating, and they've increased the target price to a number above 2,400. In the near term, they're saying they expect a tariff hike in Q1 FY27. They believe that will start reflecting in the stock price. But over the medium term, they do believe that ARPUs can compound in high single digits, which will result in an EBITDA growth of double digit. And return ratios should also start improving. And that is the thesis for Morgan Stanley's bullish call on Bharti Airtel. Back to you.
Okay, all right, got that. Rima, thank you very much for the details. Well, with that, let's move on to our next guest. And the company in focus is Narayana Health. The stock has surged more than 44% in 2025. So who's saying that this was a year of flat returns? Not really, if you're in the right kind of stocks. Well, what's the outlook going forward as we step into a brand new year? We have Sandhya J, Group CFO at Narayana Health, joining in, and we want to discuss 3 broad areas. Sandhya, morning. Let me just lay them out for our viewers. We want to understand the implications of price hikes, the ones that hospitals probably are taking or will take as the year starts off, the new year. Second, the CGHS price increase. Now, what has that meant for Narayana? And then what is the outlook with respect to the integrated healthcare business? So, Sandhya, let's start with the first one, the price hike. I mean, I remember from our earlier conversations, I think you always look at price hikes in January. And these are, I mean, fairly modest, to say mostly. You try and keep it modest. I remember that from the old conversation. But how severe is medical inflation this time around? And how are you thinking about pricing as we step into 2026?
Good morning. Thank you for having me here. So as far as the pricing is concerned, again, we aspire to keep it very modest, given that there is definitely paying pressure both on the insurance side as well as on the cash side. So we are aspiring to keep it modest. The cost, of course, one impact which will significantly come is the wage impact, both because of the new labor code, there is some amount of cost impact that we are going to see, but also in terms of the regular inflation that we are seeing. The second big piece which is playing a material part for us is currency. The volatility that we are seeing in currency and therefore the impact it is having in terms of our capex spending is another part that is playing. On the positive side, of course, we are still continuing to get flow-through benefits from the investments we've made in technology. That's what has allowed us in the past and continues to allow us to keep our price increases moderate. And the other positive play which is playing in our favor is the more and more higher-end procedures that we are able to do, and that's also helping us a little bit on the pricing side.
Okay, so that's offsetting some of the pressures, got that. But when you say modest, how do you define modest? Is it in single digits? How should we read it?
Very low single digits.
Very low single digits. Okay, that'll be extremely helpful for your patients, I'm sure. But also tell us where conversations are with insurers, because there's been a lot of chatter in the recent past about insurers looking at not raising rates. Have there been any conversations that you've had? And what's the outcome?
Insurance negotiations are for a period of time, and therefore continuously through the year, there would be some insurance which would be coming up for renewal. And every time we go for renewal conversations, like any other negotiation, there is a push and pull. The insurance insurance organizations are also struggling with their cost structures, and therefore there is a lot of pressure that's coming. But what we have seen is that if we have a meaningful conversation, I think we've seen reasonableness at the end of insurance as well. And we also get very good support from hospital organizations like HPI, Nat Health. So where there is certain behaviors that we want to address, we do take help from them. But largely on a bilateral basis, we've been able to have meaningful conversations because our price hikes are not significant. Our regular SOCs are something that insurance are able to accept, of course, subject to some moderations which both parties have to accommodate.
Sandhya, morning. Just one thing. There's no communication from in terms of these price increases, etc. There's no intimation of the government or anything, right? Whether you can go ahead and maybe we reported that there was some deliberation going on, and the government was holding meetings with hospital companies. I think there were a couple of rounds with different sets of hospitals. Anything you can tell us?
So there is there are a few conversations which have been more to bring a sense of balance between insurance and hospitals. I think in the last conversation, what we are given to understand is that the government has instructed both sides to be reasonable. From a hospital point of view, I think the cost of care has to come down, and that's something that we as Narayana also keep talking about. And from the insurance side, to be more reasonable in terms of deductions, in terms of paying for the right procedure, the right price. So at the moment, all the meetings that have been held with the government intervening as well have been trying to give balanced instructions to both sides to find a balance, because the most important thing is people need to have access to care. And with some of the stress that's going on, cashless are being disabled for people, and people are not able to avail care seamlessly. So that has to be addressed. So which is the intent of the government?
Yeah. We had reported, the last round that we reported was around the 13th of November is when we said, well, the second round happened. I don't know if something happened after that. But, after the first round of these meetings, what we reported is that some hospitals had agreed to not take rate increases in 2026. when you say both sides to be reasonable, I understand. I mean, it's not a question so much for Narayana, but do you think we are moving towards increased scrutiny across the healthcare costs from a consumer perspective, which includes insurance and, of course, hospital charges as well?
The scrutiny is at one end, it is required also, because if there is an unreasonableness from the hospital end, we need to correct. But at the same time, whatever scrutiny is being taken by the insurance companies have to be fair, and we need to be reimbursed for the costs that we are incurring. One part which we always miss is that healthcare is a very expensive business proposition, and we've spoken about it multiple times on this call also, and so I don't want to list down. But it is a labor-intensive industry. For every patient that we serve, we have 5 people in the hospital doing some sort of a service to enable that patient avail that care. So that is the multiplier. And then infrastructure. There are no zoning laws in the country. So if you have to set up a hospital, you have to negotiate with commercial real estate. So there has to be an acknowledgement that there is a significant high cost involved in delivering healthcare. And if you look at it in comparison to any country in the West, the quality matches, but the cost is like 1/5 or 1/10 of the Western countries. So hospitals are doing something right. Now, finding that balance is important, but I don't think there will be a position that we will be able to completely do without price hikes, or we will be able to run without being fairly reimbursed for the work we do.
All right. Hi, good morning. Good to see you, Vin. Well, let's go overseas then, and let's talk about your international operations. Narayana Health, well, they acquired the UK-based Practice Plus Group hospitals. I think it was done at a little south of 200 million approximately. Is it on track to hit that 250 million pounds in FY25? And if you could give us a sense in terms of scaling up, how will it contribute on revenues, margins as well in the time to come?
So we're not giving any forward guidance, but what we've reported out, I think we are trending quite robustly in terms of revenue. Now, in terms of our future potential, at the moment we are assimilating. It's a fairly well-run organization. We've been able to retain the entire leadership as part of the acquisition, and therefore we are enabling from a growth and cost point of view, but we are letting the management run the course of their plan, which itself is quite a robust plan. We are looking to improve margins. Mostly it will come from technology and more importantly, improving the payer mix. What we mean by improving the payer mix is that currently more than 90% of the revenue of PPG comes from NHS. NHS is a very positive book of business. They are good payers, which means pay on time, inflation adjusted, and provide long-term contracts. So that gives us a solid base, and we'll continue to capitalize on that base and continue to serve. But there is capacity available. So we are looking to utilize that capacity to be able to attract a private pay, which other private healthcare organizations have also been able to successfully do in the UK. So with the same capacity, as we are able to improve the payer mix, we should definitely see both revenue and margin growth.
Any indication of how much? I mean, your margins are almost touching 26% as of second quarter. As losses in that integrated business come down and your payer mix keeps improving, those high-end surgeries that you spoke of, around what vicinity are you likely to end the year, FY26?
So I don't want to give a guidance, but there are certain factors I want us to keep in mind. One is that now that we have acquired the UK business, so we will see dilution because of that, given that it is a lower profitable business, so you will have to adjust for that. The second is that because of the acquisition, there will be exceptional costs. We have incurred a lot of pre-deal costs, costs of diligence, costs of various costs. Some of the impact of that will be extraordinary items that will come into the P&L in the current quarter. Q3 is a poorer quarter relative to, you all know, you've been tracking us. Q1 and Q3 are cyclically weaker and Q2 and Q4 are cyclically better. So therefore, Q3 will have some cyclical weaknesses both on the revenue and the margin front. So when you see the Q3 numbers, all of this will play out. Q4 will be definitely very robust for India, the way we are seeing the outlook for Q3 and Q4 from we've picked up quite a bit in India and we're continuing to do more. So we will see that positivity in India. Cayman will be more or less stable. UK will be continuing at the levels at which it is. So that's how our numbers will culminate for the year.
Okay. All right, Sandhya, we will leave it on that note. Thank you so much for joining in and wish you happy holidays. Wish you a very happy end to this year and a happier 2026 as well. Thank you so much for joining in. Well, we'll take a break on that note. On the other side, the management of Kaplan Point Labs joins in. They'll give us their outlook for 2026.
Well, as promised, let's focus on the next company, Kaplan Point. That's the stock in focus. It's down in this year, actually. The stock has struggled a little bit, but know that the company has plans for 15 project launches in FY27 and is eyeing new markets such as Mexico as well as Chile. To discuss this and more, we're joined by Mr. Vivek, the Chief Operating Officer at Kaplan Point Labs, who joins in. Hi, Vivek. Good morning. Good to see you in, as always. The year has been a little rough for a lot of mid-cap companies, but you're eyeing better plans for the next year. Let's focus on the top 3 points, though, that we're going to be talking to Vivek about: the U.S. market outlook, acquisition roadmap for 2026, and expansion plans, GLP-1 drugs. That's going to be top of mind. Well, Vivek, let's start with the recent news flow then. The company's U.S. arm, Kaplan Steroids, where it was granted final approval for Linezolid injection single dose. If you could tell us what is the potential of this particular approval and also what's in the pipeline for the coming year.
Yeah, so we've been getting approvals at a good speed recently. We've got about 2 or 3 ready-to-use bag products approved. And in the next 3 months, we're also expecting a couple of more niche and high-value products coming through. And the idea now is to make sure that we execute and launch them as close as possible. As you would have seen, US continues to grow very well for us, both in our B2B and our own label in the front end. And we need to make sure that these newer approvals maximize our earning potential in the quarters going forward.
Okay, got that. So if we look at some of the trends going forward in terms of more launches in the US, What's the pipeline looking like over the coming few quarters?
So we have already about 40 plus products approved in the US. If you look at our numbers compared to what we were about 4 or 5 years ago, you will know that our R&D and regulatory potential has been very well established. In fact, the market average for getting approvals for products is around 25 to 28 months, whereas our average is anywhere between 14 to 15 months. So we're doing well in that direction. We're also actively working on the inorganic route as well, acquiring ANDAs from outside. We've already done a few, and we're at late stage to acquire another 10 plus products, hopefully in the next quarter. So this should really augment our growth going forward. Next 18 to 24 months is going to be a very interesting period for us, not just for the US point of view, but also for Mexico, Chile, etc. But yes, I think US is growing at 25 to 35% on an average, of course, at a small base. But the important thing about this growth is it's a good quality growth, where the bottom line numbers is very comparable to the parent company, which is already at a fairly decent level at 34-35% when it comes to EBITDA.
So you're expecting your US business to keep growing at this steady clip of 25 to 30%, right, Vivek?
We expect that in the next 2 to 3 years at least. And we're also expanding capacities and our plan, taking into account these newer products coming through. Hopefully in the next 2 years, we expect to be top 3 or top 4 in India when it comes to overall capacity at our plant when it comes to injectables.
Okay, one more point. You mentioned that you're looking to acquire more ANDAs. You have 10, I think, that you're looking to snap up. Now, with respect to acquisitions, because you do have a fair amount of cash on the books, over 1,300 crores, is this going to be utilized only for the acquisition of these specific products? Or are you looking at, a more strategic acquisition of a company or an entity?
Yeah, so we're sitting on fairly good reserves, and that's going to go up. In fact, every year we're able to put away anywhere between 300 to 350 crores of cash from our regular operations itself. At the end of this year, we're looking at anywhere between 1,350, 1,400 crores of cash. And we are certainly looking at something inorganic. Nothing is advanced right now, but to the point where, we as a family hold around 71% of the company. We are not against diluting a little bit of that to make sure that we're able to sign off on a much larger ticket size as well. Doesn't necessarily to be ANDAs. ANDAs don't really cost that much, but something that fits in with our line of growth, Latin America, distribution, even something in the domestic market. These are all things that we like very much. It sort of fits in with our expectations on where the bottom lines, cash flow, everything which are very important for the company needs to be. So we're not shy on writing a much larger, acquiring something much larger as well. If you consider what we're able to do with our surplus and with also our high holding on the promoter side of the parent company.
All right. Vivek, just to clear that point, you were just mentioned something about dilution. What is that? Dilution in which? In the listed entity or the holding?
Yeah, so right now we're at about 71%.
Yes.
So something meaningful comes in, and that requires a much larger ticket size. We're not against a very minor dilution of our equity as well. So in fact, we were looking at something similar to this about 3-4 months ago, but eventually that didn't pan out because we didn't understand, or we didn't really find that the future forward-facing numbers looked encouraging. But we're not against this, is what I'm saying. Many people have asked us this question as well.
Yes. And I have my ear to the ground as well on this point. So a potential size of dilution that you all would look at, you're at 70%. The company is close to around 15,000 crores of market cap. So what could that quantum of dilution, if you get the right opportunity, what is the quantum of dilution you could be looking at? And by a dilution, you could mean a QIP, a preference issue, something on those lines?
Yes, all options are on the table. We're not against doing anything between 5-10%. That would probably be, between 71% and 61%, we don't really find there to be any difference at all, as long as it's something meaningful for the company. So obviously from a promoter's angle, some people are very sensitive towards this, but we know that being part of a larger pie makes better sense for for us as a company, if it comes to that. But the most important part is it needs to be something meaningful. It needs to be something well run and something that really fits in with our growth targets and numbers that we're already able to show right now.
All right. So the potential acquisition size, going by the kind of dilution that you're talking about, could potentially be in the vicinity of what? Around 800 to around 2,000 crores approximately, the acquisition target? I'm just doing a back of an envelope calculation. You're at 15,000 crores of market cap. You wouldn't mind coming down from 71 to around 61%, which would mean there will be fresh shares that will be issued. So back of an envelope suggests that maybe 1,500 to 2,000 crores of equity fundraising is what you could be looking at. Will that be a fair estimate?
Something like that, and even a little bit bigger as well, is something we could do next year. But again, remember that we're not close to doing anything. This is just a statement that we are making, that we're not against something larger when it comes to inorganic, but it really needs to be within what values we stand for as a company, what numbers we're comfortable with. Yes.
Interesting. And you're saying that you're going to be getting various approvals, in place as well. What about growth trajectory and steady state margins? Two of the most, simple details that we ask for. Getting into FY26, almost halfway we're done. But getting into FY27 as well, what should the growth look like with and without the inorganic growth?
Yeah. So at this point, this year and next year is going to be very important for us because we are putting down the building blocks for many of our growth levers to really fire up after 18 to 24 months. Some of them are the continued progress that we make in the US, our entry into Mexico, our entry into the oncology business, and also our expansion of presence in Chile as well, and early entry into Brazil as well. So all of these things will start to take shape in about 18 to 24 months. Until then, I would say that we would be at high single and low double digits when it comes to the overall company. But 27, 28 and beyond looks quite promising for us because many of these things that we are working on will start to take shape during that time.
Okay, all right. We will leave it on that note. Thank you very much for joining in and giving us a sense of the business. Wish you a very, very happy and prosperous 2026.
Thank you.
That's Kaplan Point. Quick check back on the screen. Let's see what the market's doing. Still down about 0.5% on the Nifty. No sign of buyers just yet. Mid-cap index is down a little more. It's down about 0.6%. However, some stocks which are managing to buck the trend include Meesho. Meesho's up 10%. Not sure what's going on over there. 188. I think it crossed above, went above 190 as well. Still holding on to that 10% gain. The other one is Avenue Supermarts. Like I was mentioning earlier, it is a high conviction, quote unquote, high conviction buy for CLSA, and their price target is northwards of, I think, 6,000. Let's go across to Mangalam to find out what is making CLSA so optimistic on DMart. Mangalam?
It's a long-term growth story. That's what everyone is excited about on DMart, right? Because it's a strong business with a fair amount of moats as well. And now every time, brokerages look at DMart in the current state, they look at valuations and they feel a little perturbed. But at the same time, that they look at the long-term opportunity and they look for inspiration outside of India as well. And that's what CLSA has done to maintain their high conviction outperform call in a 6,300 rupee target price. They've looked at free cash flow trends across global retailers like Walmart, Costco, BIM, etc. And they've said that the early expansion years typically find negative free cash flow due to rapid store additions in the company. And as this expansion normalizes, the free cash flows start to turn strongly positive. DMart, they believe, could follow similar trajectory once store additions stabilize. India's consumption outlook remains strong, and DMart has a deeply moated business model. It will be very interesting to see how this really plays out because, one part of the street definitely wants DMart to accelerate store openings. So it's not the FCF or free cash flow that is as much of a concern for the analysts than, the pace at which the company continues to add stores because DMart's balance sheet is fairly strong. So right now what the street wants is the company adding stores at a faster clip and compounding top line a lot faster than, increasing the free cash flow to the firm.
All right, Mangalam, thanks very much for that. So that's Avenue Supermarts, 38.91 on the stock right now. Chandan Taparia is with us, Head of Derivatives and Technicals, Wealth Management at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. 130 points lower and lots of moves across individual names, which we can talk about. But index level, what's the trade?
Good morning, Prashant. Thanks for having me. So Nifty got stuck in a range from last couple of weeks. Declines are being bought, but follow-up is missing at higher levels. Index has multiple support near 25,700, but at the same time, sustained call writing and hurdle at 26,200, 250 is not allowing index to get the momentum. So we have to be with this trading band. The good part is that index is holding well above its 50-day exponential moving average, but the concern is FI's selling is not getting over, and FI's long short ratio has gone to 10-11%. So I believe because of all these reasons, market is likely to be in a broader range. So we have to deal with the range between 25,700 to 26,200 kind of level. And we believe that swings could be there in this range for next couple of days. And when we talk about Bank Nifty index, comparatively holding the support, but again, mixed cues are visible. 58,500 to 59,750 is the trading band for the Bank Nifty index. Now talking about stock specific, here we need to shift our focus on consumption and selective FMCG counter after a long time. So first trading idea is buy on Titan. After the consolidative move last 4 or 5 weeks, it has taken supported higher zone. We have seen some open interest addition with shift in support at higher levels. So recommending to buy with support of 38.40, looking for an upside target towards 4,050 kind of level. Second trading idea, that is buy on Bharti Airtel. Recently, it has taken support near its 50-day exponential moving average, negating its lower top, lower bottom on daily charts. In fact, we are witnessing some put writing and short covering is expected in the counter. So one can buy with support of 2040 for an upside target was 2180 kind of level. And one more trading idea that will be buy on SRF. Selective chemical stocks are doing well, and we have noticed a rounding formation on this name. In fact, the longs are being added, and those are intact in the system. So with support of 2950, looking for an upside target towards 3120 kind of level in SRF.
Okay, all right, got that. Chandan, thank you very much for joining in with all the trades for the morning. We'll take a break on that note. Come back on the other side. We'll have Manisha Gupta joining in with the latest from the commodity space.
Fly Emirates, fly better.
Welcome back. As promised, let's see what's happening in the commodity markets. We have Manisha joining in with the latest. Manisha, what's the headline?
Well, I'm looking at aluminum this time around because we've seen prices gain onto this one as well. It's trading 13% on the higher side, not too far away from its all-time highs. It actually is trading near 2022 highs, also a year when aluminum actually made an all-time high as well. Well, there is a lot of demand coming in from EVs, from construction, renewable energy sectors, and that clearly has been supportive for the prices there. Apart from that, it is also about the copper-aluminum ratio, which is near record highs. So because all the metals are doing well, so is the case with aluminum. And aluminum also turns out as a proxy when copper gets too expensive and when silver gets very expensive as well. And aluminum really seems to be finding more usages when it comes to renewables and green energy, and that is where the support is coming in from. Also, it has been about the US tariffs to the tune of 50%. That's leading to less imports within US. When you look at the Canadian aluminum export into US, there has been a decline of 22% this year so far. Canada aluminum, of course, has been going into various other countries, including UAE and Asia as well, but the quantum continues to be slightly on the weaker side there. And then China is an important market where you have seen aluminum output close to the self-imposed 45 million tons of a production cap that China has put out. So when you look at the Chinese production, it has really gained in the last decade or so. 2007, China aluminum output was to the tune of 12.6 million tons. 2025, it stands at 45, and this is where China has put a cap as well. But interestingly, China perhaps will not put a cap on those smelters which are using renewable power. So you could be looking at higher numbers in any case in 2026 there. China also is investing in aluminum outside of China, Indonesia, for example. But Indonesia also seems to be going on with their power concerns, and whether or not all that investment will start showing result in 26 or 27 is something that the markets will keep an eye on. Indonesia exports, when you look at those numbers, well, they are up 58% on the year, and the newer capacity estimated is at around 1.4 million tons for the coming year there. If you look at European markets, well, there are power concerns there too, and aluminum sector is affected because of the energy crisis there. You have similar concerns also coming in, soaring power costs leading to smelter closures in US, in Australia, and in Iceland as well. And many of this perhaps would not come on board until late 2026. Take a look at the deficit numbers then. 2025, we are dealing with 100,000 tons of deficit in the global markets, which is expected to double by the time it's end of 2026. Also, take a look at the demand numbers there. So 2020 global aluminum demand stood at 86.2 million tons, while we are looking at 119.5 million tons of an expectation by the time it's 2030. It's quite varied on where the aluminum prices could be in 2026, but most global banks and brokerages believe it's going to be higher from where we are trading right now. So currently, we are trading at around 28.50. Bank of America is the most bullish, talking about 3,125. JP Morgan and ANZ are putting it to 3,000. 2,900 is what ING believes. Goldman Sachs thinks that there could be more supplies going forward. If all that projections do come alive, then we perhaps could be looking at pressure going forward. So barring Goldman Sachs, which is putting it at 2,350, and Fitch ratings at 2,300, everybody else believes that we are looking at higher aluminum prices in 2026.
All right, Manisha, thank you very much for that. That's aluminum in focus today, and looks like, a general view is commodities set to perform base and otherwise well into 2026. We take a quick commercial break here. We're going to come back, Lata, in conversation with Santanu Sengupta of Goldman Sachs, Madhavi Arora of MK Global on the excellent numbers. Remember, November exports are strong, gold imports are lower, trade deficit, of course, much better than October. We'll ask the question, why isn't the number helping the rupee, which has made a new low? Stay tuned, coming up.
You want to talk business? Meet me in the On-Board Lounge.
Welcome to It's the Economy, and this is good news. India's goods trade deficit fell very sharply in November to $24.5 billion versus an all-time high of $41 billion in October. But the reason why it fell is even better. The lower deficit was because of, one, a steep fall in gold and silver imports, and two, more importantly, exports did very well. They rose almost 20% year on year. So does the lower deficit now look sustainable? I mean, can we repeat the November performance? Are economies lowering their current account deficit forecasts? And why isn't the rupee recovering? In fact, it's a new low today. For all this and related questions, I have with me two top-notch economists, Santanu Sengupta, the chief India economist at Goldman Sachs, and Madhvi Arora, the economist from MK Global. Madhvi, Santanu, thank you very much for joining us. Santanu, what were the key takeaways from the export numbers? Did you take away something very positive in that, we are doing well despite tariffs?
Yeah, thanks, Tata. I think, you mentioned two. I think the third point I would mention, apart from better exports to the US and lower gold imports, is the diversification of shipments outside the US for particularly labor-intensive exports like textiles and gems and jewelry. Overall, the number has beaten market expectations. I think the market was expecting somewhere around $30 billion. It came in at around 25. We think the peak current account deficit is in this quarter. It'll improve from the next quarter. So the current account stress, particularly on the rupee, we think largely would be behind us. There are other things which are impacting the rupee, which we can get into later on, but the current account stress is likely behind us now as we head into 2026.
But are you changing your current account deficit number? Are you having a downward bias to the current number?
We already had a sub 1% number. I mean, it can tweak around by maybe 10 basis points, but in any case, it wasn't really the piece which was moving the needle so much. Apart from the fact that all of that happened in the second half of the calendar year. I mean, last quarter and this quarter, the current account widened. But on an aggregate basis, it still looks quite manageable. But it's just that it all came together during Q3 and Q4, which is why you had that exaggerated move in the rupee.
No, I take your point that the current account, even if it is 1.3, 1.4, is not a big deal. We have lived with 2% plus for a very long time. It's just that even that minor deficit is not getting filled up by capital flows. Madhvi, your thoughts. What are your key takeaways from the November data? And are you likely to lower your current account deficit number?
Hi, Lata. So clearly the way things are moving, it's getting extremely difficult to really catch the trend. The trade numbers have been very volatile. Nobody expected it to be sub 30 billion. And here we are, right? So I think one has to reckon the fact that there's been, I think across Asia, it's not just India. If you see Asia exports as well have done extremely well, possibly largely led by tech. But for India also, if you look at the, diversification we have done, in our tariff-led exports, especially, segments like gems and jewelry, textiles, they actually have been pretty, I mean, they've not, YTD have not seen a massive growth, but have been largely flat. There's not been a negative growth. Have found new markets, especially sectors like marine products. They've actually seen 15% growth on the back of higher shipment to China. We also see in the rest of the world growth actually being much more resilient and actually, increasing their share in the last 3 months. So it's a quite, encouraging trend in terms of both resilience as well as diversification or shipments, or whatever one would like to say. I think it's not just India; it's actually Asia, which is again.
So then it is a sustainable trend.
Led noises very well.
So Madhvi, would you therefore say it is sustainable?
Well, I have to really see that, because honestly speaking, last month we were so bearish on the trade that we were discussing whether this month could also probably be touching a 30 billion plus number and what it would imply for the current account or BOP. As we stand today, the 4-month low deficit of trade again is making us, think about the trends that we may see in the export sector. My sense is that businesses are very smart in the end, right? Across the world, they would want to adapt to the new global order. So I'm not sure whether it will be sustainable. I'm sure, but there'll be a way to weather out these noises. Even if we are seeing some volatility in trade numbers in India or in Asia, I think on a more smoothened basis, I am very sure that businesses will be able to weather this noise.
Shantanu, can we make the statement that therefore the US tariffs don't matter as far as the Indian external sector is concerned? We have learned to weather it.
I think it does matter. I mean, if tariffs were not there, current account would be slightly lower. But I think what's happening right now is that you have a confluence of the current account widening, lower capital inflows, likely partly because of the US tariffs being imposed, and you're having to fight a pretty large short forward book, which you are running down. All of that put together, along with INR valuation, if you look at it from a real effective exchange rate that is inflation adjusted basis against your trading partners, it was quite expensive at the beginning of this year or around this time last year, after you had held the rupee almost in a very, very low ball range. So you are adjusting in terms of valuation on the currency. Ultimately, the currency is reflective of prices, right? So you're adjusting in terms of valuation in the exchange rate. And it's the right time to do it because your inflation, in any case, was running at near 0%. I mean, you've 0.7% inflation now. You're likely going to go up to about 1.5% inflation in December. So if you wanted to make a currency adjustment, this is an opportune time because the inflation pass-through from weaker exchange rates is going to be pretty manageable for the macroeconomy.
Fair enough. Fair enough. That's exactly what the chief economic advisor said, that this is the best time to let the currency adjust because it's not going to impact inflation. But the reason why I asked you about US tariffs not being a major deal is that there is a general feeling in the stock markets that if the US deal is signed, then the rupee will not be under pressure. Now we can't hope that because, I mean, can we say that? That in case, say, the US deal is signed in a month or two, does that really remove the pressure from the rupee?
So the short...
Shantanu, let Shantanu finish that, yeah.
The short forward book position doesn't go away whether or not you sign the US.
But the short forward book can be rolled over, isn't it? I mean, we've seen RBI do this in the past.
It depends a little bit on the size. So if you central banks may not feel comfortable at $70 or $80 billion of short forward, may feel more comfortable rolling over at $40 or $50 billion of short forward. But what goes away once the deal is signed is the uncertainty that you have on likely private capex, also the MSME sector. It's a surprise that we have seen on the textiles and the gems and jewelry front. But at the same time, you would have seen some fiscal ammunition being directed towards those sectors, right, in terms of credit guarantees and so forth. So yeah, I mean, it's still a headwind for the economy. And once that is lifted, you will likely have slightly better growth and slightly lower current account purely from the export front.
Okay. Madhi, let me put that question to you. My own sense is that from the way the rupee reacted to or did not react to the very good trade numbers, my sense is that capital flows are not coming, and it is unrelated to the tariff. The capital flows are not coming because our corporate growth story is not good enough. Our earnings growth story is not good enough. So even if the deal is signed, will capital flows, I mean, will the FPI flows come unless they see earnings growth?
So Lata, see, trade is always a relative play, right? As I said that while we have been resilient, Asia has actually done better. Their exports are actually booming, which is led by tech exports. And Asia currencies have also done very well, despite the fact that, they also have been imposed with certain tariff. Clearly, we have a penal tariff on us. It's but natural that we will have some implication versus our peers. So we will be differentiated when it comes to, market positioning. As you rightly said, it's no longer a problem of current account, but a problem of capital account, which also has some sense of, I think it's more a positional play as well. It's not just, the sentimental aspect or expectation aspect that, we'll continue to weaken. I think it's more a positioning play, especially for the month of November and December, where most FPI actually tend to, close, leave emerging markets. So maybe to that extent, India has been disproportionately hit, and clearly so because we are also facing a much higher penal tariff. Once the penal tariff is probably gone, we'll have to see the quality of the trade deal that we actually end up signing with the US. The contour of the deal will be very important. My sense is that at best, you're probably going to just get rid of the penal tariff, and you'll still be, at best placed in line with the emerging market peers, which doesn't give you any kind of a big leg up versus them in terms of competitiveness. So that would remain a problem. But at least to some extent, that would take away the uncertainty with regard to India being, very worse off compared to peers, or, a position in a way that, we will end up getting the massive hit as far as the trade dynamics are concerned.
Fair
but I don't think that would be the deal to seal the
I'm
rupee.
being told I'm out of time, so I'll have to quickly wind this up. Shantanu, what is your sense about the rupee itself? Where does the decline end? I mean, is it at some... when you speak to FPIs, what do they tell you? It looks like unless the FPI flows turn positive, the rupee is going to be under pressure. What is it you're picking up from FPIs, one, and what is your own forecast for the currency?
Well, from investors, what we are hearing is that they're looking for a catalyst to play India going into 2026. It still remains a strong growth story, and at least tariffs would be one of the headwinds. It may not be the only one, but at least one of the headwinds for the growth story. Look, our sense is that as you head into the next quarter, your current account suddenly will shrink from almost 3% of GDP in this quarter towards near zero. So just the dollar demand will just be so much lower than what you faced in this quarter or even in the previous quarter. So we think you peak out at around $91 plus minus a rupee or so.
Okay.
91 rupee to the dollar plus minus one.
Got it. Madhvi, just your number. I'm sorry, out of time. What's your forecast?
So I'm in line with Shantanu. I also believe that probably you're going to be toppish around 91. Next quarter is going to be healthy as far as the current account is concerned, and most likely you will see new inflows to emerging markets where India will also benefit at least to some extent, and that could lead to some pressure being off the rupee, and we may even see positive news with regard to trade deal, even if it's not a great trade deal.
Sorry. I only
getting rid of our
time for one
so I think 91 would be what I would also look at, and most likely a range around 89.50 to 91 type.
Okay. Sorry, out of time. I had to rush too many things. Thank you very much, Shantanu and Madhvi. The important point Shantanu is making is that next quarter we will be in a current account surplus, and therefore, the demand for dollars itself will go away, and we should see the rupee, recovering or at least stabilizing. But the big problem is that FPI and FDIs are still pulling out. When will that stop? That's the question to which we're not getting answers. Wrap up on Bazaar on that note. Chartbusters up next.
we start to trade right now, we have the Nifty, which is down by 111 points below that 25,600 mark, closer to 25,900. The broader market bleeds too. The rupee hits a fresh all-time low, crossing 91 to a dollar.
FMCG stocks hold up as the sole sectorial gainer. Britannia too gains as it appoints the new CEO for its dairy business.
Fertilizer stocks, they surge following the finance minister's comments stating that demand for fertilizers remains strong and that the government must provide funds for any additional requirement.
Motilal Oswal issues a buy rating on Arvind Fashions with a target price of 725 rupees a share. The stock is the big outperformer from the broader markets, up close to 4%.
Another one which is an outperformer is DMart, up 2.5% after CLSA issues a high conviction outperform rating with a target of 6,300 rupees a share, expecting strong free cash flow going ahead.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as we can see, the market currently trading in the red. We're still defending the 25,900 odd mark, Mangalam. But individual stocks are doing a thing of their own.
Individual stocks are doing a thing of their own, Nigel. You goaded me the last time I wore this and you said that it's not matching the market.
Yeah.
Turns out that it's matching the market.
Today's market.
If it does happen that way, then maybe one day we'll wear a green shirt as well and see whether it matches or not.
Shoes.
Well, be that as it may, a lot of individual stocks buzzing around. None bigger than Meesho. What a big move that we're seeing on that stock. And the other side, on the other side, we're also seeing a bunch of these, brokerage notes impacting movements. We've seen moves coming in on names like Arvind Fashion as well as DMart. We'll watch out for a few other stocks as well as we speak. We do have, Astral, which is taken a bit of an up move right now. Varun Beverages is the other one which is seeing some bit of an up move. Remember, Varun Beverages seasonally, this is not a very strong quarter for them for their India business. But a couple of years ago, they went ahead and acquired business in Africa, which deseasonalizes a lot of their business. So, which makes this quarter look extremely good as well. But we have the insurance stocks on our radar. We'll probably try and get Yash shortly on that as well, because Insurance Laws Amendment Bill, which received the Union Cabinet's nod on Friday, will be introduced in the Lok Sabha today. It allows 100% FDI in the sector and other key amendments as well. We'll go across to Yash Jain in just a bit on account of that. But before we do that, let's talk about new listing. We have magnet winding wire manufacturer KSH International's 710 crore rupee IPO, which is open for subscription. All right, we will have to wait for Yash, I'm told. But we'll try and get Yash. What we'll actually do is just take a short break, come back, we focus on the Insurance Amendment Bill, and we get chatting with the management of KSH, the IPO that hits the bourses right now. Take that break, come back.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. It's down about 120 points for the Nifty. The mid-caps down by about two-thirds of a percent. The Nifty Bank down by about 0.5% as well. But the big story is the Insurance Amendment Bill. And as we speak about that, it has been tabled. What are the key proposals? What the outlook for the sector is and what the impact it could have on individual stocks as well as the sector at large. We do have Yash with us in the studio. Yash.
Well, Mangalam, it's been a 4 years wait, right? After it was first introduced, the amendments, and finally getting tabled today. And multiple changes came through in those 4 years. Finally, some very big reforms being tabled in front of the parliament today. I'll first take our viewers through those key reforms which have been tabled in front of the parliament. The first and the biggest decision, 100% FDI allowance as far as insurance sector is concerned, and this would be done through an automatic route, which means no regulatory approval will be required, no government approval will be required for a foreign entity, which could include foreign portfolio investors, to have a 100% owned insurance unit in the country. As far as the details under this are concerned, they'll be very crucial. What kind of board seats are given to Indian origin people? The second one, the Insurance Amendment Bill to allow merger of insurance companies into non-insurance companies. This has been a very controversial issue, specifically with respect to one company, the listed one, Max Financial Services, which has been trying, for the purpose of simplification of corporate structure, to merge Max Life Insurance Company, which is the unlisted life insurance unit, into the listed entity, which is Max Financial Services. But so far, Section 35 of the Insurance Act wasn't allowing that, and now it has been allowed as far as that merger itself is concerned. So big positive for Max Financial Services here. The third one, open architecture for individual agents. That particular element has been dropped, which means essentially agents won't be allowed to tie up with more than one life insurance company, one general and one health insurance company. They will continue to operate only with one of each category of businesses. We
will take that on board, Yash, but we do have a guest with us as well. Amit Jingran, who is from SBI Life, joins us. It's a big CNBC TV18 exclusive. So, Mr. Jingran, your first thoughts on the Insurance Amendment Bill. What are the positives? What could have been better, according to you?
So the 100% FDI was the most anticipated thing, as the Honorable FM had already covered it in her budget speech. This will attract long-term capital to the country and also lead to technical upgradation, more innovation. And looking at the penetration level in India and the insurance density, I am sure that this will open up market further and will be good for the customer segment as a whole.
Mr. Jigran, I want to come to you with a point which was closest to SBI Life out of all the amendments which have been tabled, and that was the whole idea on open architecture for individual agents. 28% of your new business premium comes through individual agents, and there was a risk that if these agents are allowed to tie up with more life insurance companies, there could be a risk of higher cost for you or losing out on business. That seems to have been averted. That seems to have been dropped. How big of a relief do you think would this be for business? What could have been the risk if this would have come through?
So all the provisions of Insurance Acts are as dear to us as an industry player. And regarding open architecture in agency, I will say that this step will create more number of people to take agency and will increase the employment potential for everybody.
Okay, 28% is where it currently stands as contribution to your company. Do you think now with this overhang being averted, do you think the share of individual agents in your new business premium would go higher? Because that generally entails a lower cost as compared to banca. Do you think that could now go higher as you would focus more on individual agents?
So we have been trying to improve our agency contribution to total business mix for last 2 years, and we have seen positive movement in this product mix in last 2 years also. And I'm sure that this focus of company for improvement in distribution mix will continue in coming years.
Okay, one question, Mr. Jingran, as far as composite insurance license is concerned, that has not come through. Of course, this was a revolutionary move, it would have come through, but doesn't seem to find a place. Where do you stand on this argument? Is it positive? Is it negative? Do you think this could have increased penetration and we've missed a chance here? The government has missed a chance to introduce composite insurance license?
As a company, as a subsidiary company of a bigger group, which also has a general insurance subsidiary, this particular thing was not on our radar. So as a company, it doesn't affect us at all.
Okay. Mr. Jingran, there have been various steps which have been taken to bring new players in. Of course, the biggest one is 100% FDI with new large players coming in. The net worth requirements have been reduced to bring smaller and niche players into the industry as well. I mean, considering the largest private life insurance company with a large market share, do you think somewhere 4 years, 5 years down the line, it could create, more intense competition in the industry for a player who's been commanding a leading position and could lead to, some sort of loss of market share for you as well?
As I said in my opening remarks, the kind of insurance penetration that we have in India and the insurance density that there is, the pie is so big that more number of players coming in will further open up market. As you yourself said, there may be players who will like to cater to niche segment and all. And I am sure that expanding market will definitely be good for the industry as a whole.
Mr. Jingran, one more point as far as investment regulations are concerned. Authority has been given empowering the regulator. How? I will tell you. For life insurance companies, about 50% has been allotted when it comes to central government and state and central government securities. And the balance 50% of investment, the authority has been given to IRDAI, which could make the regulations. Now, in all scenarios, one could imagine that insurance companies might ask for higher investment allowance when it comes to an asset class like equity to increase the returns for their policyholders. How big of a positive could this be for a company like SBI Life? And how could the investment scenario change with this change coming through?
There are there are so many areas where the IRDAI has been given more power, and we will be studying the provisions in detail in coming time and will interact with the regulator for on all of these things.
Mr. Jingran, just one final question as I let you go. There is one important provision which the government tables, and that is giving IRDAI the powers to cap commissions, to cap remuneration and to cap rewards. One more adjoining thing with this thing is that insurance companies will have to submit details of expenses of management. How important would this be from a transparency point of view? Giving, furnishing details, everything how an insurance company spends, every little detail about it.
The regulator, IRDA, was already looking into the expenses of management, and the regulation about this had been changed around a couple of years back. I am sure that this step will bring more transparency and will create a better regulatory environment for orderly growth of the industry.
Thank you, Mr. Jingran, for that very important conversation. Mangalam and Nigel, it's back to you.
Thank you. Right, thanks a lot, Yash, for taking us through with that conversation as well. We'll obviously keep playing bits of this important conversation, the big CNBC-TV18 exclusive. The first time we got SBI Life immediately as we got what is likely to be on, the bill that will be tabled today, the Insurance Amendment Bill. So that is CNBC-TV18 for you. Big, exclusive and always in depth. We'll take a short break, come back and get you KSH International 710 crore rupee IPO that is open for subscription. Rajesh Hegre, the Managing Director, joins in on the other side.
Fly Emirates, fly better.
Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, as promised, let's focus on magnet winding wire manufacturer KSH International. Their 710 crore rupee issue opens up for subscription. The IPO, has two variables. One is the fresh issue of around 420 crores and the offer for sale of around 290 crores. We're joined by Mr. Higde, the managing director at KSK International, who joins us on the show. Hi, sir. Good morning and welcome to the stock market. All the best with regard to the IPO, and we look forward to interacting with you. Now, one of the prime reasons that you're raising this money, the fresh issue, is to repay some debt. So give us a few details. What would the debt number look like? Post this issue, are you repaying everything? And what would the interest savings be? So we could get that out of the way first.
Okay. So in terms of the debt journey, what I wanted to tell you is that we had raised about 176 crores of long-term debt about 2 years ago for this new project which we are setting up in Supa. And this 420 crores of primary that we are raising, 225 crores of debt we would be repaying. This is both long-term as well as short-term. And overall, as of October, we had about 520 crores of total debt. And that would be reduced to by about 226 crores.
Got it.
And overall, the debt equity ratio would, eventually be about 0.83.
So your debt, basically debt comes down to around 300 crores ballpark, right?
Yeah, approximately.
And approximately that would be an interest saving of around 22 to 25 crores?
Yeah, you could say that. Also.
That's important because, your quarterly profit is about 22 to 25 crores. If you adjust that for tax...
I would say it would, on a yearly basis, it would bring down the interest by maybe about 15 to 17 crores.
15 to 17 crores, and that obviously aids your profit by about 10 to 12% as well. Importantly, I wanted to know a couple of things. Leading up to IPOs, companies do phenomenal revenue growth. They show margin expansions, and you've done both of that. 30% plus revenue CAGR from the time you've been reporting for the IPO. 1,000 crores has turned into about 1,900 crores. The first quarter this year, you've done about 560 crores on the top line. And all of this with sharp expansion in the margins as well. 4.7% turned into about 7%. The question is, this is great up to the IPO. Post that, how sustainable is this 30% revenue growth? And at what levels do margins peak out?
Yeah. So just so that you understand our business, actually, we are basically, the right way to look at this business is on a unit economics basis. That is EBITDA per ton. Because, one of our key components of our cost is actually copper. And copper, we are in a B2B business and a make-to-order business. And in our business, copper is generally a pass-through for us, 100% pass-through. So what happens is, some years copper could go up or some years copper could go down. But as we focus on the value addition. And if you look at the EBITDA per ton, on a unit economics basis, then over the last 3 years, if you see, there has been a significant expansion of the EBITDA per ton. And going forward, we feel that this EBITDA per ton, where we are at currently, that is sustainable because of the increase in capacity that we have done. Of the 30,000 tons of additional capacity that we are adding, 12,000 tons is already operational as of 1st of October. Right. And the balance 18,000 will come over the next, by Q4 of FY27.
Just to get that EBITDA per ton, sir, out of the way, how much is it?
So as of the June quarter, it's about 65,000 rupees, per metric ton.
Okay, 65,000 rupees per metric ton. And if you could give us a difference between domestic as well as exports, because I can see your exports percentage has gradually been coming down. So in terms of profitability, is there a variance over there?
Exports are generally more profitable than local.
Okay.
But if you see, historically, we've maintained about 30 to 40% of export versus local mix. Oh. And we've always maintained a 20, even if you see our number today, it's about a 20% CAGR in terms of export volume. The, last year or the last 2 years, we shifted our focus more to the local market to focus on the higher margin 765 kV transformer segments and, some of the higher margin segments and higher value added segments. And, we didn't want to leave the Indian market, but the endeavor is, of course, going forward, we would look at, maintaining between 30 to 40% in terms of exports.
All right, 30 to 40% in terms of exports. Just a quick couple of questions. One, your current overall capacity is what, including the capex that there is?
So currently, as of 1st of October, it's about 41,000 and 41,000 metric tons. Yeah.
Because what we're trying to understand is what could your peak EBITDA be at around 65,000? It's close to around 270 crores. That would be a fair estimate, right?
Yeah, a little bit less than that, I think. Yeah.
But can you go to 100% in a business like yours? Or
no, it's normally about 80-85% is a more sustainable capacity.
So that makes it about 230-240 crores in terms of an EBITDA. And the reason why it matters is because you are offered at an implied market cap of close to around 2,600 crores, add a little bit of net debt as well. So you would roughly be around 10.5 times EV to EBITDA on a forward basis. So that's just to clear the air on the valuation bit. Just a final bit that we want to know from you, working capital days, because of the export prevalence, it's around 72 to 80. Is there any scope for improvement there, or is it likely to stay this way?
No, we are working on certain improvements, because as we scale up, then we would look at reducing the payables day actually with our current copper suppliers, and that would definitely bring down the overall working capital days.
To what?
Our endeavor is, of course, to bring it down, by about 10 to 12 days, on an overall basis.
Well, it's been a pleasure talking to you, sir. You've given us a fair idea about the business. Wishing you all the best. And we are at CNBC-TV18 will be looking to speak to you on the date of listing as well. All the best and have a good day ahead.
Thank you for having me. Thanks.
All right. On that note, though, we'll wrap up on this edition of Chartbusters. Mangalam's won red. The market's in the red. Let's see if the fortunes change, because Mangalam stays on TH, but I move out. Stay tuned. The team of Trading Hour comes up next.
Good morning. You're watching us here on Trading Hour on CNBC-TV18. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Horma Svetakia and Ritu Singh, as always, joins in from Bangalore as well. It's not a particularly good day if you are a bull. Yesterday, we saw recovery from the lows at around 25,904, ended above that 26,000 mark as well. There wasn't a big gash on Wall Street overnight, but this morning the market opened lower, and from lower levels, it went further lower, currently below that 25,900 mark as well, slightly below that, so below yesterday's low. The only important level to watch out for on the way down now would be closer to 25,800, where the 50-day moving average comes in. The Nifty fails to cross that 20-day moving average and close above that for the second day in a row. So that's something that we will monitor as we go ahead. Individual stocks as well, broader markets, 2 stocks declining for every stock which is advancing. But despite that, a couple of these names are doing well, and they belong to the erstwhile safe haven securities. So we have FMCG, consumption, doing well. We have a couple of these retailers doing well. And we do have a few of these new players, the likes of Meesho, seeing a big spike. So Meesho is up over 75% now from its issue price. So there is some safe haven buying right now. The market, as we wind down towards the year, is seeing some bit of a sell-off. Hi, Ritu.
Hi, Mangalam. It seems the markets and your wardrobe are perfectly in sync today, continuing with another day of losses. As you were saying, Nifty now down about 124 points from the day. Sensex, about 441 points. So that rough patch for the market, it continues. The market breadth, not much of an improvement. In fact, some worse things since morning. The ratio is 1:1.86 advances to decline ratio. So you have about 1,800 stocks declining on the NSE compared to about 971 that are advancing. All of the major indices are in the red. The FMCG pack is the sole fighter there in the green, still holding on to a bit of a gain in trade here today. So cautious setup, Hormas, but good morning. It's over to you for the specific names that are buzzing in trade today.
Good morning, Ritu. And as you mentioned, the screen does not paint a pretty picture as we wind down on the year. But there are specific stocks in the broader markets that are still holding on to their gains. And a common theme among the names today are the fact that they have been smashed all through the year. And Exicom Telesystems is one such name. It's the 4th straight day of gains for the stock. It's up around 12% today. And it's up 18% in the last 4 trading sessions. It has gained in 5 out of the last 6. Even in today's session, we have had close to 20 lakh shares that have been traded already compared to a 20-day average of just under 2 lakh shares. And the stock is now nearing its 50-day moving average at 128.5. And then you go to the 100 DMA, which is at 138. But the July 2024 peak that the stock had made, well over 500 rupees, the stock is down 76% from those levels. Fertilizer stocks are doing well for themselves today. Fact is one such name. Of course, bear in mind that Fact does not have enough float in the market. It's still the 3rd straight day of gains. The stock is up 7%, is up 12% during these 3 trading sessions. Today's volumes, the highest in 4 months and counting. Here too, close to 20 lakh shares have been traded. The 20-day average is just 23,000 shares. So that explains the very little free float. The stock has moved above its 50 and its 200-day moving average on the upside. And the 100 DMA now comes up at levels of 921. The stock down 8% so far. There's recovering some of those losses, but it might just turn out to be the first negative year that Fact has after 2019. And lastly, Tata Tele, we spoke about this stock last week as well. The stock is now up 10% in today's session. So after that big up move, the stock had a 4-day losing streak, and now it has gained. The stock had gained 18% as we spoke last week. 2.5 crore shares already traded. The 20-day average is just around 26 lakh shares, and the stock is now exactly at its 50-day moving average, which is at 53.6. Now, the positive returns that the stock has had in the month of December comes after 6 months of consecutive losses, and still down 30% so far for the year. And this is turning out to be the 4th straight year of negative returns for the stock.
Right, Ormas, thanks a lot for that. So a bunch of stocks which are moving around right now, but Supreme Industries, that's recovered to the high point. We have Astral as well. So a couple of these pipe players doing extremely well. And we've also seen some traction in a few names that come from the broader market, cash market names in particular. Nava, for instance, has recovered from the lows, decent volumes backing that one. And Thyrocare, that's the one that should come up for you. It's a big move that we're seeing on Thyrocare, from lows up around 4.5%, currently sitting with a gain of about 3.5% at the high point. Take a short break, come back, focus on the commodity space, bond market with Manisha Gupta on the other side.
You want to talk business? Meet me in the On-Board Lounge.
India Bonds presents Bond Street.
Welcome back. Still 130 points lower on the index. Still fighting tooth and nail are the bulls to defend the 25,900 mark. But the bigger talking point is the currency. Another record low, 90.91 against the dollar is where the rupee has declined to. We'll get to that in just a bit. But shifting focus to the bond markets now, Manisha is here with all the latest from that space. Manisha.
Thank you for that, Armas. Well, absolutely. The bonds also are taking cues from the Indian rupee, and the way the rupee seems to be declining is quite heavy on the markets right now. So this is the worst year that we're looking at in sense of the currency since 2022. It has been about portfolio outflows, delay in trade deal between the US and India, and the markets believe that the lower RBI intervention is yet another thing to blame, because we are looking at a very sharp decline coming in for the currency, and we've been telling you that it perhaps is the worst performing currency in Asia when you look at this current year. A very, very sharp decline coming in for the currency. The bond markets also reacting to this. Well, the central banks' debt purchase is one thing that the street is watching out for. And the other thing has been about the foreign investors' activity that the street will keep an eye on. If you look at the 10-year benchmark, well, we have seen it gain quite strongly, the yields that is, the most in last 4 months in the previous week itself. But the bonds also have seen a bit of a decline because you have seen that heavy selling pressure come in from foreign buyers. It also has been a sharp spike that we've seen in overnight index swap rates that have led to offshore paying interest there. When you look at the overall markets, well, the central bank's upcoming bond purchases is something that is in focus. The traders do expect that the yield will continue to be between 6.5 to 6.65 there. Well, it is the previous week, that is, then when RBI really bought quite strongly into the markets at around $500 billion at higher than expected cutoff prices in the previous week also. Well, there has been selling that we've seen come in from portfolio buyers, the portfolio investors ahead of the year end into the foreign markets there. So when you look at the overall number there, the year-end selling pressure that you have seen clearly seems to be the case. In the first fortnight of December, we've seen net sales from foreign investors at 54 billion, while the foreign banks in the same time period have sold something like 30 billion as well.
Address Rupee.
Manisha, thank you for that update there. And speaking of the currency, it's the new low that the rupee has now made 1991 against the US dollar and continuing to make fresh lows. This is despite the fact that India's November trade deficit had declined sharply, primarily because the exports grew very strongly by 19%. Now, exports to the US, in fact, have also increased. Lata is now here for her editor's take on the fall in the currency today. Lata.
Yes, another day, another low for the rupee. It now looks like it is importers who are panicking. That's what dealers tell us. The scene from the Reserve Bank appears to be let it find its own level. They are apparently in the market, but not really trying to protect any level. But the importers finding that, the rupee is going well into the 91 area are panicking, and we are seeing, at least dealers say, that they are coming and buying in a hurry. They were not prepared for a level above 90 to the dollar, simply because for so many years now the average fall, depreciation of the rupee versus the dollar has been 3%. And now it is 3% since mid-November itself, which clearly importers were not prepared for. And that's why you're seeing this, elevated rise in purchases of dollars. The other important point is that although we have got a very small trade deficit, monthly trade deficit in November, that is in the current account. In the capital account, we are continuing to see huge outflows day after day. It is anything between a 1,500 crore to a 4,000 crore sell by FPIs. Big, organizations like Prudential and earlier LG, Hyundai, all of them wanting to exit. So FDI and FPI are exiting. The fact that there is a narrow trade deficit is not mattering to the market because these people are exerting pressure. You must note that in a day like today, when trade data is good, the dollar index has fallen, crude is at $60. In spite of it, the market is not taking any encouragement. There are no positives for the rupee long guys, simply because, there is no support. There is no two views in the market. There is no supply of dollars. It is this FPI, relentless FPI selling that is countering all these positives for the FX market.
Right, Lata, thanks a lot for that. But, what is this reluctance of the RBI for it to let it fall the way it is? I mean, at some point, it would have perhaps come in,
I think that's what they tried earlier.
Okay.
And it didn't work. I mean, if the pressure of FPI selling is so huge, $17 billion and counting, as far as only FPI exit is concerned. And now even the bond guys are selling. Bonds were 8 billion positive in this year to date. But last few days, we have seen them also selling because the currency is not helping. Every day they see their profits evaporating. So that group has also started selling. Now, if you come and try, you can't really bet against the market. You have to ensure that the FPIs find Indian markets attractive. There is no other way to solve this problem. Why would you want to let them get out at a better rate? Let them pay the market rate when they are leaving. Beyond a point, no central bank can stand against the force of the market. They can do it for a day or two. Yeah. They can do it for a week, perhaps. But you can't literally
reverse it. They just want to soften
reverse, when kind of the world is against you.
All right, we have Ritu with us as well. Ritu, you have a point?
Well, Lata. Well, yes, actually, Mangalam, we have Dheeraj Nim, who is an economist and, FX strategist at ANZ Research joining in now. So, Lata, we'll thank you. But Dheeraj, very quickly, rupee, new day, new low, 990 and, falling swiftly towards 91. the trade deficit numbers were better than many expected, and even then the rupee doesn't seem to be finding any support. What are the immediate triggers, and what is the near-term target that you have?
Thank you. Thank you for inviting me. Look, I think it's more of the same story these days. Nothing much perhaps has changed in the overall risk matrix that the Indian economy is facing as long as the U.S. tariffs remain. And what we have seen in the last few weeks is a lot of surge in importer hedging demand because of these one-sided expectations on the exchange rate. And that perhaps is still playing out. So after yesterday's trade deficit number, I do think, however, there is some scope to heave a sigh of relief, because not only the trade deficit was better than expected, but even if you seasonally adjust it, it was even lower at about $22 billion, perhaps reflecting that the risk is not as large as we had made it out to be. Of course, we will need a few more months of data to confirm that. But I do think that, the current momentum can sustain a bit because the market expectations are one-sided. We, in fact, have our, USD INR forecast at 91.5 by the end of next fiscal, which would appear much sooner in the market. But there is, of course, some leeway here for the central bank as long as dollar remains weak and, the trade deficit numbers have improved a bit, that some of these pressures can abate. But we'll have to, of course, watch out for the next few sessions.
And what are the immediate triggers then in that case that you'll watch out for? I mean, this trade deal, we're still awaiting to hear more on that front. The deficit numbers don't seem to be helping much. RBI seems to have had a hands-off approach, perhaps, for the exporters to also benefit in light of what's happening around us. So what are the immediate triggers when you say this 90.5 we may get to before the end of the fiscal itself?
Look, I believe that there is no specific event trigger apart from the U.S. trade deal, which we don't know when it will happen. But I think at these levels, we should become a little careful about the RBI's intervention, which so far had been a bit hands-off. They're letting the rupee sort of play out to the market forces, only smoothening the slide. But if the broader economic complex is pointing to risks not being as large as market is imagining, then it may happen that the RBI could intervene a little more strongly to sort of manage expectations around the exchange rate. Look, it has not let the rupee have a free run, in terms of depreciation. I mean, it's still controlling the slide, but letting the market forces play out. But if the economy so warrants, or the evolving configuration of the economy so warrants, they may come in at some level, perhaps around in the 91.5 range, to sort of signal that they may not be comfortable for the rupee to depreciate even more. So I think we should watch out for some strong-handed intervention from the RBI, especially relative to the recent few weeks where they have been a bit hands-off.
Okay. Two-part question, Dheeraj. Do you think that when we get to the Jan-Feb-March quarter, where we clearly post a trade surplus, usually, in several years in the past, and now the way in which the November exports have trended 20% higher, if we get a surplus in March, in the March quarter, do you think the rupee automatically will find a floor because the demand from importers is less?
I do think, Lata, that could be a possibility, but here's a two-part story again. So we have the financial account story and the current account story. Let's be honest, the current account story has worsened a bit, but it's not become unmanageable, so to speak. I mean, the pressures from the current account perspective, even over November, were not particularly sharp when you go by the aggregate trade data. So I think what will happen in the financial account is also very important, which is where I think that if at all the central bank gets a little uncomfortable around the levels at which the rupee is trading despite improved trade numbers, there could be a bit of an intervention which could be slightly stronger than what we have seen in the recent past.
Is anyone, Dheeraj, talking about a policy intervention? Do you think we have to come to terms with the fact that FPIs are not entering and maybe make it attractive to them by removing withholding tax or any tax on them? They often complain that this is the only country which taxes their gains.
Well, to be honest, I haven't heard any chatter about taxation sort of relaxation for foreign investors. At this moment, we're all treating these outflows as hot money outflows. Of course, they have persisted for a bit longer than we would have liked, but we're hoping that at some point India's strong economic fundamentals will come back into play, especially when the clarity over U.S. trade deal emerges. The sentiment can reverse dramatically. So I think that hope is still very much alive.
All right, we take that point. Dheeraj, thank you so much for that. Thank you, Lata, for
I don't think it's hot money. It's prudential going. I mean, they've been here for 2 decades.
Let's see how that goes, Lata. We'll monitor this, and let's see whether if it falls a little too much, does the hot money come back and stems that fall or not, even if Prudential is going for now? Take a short break. Come back. We will get you a special discussion on IPOs. In fact, all that we've lined up on the show today invariably somehow comes back to money. How is that? IPOs, if foreigners are selling, then maybe that could impact the flows out there. And at the same time, if FPIs are buying into those IPOs, that could negate that. And the second part, after that, we will discuss hospitality, because the foreign tourists so far haven't come in the numbers that we expected them to. Whether they come back or not, and whether that gives us some foreign currency or not as well, is something we'll be tracking. Take that break, come back. Pranav Haldia joins in.
Welcome back. You're watching Trading Hour. Now we'll shift focus to the primary markets where it's been a record IPO year. About 102 issuances so far, raising about 1.75 lakh crores, surpassing the highs of the previous few years. We have Pranav Haldia, MD of Prime Database, joining us now to decode some of that primary market action. Pranav, welcome to the show. Thanks for your time here. Just looking at some of the data you provided us from Prime Database, in 2025, the OFS has crossed about 1.1 lakh crores versus the fresh issuance of 64,000 odd crores. Should investors be worried that, the promoters and these PE funds are selling more than companies are investing? And is there any clear correlation you see in your data, between these lower OFS heavy IPOs and better post-listing stock performances?
Good morning and thank you for having me. Yes, it's been a record year, and before I get into the OFS bit, I would like to say that this is actually the first time in India's IPO history that you've had two back-to-back all-time high years. Traditionally, you've always seen that all-time high year is succeeded by a couple of years of relative calm, but you've had record fundraising in 2024 and now again in 2025. Now, coming to your question about OFS, of course, that's something which has, structurally changed in the Indian IPO market over the last 30, 40 years. Just looking at the data, if I look at the data of 24-year period from 1989 till 2012, during that time, just 13% of the amount was actually raised through off of sale. While over the last 13 years, since 2013, 68% has been raised as offer for sale. So it's been a big change. A couple of points which I'd like to make. One is that, fresh capital being raised is not particularly or necessarily a good thing. This period which I spoke of from 1989 till 2012, where a lot of fresh capital was raised, most of those companies either shut shop as their business models did not work or vanished. So what you used to see back in the day was, companies used to come to the IPO market much earlier in their life cycle to raise the risk capital or the growth capital. What has structurally changed in the Indian capital market over the last 10, 15 years is that risk capital is now being provided by angel investors, venture capital, private equity, and only companies which are able to reach a certain scale, a certain size, establish some governance mechanisms, come to the IPO market. So in my view, this is a sign of a maturing capital market ecosystem. This is also very akin to what you see in the Western markets, where typically by the time the company comes out with an IPO, the founder is left with single digit of holding. We should also acknowledge that these VC investors do need to get an exit, because only if they are able to return money to their investors will they be able to raise the next set of funds to invest in the next set of growing companies in India.
No, we take that point entirely, Pranav. It makes entire sense to not look at IPOs, whether they're good or bad, whether it's a fresh issue or it's an offer for sale. That point well taken. The question here is that if it's an offer for sale, typically it's about the value that is left on the table. If a company comes much earlier in its growth journey, the riskier capital, there is a lot of growth ahead of them, and as a result of which higher valuations the street would have liked because they were novel businesses. But now the VCs and PEs are investing in these companies at extremely high valuations, juicing most the value out, and thereafter, in a way, so to say, dumping that paper on public at a much higher valuation for their returns, when growth or most of growth is perhaps behind the company. So it's the quality factor as against, whether the paper comes from the promoter, the PE investor, or whether it goes back into the company for growth. So that's something that is, a bigger function of how returns are. So I wanted to ask you on that itself, on the database that you have, how many of these issues that have come by have done well on listing day, 6 months from listing day, and 1 year from listing day? Do you have any data on that?
Yes. So, to answer your first part, market is all about risk and reward. So surely we can have, companies coming at an earlier stage to the public market, but then we should remember that, that would, result basically be more risky investments as well as far as retail investors are concerned. And that is what you saw in the past as well. Now, coming to the data, I'm not a big proponent of doing this post-analysis, whether 6 months or 1 month later or 1 year later or 2 years later, because I do believe that after a company gets listed, its share price will go up and down on the basis of its own performance, how the sector is doing, how the economy is doing. Nevertheless, we did do some analysis, and we looked at some data from 2015 onwards, which is the last 11 odd years. And actually, it was startling. The findings were extremely surprising that out of the 103 pure OFS IPOs which have come, they delivered an average of 351% return, while the 81 pure fresh capital IPOs delivered half, or 173%. So actually, even from a return point of view, and in fact, I often give this example of India's largest IPO, which happened last year, of Hyundai, which was a complete OFS and has given a good double-digit return. Yes.
Well, Pranav, sorry to cut you short. We have a lot more questions, but we have some breaking news coming in, so we'll have to thank you for now. The rupee, it has crossed the 91 mark now. If 90 was a sentimental level, 91 is going to rattle people on the street. It's a new low. We started the day with about 90.80, and now swiftly the rupee has moved to 90.91. That is the level to take note of. Not much has changed in the broader market as far as the sentiment is concerned. The continued FPI selling has weighed on the rupee. The fact that the US trade deal, is taking longer than perhaps was expected, that continues to weigh negatively on the sentiments. It's not helped by the fact that we had a better than expected, trade data coming in. So taking all of that into account, some of the experts we were just speaking to expected the rupee to touch this level, in the next few weeks. But we've already seen this 91 level being crossed. The RBI at least has been, more or less hands-off, not really coming in to supply dollars in huge amounts, the likes of what we'd seen perhaps last year. So there is a gradual fall that RBI has allowed, and now we have the rupee at 91. And so we're going to wait by for some reactions on, what this means. We're trying to reach out to some of the experts. In the meantime, just take a look at the rupee, down by more than 5% this year. Easily the worst performing Asian currency in the market. But, as we wait by for more reactions on that, we're going to slip into a short break. But don't go anywhere. We'll be back in just a moment to take this forward.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back here with the Trading Hour, and we've been talking about the rupee, which has now breached a fresh record low 91 against the greenback. And we have Navneet Damani, the head of commodity and currency research at Motilal Oswal Financial Services, joining in now. Navneet, thanks very much for being here. You know, this 91 mark, a new psychological level. Do you see some consolidation here, or do you think this could trigger, some further momentum? And what are you immediately hearing from traders? Is there some panic buying from importers that's triggering this fall?
Well, 89 was a psychological level which was not surpassed for a very long time. But ever since that's breached, a panic selling has been set in, and we are seeing depreciation every alternate day in the rupee. Primarily, exporters have been very active in the market and have been covering to a very large extent in anticipation that probably there might be a peak around 91, 92 levels. In anticipation to that, trade deal has been a major laggard, which has been adding to the depreciation at this point in time. Until we hear a positive buzz from the government as far as trade deal is concerned, or probably some intervention, massive intervention from the RBI, then the slide is likely to continue. And technically speaking, it's headed towards 91.5, 92 levels before we take a break.
91.5 and 92, that would be fairly scary. I mean, 91 isn't any less scary either. Navneet, I just wanted one, clarity. How are the volumes right now? Is it falling more on lower volumes, or is it volume back? Because towards the end, the impact cost increases as well as volumes thin out across the world.
Well, I wouldn't say the volume is very consistent. It's been ad hoc on alternate days and alternate time frame. As and when we approach a new level, we see massive amount of volume come in. But through the day, the volumes are not as robust as it was around 87, 88 levels.
Navneet, generally the depreciation in the rupee is coinciding with a strength in the dollar. In this case, that's not the case, right? Because the dollar is struggling. It's still, sub 99. It's almost at 98 now, the dollar index. So what other external factors, barring the trade deal, is contributing to this? And if you mentioned that 92 is where you take a break, does that spark an intervention from the RBI, which has so far remained absent?
Well, dollar and rupee have not been in sync ever since start of 2025. We saw dollar appreciating, or dollar index falling from 107 levels to 96 and then appreciating back towards 100. But pretty much around that level, the rupee was consolidating between 80 to 83 levels. They did not react to it. Ever since the dollar started to go flat and probably rebound from 100 to in the range of 98, we are seeing a depreciation in the rupee. Largely, the driving factor at this point in is the trade deal and the capital flight, which we're seeing in the equity markets. To top it up, the Japanese bond yield has been rising. US bond yields are upwards of 4%, and the differential between both the countries is something that is kind of having upper hand on the rupee at this point in time. Well, RBI will come to intervene or not is somebody's guess. They were pretty active in the market between 88 and 89, but ever since that, we've not seen a massive intervention from the RBI. And 92 is a level where I think we see that some bit of exuberance or some bit of depreciation might take a pause. We've done an analysis of the last 40 years where rupee tends to depreciate by say 12% on average in every 4-year bracket. And since 2023 to now, we are depreciating by about 9.5-10% as we speak. So another 1.5-2% is still on cards. It happens by end of the year or maybe start of 2026. We'll have to wait and watch.
Navneet, just very briefly, the RBI's $5 billion forex swap, immediately in the spot market, do you think that could have any very, very short-term trigger?
That is already in the price. That has been announced about a week or so ago, and that is already built in the price. And the forex reserve is something that we have to wait and watch for, because they have not burnt much of forex reserves. We were around 702 at peak, and as of last week we were around 686. So this typically indicates that RBI actively is not intervening in the forex market at this point in time, because if that happens, then forex reserves go down very drastically and very rapidly. So we'll have to wait and watch. The Fed or the swap that you're talking about is already built in the price.
All right, we leave it at that. Navneet, thanks very much for your time here. We have to take a short break, but don't go anywhere. A discussion on the hospitality sector when we return.
Fly Emirates, fly better.
Well, as we move towards the end of this year, an interesting set of things that we'll be watching out for the hospitality sector in particular. On the one hand, rupee being so, weak as against dollars, international holidays perhaps for a lot of them out of the way. Do they celebrate in India itself? Second part, there are more weddings in the second half this year than there were same time last year. So will that help the a MICE business of all these hospitality companies? And finally, we have this emerging group of affordable premium hotels which have come in as well. Would that be the next leg of growth coming in for all these companies? Well, we have an interesting discussion lined up. Nikhil Sharma of Radisson Hotels joins in, and alongside that we have Chandar K. Balji, the Managing Director at Royal Orchid as well. Nikhil, thank you so much for joining in. Mr. Balji, thank you for joining in as well. The first obvious question, the industry did near double-digit growth in the first half of this year. There were a lot of disruptions. The second half, analysts are penciling in what, 15% plus growth and a higher EBITDA growth as well. Does that continue despite the disruptions with Indigo?
This disruption with Indigo is just a temporary phenomena. And I think we are used to in the industry some disruption or the other. Like the first quarter, there was this war which is going on. Then second quarter, there was this rain, disruption by rain. So we have to get used to all this, and carry on business regardless of this various disruption. We don't know what is in store in the future, but I think there's nothing like COVID which is happening, hopefully, and so we are prepared for all that.
Nikhil?
Hello, firstly, thanks for having me. Despite headwinds in Q2, Q3, 2025 has closed and will close at a strong and healthy. Let me just put that in first. It's been led by rate and not by occupancy. What do I mean by that? We've seen ADR go up by 10 to 12% in peak months. RevPARs up in low teens. And demand, like you said, was driven by corporate, MICE, weddings, and if I can say festive leisure, because November was a month without any festival, and it gave us a clear base. And the last piece is that you're seeing India's growth in tier 2, tier 3, tier 4 markets away from the metros. So really the demand base has broadened.
Well, Nikhil, your target for the next year is to get to about 150 operating hotels. But how confident are you about maintaining pricing power as the supply expands, especially in the non-metro markets? Are you seeing greater competition on room rates?
Let me just say a little that there may be some micro markets that may see stress, but let's just take Bangalore as a micro. Consider Bangalore and Mr. Palji's base there. I think it's a bellwether market. It's seen a 20 to 23% increase this year over last year. We see corporate tech and MICE driven growing further in that market. And for 2026, I see even the micro markets within Bangalore growing at least a 6 to 7%. And if we talk about non-metros, you will see similar growth patterns, including leisure, whether it's Jaipur, Goa, or Udaipur. They are now stable and growing at a great pace.
Right. Mr. Balji, I'm curious to know how the opening of the Navi Mumbai airport would impact pricing in hotels which are closer to the erstwhile, airport in Mumbai, T1, T2, phasing closure of T1 thereafter, and the lack of supply of hotels around Navi Mumbai. What's the opening pipeline out there? Because you recently opened a premium property next to T2, Iconica.
Yes, I think, see, in a large market like Bombay, if you open another airport, like in Delhi also, one Jaipur airport is opening, the whole market dynamics does not shift because it takes years. And so I don't think, yes, while that is definitely a market to be in, and we are looking at, exploring possibilities of something in Navi Mumbai airport also. But it's not that these hotels will go begging or so. And in fact, with the closure of T1, some business will go to the Navi Mumbai airport, but most of the business will come to T2. So I think we are hopeful that we'll gain out of that. And so I think, these are things which, ups and downs one has to contend with. And I think wherever, there has been apprehension that this will happen, that will happen, I think industry has defied all that. And like business, whatever said and done, business in T2 area is booming with so many hotels coming up, and already operation. Business is there. So it's a very, very stable market because all those companies are not going to shift to Navi Mumbai.
Mr. Balji, I was also wondering, earlier when people used to travel, a big factor was affordability. Right now, with the growing aspirational class, or maybe even say the generation belonging to our age, they are willing to pay that slightly extra premium for the kind of experience. They need to have a proper experience. They may want to pay maybe 5,000, 10,000 rupees extra, but is that mid-tier premium segment becoming a new normal for the aspirational class, and that might end up becoming a bigger segment of the pie going forward?
It is, definitely. See, what's happened is youngsters, first of all, in India, connectivity has become fantastic. Whether Indigo or any other airline, it's very easy, and rates are still very affordable. Driving distances, roads have become excellent. Like the other day, I was traveling from Jaipur to Delhi. It took me 3 hours. So it is very, very accessible. And youngsters today, at a drop of a hat with social media, you always want to also fear of missing out. So if somebody's gone for a holiday somewhere, you definitely want to do that also. So I think this whole overall boom with Gen Z, taking over, I think the whole thing. And then, with COVID coming up, they say live for the day, don't save for the next few years. Whatever you earn, spend it up, enjoy it. You don't know whether the next day will come or not. So I think the whole psychology of the country, and there's a general euphoria in our country, whatever said and done, with the increased population, spending population, and the growth rate in our country that we...
Yes, Mr. Balji, macros are fairly well taken care of right now. We know there is an underlying tailwind. Nikhil, just a final question to you before we leave. Two trends emerging. One, the extreme premium luxury, that's doing extremely well. Boutique hotels, very high ARRs, high ADRs, very difficult to get bookings as well. And the second part is, we spoke with Puneet Chatwal. He said the gingerization of the hotel industry, where there is this... emerging class coming in. They want about 250, 300 ginger hotels coming by as well. The next $1 billion for the hospitality industry, which one comes first? The gingerization or the ultra premium one?
Well, Mangalam, globally, mid-scale, upscale, and upper upscale are pride hospitality. It's not too different from the country, and I think we are at that position in the market where you'll see mid-scale, upscale, and upper upscale coming on board. I wouldn't want to give a term to it, but really mid-scale, upscale, and upscale. And if you look at the number of signings that have happened this year, as an industry, we have signed almost 50,000 keys, just about 50,000 keys. 70% of them are non-metros. And that tells you that there is not only demand there, but it's more mid-scale, upscale, and upscale. So that's where the growth is.
Mid-scale, upscale, and upper middle scale, 70% of the new keys coming in beyond metros. Thanks a lot, Mr. Balji and Nikhil, for joining in. We'll continue this discussion as we move towards the end of this year as well, and have a little more of that on how the holiday season actually fared. With that, we're out of time on this edition of Trading Hour. Stay tuned. Halftime report comes up next.
You want to talk business? Meet me in the On-Board Lounge.
Stocks come under pressure as the rupee slips with declines far outpacing advances. Metals, IT, financials and energy are the big drags, while telecom and FMCG eke out some gains.
The rupee breaches 91 to a dollar despite a lower than expected trade deficit in the month of November as unhedged importers rush to buy dollars. A delay in concluding a trade deal with the US and continued foreign investor selling continues to be a drag.
The insurance amendment bill is set to usher in significant changes with moves to increase foreign investment to 100%, permit M&A with non-insurers, offering more investment flexibility and put the spotlight on commission and expenses and more.
NCLT is expected to pronounce its decision on Vedanta's demerger plan today. This follows the Ministry of Petroleum and Natural Gas raising objections, citing potential financial risks due to inadequate disclosures.
Hello, good afternoon. You have tuned into Halftime Report on CNBC-TV18. We're coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me are my colleagues Sonal Bhutra as well as Ekta Batra. Good afternoon, ladies. And a day again that we're seeing some bit of pressure that's coming for the markets. Nifty is down almost 150 points in the trading session, but we're following what was happening in the US as well as the Asian markets as well. This morning opened up in the red. Now, obviously, we are seeing almost a 0.6% of decline that's coming for the Nifty 50. All the sectors except for Nifty FMCG are trading in the red. Nifty Metal obviously clearly seeing a bit more of a pressure. Realty and IT are also these other sectors which are down and out in trade. Nifty IT is down almost 1% and bank, look at that. Nifty Bank is also down almost 0.7%. We're not seeing much of a support that's coming in for the markets. Advance decline ratio also clearly in the favor of declines versus advances as well. And rupee also something that is almost at the lows.
Oh yes, that is the big talking point. Definitely 91 on the rupee. It has been a one-way slide. It just took 10 trading sessions for it to go from 90 to 91, and that's something, of course, we'll continue to address and analyze with Lata, with our experts as well, and that's something impacting the markets as well.
Yes, absolutely. I think that is the overarching sentiment negative for the markets, and as you can see that in today's trading session. But besides that, the rupee has fallen around 1% just in the last 5 trading sessions. So the intensity or the velocity of the fall or the depreciation from levels of around 89 to around 91 have been swift and rapid. But let's in fact address the biggest talking point for today, which is the rupee depreciation. We have Lata joining in. She's been working the phone. She's been working the phones to find out what exactly would the next steps be. Is the RBI stepping in? Why hasn't the RBI in fact stepped in enough? Lata, over to you.
Well, the reasons for the rupee's fall are known to all of us. It is this relentless FPI selling of equities, buying dollars and remitting it out of the country. That is not, it's not a mystery. It's known to everyone. It was just that one was expecting that the Reserve Bank will come in at some point. The Reserve Bank is probably having a hands-off approach, and that is further leading to a sentiment in the market that, you can short the rupee or you will have to come and hedge. That's exactly what we have seen today as an additional reason. The fact that the FPIs are exiting and that the trade deal is not in sight are negatives that have been with us for some time. What has added is that if you look at from November 15th to today, the rupee has fallen 3%. Until now, the importers are used to the rupee falling 3% in a year. So probably until November, when the rupee fall was about 2.5%, they were reconciled that this is what we normally see. This accelerated fall in the last 3 to 4 weeks, has got them napping. And you're seeing today, at least several bankers telling us that importers are buying big time. So there is the FPI buying of dollars. In addition to it, there is some serious buying of dollars by importers as well. And at no point in time are we seeing any big support from the Reserve Bank. They're providing some sales. In fact, today there is the buy-sell swap as well, which they're doing, unrelated to dollar. That is more to provide liquidity to the market. They're not supporting the rupee with any seriousness or any level intent. And that's why you're continuing to see this fall in the rupee. No one has a level because all levels they say have been taken.
But what can RBI do, Lata? Is there anything that the market is watching out for? You're saying they're not doing anything yet, but is there something that can do?
No, the first step, of course, is to provide a load of dollars at a level and pretend that I am, send out the message that I'm not going to allow beyond 91 or some such, a cascading sale. Usually central bankers desist from doing that because you will only be giving the FPIs a more lucrative exit. So, you want to see if there is serious, like for instance, Prudential, they will move out at any price because they are divesting. So when there is serious intent of leaving, the Reserve Bank doesn't come in the way and provide a lucrative, profitable exit to someone who is wanting to exit. But when they feel that it has reached the level of speculation, they will come in. When it reaches the level where it is starting to hurt Indian growth, like, people are not investing because we don't know what is the level. If there is a sense of instability, then they will come in. There are bigger, weapons they have during the taper tantrum time, and before that, during the nuclear testing time, they issued the Resurgent India bonds, the Millennium India bonds, which gave NRIs a very attractive interest rate. And so dollars came in. Clearly, the government doesn't think we have reached that level of having to come with a policy support or change taxation for FPIs. At the moment, they pay withholding tax. You remove that. There are umpteen arrows in their quiver. But at the moment, the Reserve Bank and the government, and in fact, the chief economic advisor even said it, the fall in the rupee will mean expensive imports. It will mean a rise in inflation, something we can take because our inflation is at 0.25% or 0.7%, the last number we saw. And crude is at $60. I mean, even if you multiply it by 90, it's not a very big deal. All of last year, you had $85 and you multiplied it by 85. So at the moment, the arithmetic is still not, serious as far as the macros are concerned. But at some point, when the Reserve Bank and the government jointly think that this is hurting the growth sentiment, I suspect they will come with all these arrows, depending on the seriousness.
Okay, all right, Lata. Thanks very much. Okay, we do have the Finance Minister talking in Parliament. Let's cut across.
Act 1956 and the Insurance Regulatory and Development Authority Act 1999.
Sri N.K. Premchandan.
Sir, I rise to oppose the introduction of the bill. The Sabka Bima Sabki Raksha Amendment of Insurance Laws Bills 2025.
All right, so that was the Finance Minister tabling the insurance bill. We'll do one thing. We'll take a short break on that note, but we do have an important voice coming up next. So let's get to that. An exclusive conversation with Neelkant Mishra of Axis Bank on the Indian markets in 2026. Stay tuned after a short break.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still tuned into Halftime Report. Let's go across to our special Outlook 2026 series. India had a Goldilocks 2025 with growth likely to be at 7.5% and inflation at 2%. And yet the rupee struggles and Indian stock indices were underperformers compared to US or North Asia. My colleague Lata Venkatesh caught up with Neelkanth Mishra, who's the chief economist at Axis Bank, and began by asking their FY27 growth forecast of 7.5%. Listen in to a slice of that conversation.
Yeah, so I will start with what I've been repeating, and I'm quite surprised and shocked that economists can still see a stimulus in FY26. This fiscal year. See, the way I see the Indian economy is that in FY25 you had simultaneous fiscal and monetary tightening. The fiscal tightening was explicit 80 basis points, and on top of that, there was another 50 basis points where the government collected GST compensation cess, but was retiring some off-balance sheet debt. There was 130 basis points of fiscal consolidation in FY25, the last fiscal year. And on top of that, because of the letters sent to some of the large private banks, credit growth slowed very sharply. And that itself was equivalent to more than 2% of GDP worth of monetary tightening. So if credit growth slows, obviously GDP growth will slow as well. So the economy delivered 6.5% despite significant fiscal and monetary tightening. In FY26, I think, again, I'll reiterate, I've been saying this from budget day, that the tax cuts were not a fiscal stimulus. The government was still bringing down its fiscal deficit. That is simple macroeconomics, that 4.8 going to 4.4 means that the government is a drag on incremental demand, on aggregate demand. And therefore, the economy this year, till the time that the GST cuts happened, which actually kind of neutralized some of this tightening, the economy was still facing headwinds on the fiscal side. On the monetary side, at least, the incremental headwinds faded. So it's almost like, if it's like a maybe class 3 maths, that if an aircraft is on the ground speed is 700 kilometers an hour, and there are headwinds of 250 kilometers an hour, if the headwinds fade 200 kilometers an hour, what will the aircraft fly at and on the ground? And that's exactly what has happened this year. So the growth surprise for many people was not something that was a surprise to us. We expected that as the headwinds ease, the trend growth will start showing up. FY27, the fiscal becomes even less of a drag. So this whole narrative that, the government doesn't have fiscal space has been true for the last 5 years. In fact, the pace of fiscal consolidation is now slowing. So now you have, we are forecasting 4.2, but let's see what the government throws up in the budget. So only 20 basis points versus the 40 basis points that happened in FY26. And the monetary, all the easing of conditions, the fact that there is now a firm vision or message from the central bank, I think credit growth is starting to revive. That can become a tailwind. So we can run the economy above trend for a while, and that is why we are at 7.5%.
Okay. Well, fair enough. Let me come to earnings. Time permitting, I'll get back to the macros of inflation, etc. later. But earnings has been our bugbear. Do you think we are going to get to high single digits or double digits? And what gives you that confidence?
So both macro and micro. So you have the 12-month forward earnings, which frankly is what matters. So you had a very nicely upward sloping curve, and then the last 12 months it has flatlined. Because whatever you gained from the roll forward, you gave up by the pace of cuts. So you're seeing like 3% plus cuts every quarter in index EPS. Our expectation is that as GDP growth stops disappointing, because many of these trend indicators were below what was expected in terms of momentum earlier, especially on large sectors like autos and financials. And so once this starts to revive, the pace of cuts will start to slow. And therefore, the 12-month forward earnings then resumes its upward climb. And our forecast published in the report is that the 12-month forward is likely to rise by about 14% in the calendar year, CY26. The second approach to that is to look at assumptions sector by sector. So there are 4 sectors which account for nearly 2/3 of index EPS, which is financials, IT, industrials, and energy. And in all these 4, the assumptions look reasonable. I don't want to bore you with all the details, but the gist is that the CY26, and therefore, and you're absolutely right, if the 12-month forward earnings start to climb, our weights in passive indices start to go up, our market either becomes cheaper or starts to climb, and then FII flows start coming back, and a lot of other factors then start to stabilize.
Fly Emirates, fly better.
Welcome back. Well, the rupee has fallen to a fresh low versus the dollar. This fall is despite the fact that India's November trade deficit fell sharply as compared to the record deficit that we saw in the month of October. We have with us senior forex expert K.N. Dey and Kanika Pastricha, who's the chief economic advisor at Union Bank of India, joining in. Mr. Dey as well as Kanika, thank you very much for taking the time out. Mr. Dey, I'm just going to come to you. It has been around a 5.5% depreciation that we've seen this year for the rupee, and we have depreciated much more sharply as compared to, say, the Indonesian rupiah, the Filipino peso. What is your sense in terms of what the key pain point has been for the rupee depreciation, and where do you think we're possibly going to stabilize?
Hi, good afternoon. Well, as you rightly said, the last 6 months, rupee has almost depreciated by 5.5%, and the whole year is around 6.5%. And the first villain for this rupee depreciation is it started off when our U.S. president came in from January this year. It started talking about tariffs and putting negatives in the market, confusion. When we saw a lot of FIIs selling this year, if you see from January till December, I think FII's net inflow is minus $25 billion. And they have been selling almost every month except 2 or 3 months, maybe July, August, or maybe one more month. Otherwise, in every month, the FIIs have been selling. And as of date, around 2,25,000 crore of rupees has been out from the Indian market, periodically, month-wise. That is one of the biggest negatives for the rupee, where we didn't get any inflows in the equity markets. There was some FIIs money coming in the bond market, but the whole year was something around 8 billion till last month. I believe even that sell-off is started this month also. So there is no actually negative flows. That is the biggest thing for India. Then we have this tariff coming in, and about a couple of months back, and then this penalty. And there's a lot of stories coming in the market. We are almost done with the tariff. Everything is done. We will be here or there. But still today, nothing is happening on the tariff. No. And I believe even if tomorrow U.S. reverses the tariff from 50% to even 20 or 25 or 15, whatever it is, I don't feel the rupee would correct back. Because it may be little half 1%, but not to those old levels. I think 88, 89 are history as now.
Oh.
So going forward, that's all history now for me. It looks like that. Because, again, why will RBI has been intervening? They have no fixed rate in the mind. At what rate it's depending upon the market-driven rate. We are only trying as a speed breaker to intervene and stop the speed. And today we saw a lifetime high of 0.91 point, I think, 0708. And this would continue. And being a year-end also coming in. And normally in year-end, the markets become thin as we go forward. And any thin market, any demand coming in, the volatility also goes high. So this thing will continue for some time. And maybe we could see some stability coming in from the second half of January coming here, where we might see some flows coming in, provided there are some positive things from our side.
Okay, all right. So you do not see it getting back below those 90 levels anytime soon. Kanika, Mr. Dey also mentioned what the RBI is doing. It's not a big policy change or intervention that's coming in from the RBI, right? Do you think it is done because what's your sense first up? Should RBI do something? If yes, what would they be doing? Or is it a fact that this is basically motivating more exports, helping exporters, and this is something that the RBI wants to continue?
So, first of all, thanks a lot for having me on the show. 2 weeks back, rupee was about to hit 90, and I was on the same show. Now, in just 2 weeks, we are pulling towards 91 handle. See, it's December. Liquidity is low. FPIs are selling, and as you rightly said, Ekta started the show by stating that fundamentally nothing much has changed in the last 2 weeks. In fact, we've only got a positive data from a fundamental perspective, where trade deficit has narrowed from $41.5 billion to $24.5 billion. So from that perspective, what becomes very important is that rupee fundamentally is unlikely to be at these levels. Overshooting typically happens in December. And the reason for that is low liquidity and the sentiment that's taken a downbeat because of delay in US-India trade deal. Now, last time also had stated this, on a 3-year basis, when we look at a fundamental handle on the currency, it typically depreciates by 3.5% annual average. And on a 3-year basis, that's respected. 2020 to 23, March 22 to 23, rupee depreciated by close to 9%, 3% annual average. Now from 2023 till 25 March, rupee was down by 4.5. So this year we were already forecasting rupee moving towards 89.90. Moves beyond 90 is overshooting in our view. It's in a zone where in December typically such moves happen. RBI is there, always there, compliments to them to handle volatility in the currency. Levels very difficult to predict at this juncture, but we think eventually by March, currency likely to settle back to fundamentally prudent levels, which we think is 90 or below.
Okay, you think 90 or below, maybe by March is what we'll keep an eye out on. Mr. Day, just a quick word. So you said that FAII selling, obviously a big concern coming in there, and this is not coming into the equity markets. Do you think if FII start coming back or valuations in the equity market come lower, that's when we'll see the buying coming in, and that's when the rupee will settle further?
Absolutely, because once you create a confidence, something on the FIs where they will start coming back in the equity market, obviously the rupee will go. And obviously then whatever RBI has intervened for last couple of months, they will try to recover the dollars they have sold in. And we had, I think, reserve about $704 or $5 billion a few months back, which has come down. So I personally feel I want the FIs to come back to invest in India. And once they come back, we will, I think RBI may parity the rupee as my other colleague told. Should be around 90 here or there, because we also cannot make the currency too strong enough to support our exporters. At the same time, make it not very volatile to see that it hurts it has to be balanced in a proper way. So I guess, as you said, maybe 90, around 90s, maybe somewhere there, the rupee should stabilize going forward. Hopefully, the FII starts coming back. As I said earlier also, I don't think the tariff would make a very big difference now, because most of the, except I think the textile exporters have been hit very badly, but I guess they are now readdressing their issues. So I think we need to have some positive things coming out to lure our FIIs to come back to India to put in their money as fast as possible.
Sure. Okay, Mr. Day, as well as Kanika, we've completely run out of time, but the topic does continue as the biggest topic for today's trading session, and not only today, but in the past couple of days. We need to take a short break with the news that the insurance bill has been tabled in the Lok Sabha, and the details of that is flashing on your screen in terms of what the finance minister is saying at this point in time. We'll take a short break. Manisha Gupta will join in next. She has with her David Tate of the World Gold Council. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty is down 140 points, around 25,880 levels is what the Nifty is trading at. Slight bit of a decline is what we're seeing in the last few minutes of trade as well. The broader end of the market, that also continues to be under pressure. Nifty mid-cap is down almost 0.8% in today's trading session, as well as the small cap too is trading with cuts of almost 0.7%. IT2 under pressure, and apart from that, we're seeing FMCG, that's the only one which is managing to hold on to green. A lot of individual movers today, especially we're seeing Policy Bazaar that's down and out. Ola Electric that's seeing a pressure and a fall of almost 4%. Axis Bank too seeing pressure and down almost 3 to 4% in today's trading session. We'll keep an eye out on those names as well. And apart from that, these food delivery names, Eternal, Swiggy, both of them are also under pressure. So keep an eye out on that as well. On that note, we're going to slip into a very short break. After the break, we'll come back and we'll talk more on commodities. Manisha will take us through a conversation on that.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back, and joining us on the show now is David Tate. He's CEO of World Gold Council. David, hi, thank you so much for joining in. And you are in India, and I'm hoping you're having a good time here. And when you look at the gold prices then, and they have had a stupendous year as well, the best year since 1979. How have you seen the year 2025 in sense of prices and sense of demand as well?
Well, I've been very, very happy with the price rise over the course of the last year, as you would expect, given my role. It has been somewhat spectacular, even by our estimations, I have to say. Over the course of the year, we've obviously seen continued central bank buying. We've seen all the major buyers that you would expect get involved in gold. We've had some notable events. We've had deregulation in China, which has made a big difference. We've seen a huge growth in ETFs in India, and which I expect to increase over the forthcoming years. You've had Japan has adopted gold in a major way over the course of this last year, which we expect to continue as well. I mean, quite frankly, they're suddenly discovering what inflation is after 30 years and a little bit of geopolitical risk. So I expect to see great things happen in Japan. And then, of course, the old classics, shall we say, the normal economic stuff that we've grown to know and love over the year has supported gold. Then we've got the interest rates and dollar, which have all done their part. But most importantly, we've had a never-ending burden of ever-increasing debt. So whichever way I look at it, there are a whole variety of things which are continuing, which have supported gold over 2025. And frankly, I don't see changing going into 2026 at this moment. I do think there is one scenario, though, which could change everything, but I'll leave that one for later.
No, that's coming up exactly the second question as. So what do you feel? I mean, is it safe to say that the gold prices will continue to make higher highs, because both banks and brokerages believe that we are headed towards 4,500 and 48 and 5,000, also a possibility in 2026. You're saying that there is perhaps going to be a reason that we will not see those numbers there. What is it according to you?
Well, actually, no. I have 6 or 7 main reasons why I think it will continue higher. That's probably the way I should couch it. I'm firmly of the belief that it will go higher for those 6 or 7 reasons. But I can see one situation where I think it could, people could start to view gold differently, but that's probability adjusted, very low probability. And that is if the United States, for instance, Mr. Trump, gets very lucky, manages to spur 6-7% growth in the United States with moderate inflation, and is able to project a declining sovereign debt level. At the moment, we know it's $37 trillion, and he's doing his best to force down interest rates to generate enormous amounts of growth. I think that's the game plan. And if he is able to suddenly project that in 2030, 2032, the overall debt burden of the country will start declining, that will probably give a number of people who have been convinced that buying gold is the right thing to be doing because of currency debasement, because of the threat of runaway debt burden. I think that is a scenario that could start to raise a few doubts in people's minds about the future of the gold rally. But I must stress, I think that's an incredibly low probability for him to be able to pull that off. Okay. It's the only scenario I can imagine that will probably put a dent in gold's rally. And like I said, I think there's 6 or 7 major contributors to why it's going to go higher. And some people are talking incredibly high numbers for gold, and I would not be surprised.
David, let's talk about the investment part as well. And we've spoken about ETFs, but there has been a lot of retail investment and physical investment as well that we've seen, especially in India and other parts of the world as well. This also is going to be one year when the investment is perhaps at very, very high numbers. How are you looking at retail investment going forward for the Indians? Because of the rupee depreciation, the gains are even more sweeter there. But how are you looking at overall investment globally? And second, how do you look at gold buying in sense of India as an impact?
Yes, we've seen over the world the desire to invest in gold is somewhat different from the jewelry market. The jewelry market has obviously taken a hit because of the increase in price, and that's to be expected. But that jewelry market also is very durable. It does come back once the price sidelines for a little while. And frankly, just above $4,000 it has done. And the jewelers I spoke to en masse yesterday, they were seeing relatively good pickup in their showrooms. However, it is the investment bar and coin from a physical perspective, and the ETF world that has seen the major increases over the course of the last year, and I expect to continue going into next year for the reasons that I've largely mentioned. I think most people in the world are now very, very alive to the fact that the financial situation throughout the world from a debt perspective, as I said, is threatened, and there are not many prospects of that improving anytime soon. Many of the countries, at least in the West, are suffering from almost non-existent levels of growth, and yet ever higher burdens of debt. Take the UK as an example. It cannot seem to find a way to cut its own costs. That sort of scenario to the average investor lends itself to a threat to its currency of each of these current countries. It feels like the financial situation is failing. And that is a perfect scenario for people to get involved in gold. And so investment bars and coins I expect to continue to be very well in demand globally. Okay. But I would say probably the keenest opportunity for India will be the growth of the ETF market and gold funds. Because you've got a large younger generation coming into an awful lot of money, and learning about financial markets and gold in particular as an investment asset, coming from a very low base. And the opportunity they have is to not be frightened by the idea of an exchange-traded fund, which sounds awful grand, but is essentially a very simple tool. And I do believe having access to mobile phones and their willingness to experiment will mean that you'll see a whole generation start to invest and hold gold in this form going forward.
So, well, 25 has been a great year, and 26 perhaps would see a spillover of great demand. And of course, as you said, more awareness about financialization of gold in India as well. David, as always, thank you so much for joining in and making sense of what to expect from gold in the next year too. With that, go for a very short break, come back and talk more about markets.
Welcome back. Still tuned into Halftime Report. We are consolidating at the 25,900 mark. The mid-caps are underperforming, down 0.9%. Barring FMCG, all the indices are in the red today, so continues to be a down day. We'll keep tracking the market moves for you, the rupee depreciation and a lot more. There's so much happening in the markets today, so we'll take your leave for now, but stay tuned. Business lunch is up ahead to take all the action ahead.
Stocks come under pressure as the rupee slips, with declines far outpacing the advances. Metals, IT, financials and energy are the big drags, while telecom and FMCG managed to eke out some gains.
The rupee breaches 91 to $1 despite a lower than expected trade deficit in November, as unhedged importers rush to buy dollars. A delay in concluding a trade deal with US and continued foreign investors selling continue to be a drag.
The insurance amendment bill is set to usher in significant changes, with moves to increase foreign investment to 100%, permit M&A with non-insurers, offer more investment flexibility, put the spotlight on commissions and expenses, and a lot more.
NCLT is expected to pronounce its decision on Vedanta's demerger plan today. This follows the Ministry of Petroleum and Natural Gas raising objections, citing potential financial risks due to inadequate disclosures.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Patakia, and mirroring the sentiments of the market in her own words through our outfit is Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormas. Absolutely wearing the colors of the market at this point, right? I mean, markets clearly under pressure. The mid-caps doing worse than the Sensex and Nifty. The rupee also being something key we need to watch out for, breaching that $91 mark, right?
That's been the big talking point of the morning. And of course, we need to account also for the fact that today is the weekly expiry of the Nifty contracts. So that comes with its own associated volatility. 1997 is where the rupee currently stands at. So slight recovery from the lows of the day, if you could call it that, even if you can call it a recovery to begin with. But for the index, the bulls as of now are fighting to defend the lows of the day. 25,870 is the day's low. It's still hovering around those levels for a better part of the last 60 minutes. And that has been the case for the index. The broader markets, though, are facing the pressure. The mid-cap index is at the lowest point of the day. The small-cap index, too, facing selling pressure. So 500 points down now on the mid-cap index, and the small-cap index, too, at the lowest point of the day, 0.8% lower there.
Absolutely. So clearly under pressure. Even if you take a look at that advanced decline ratio, clearly in favor of the declines. You know, all of the indices except for FMCG have been falling. Some of the top falling indices are the metal index. That's fallen over 1%. Hind Copper, SAIL, JSW Steel. If you take a look at all of them, all down over 2% right now. IT is also under pressure. All of those stocks low as well. HCLTech, Infosys, Emphasis. Take a look at them, all between 1 and 2% in the red. There's the realty names as well, seeing big cuts. Godrej, Oberoi, Prestige. All of them in the red, over 2% lower. Only respite we're seeing is in those FMCG names, and that index is about 0.25% in the green, barely in the green at this point in time. But the big trigger today, the Indian rupee falls to a fresh low versus the dollar. Let us invite Lata for her editor's take on the rupee today. Lata?
Well, it is a shock that the rupee has fallen so rapidly. The fall from November 14th, when the October trade data came, to today is a 3% fall in just a little over 3 weeks. That's a little rare. The speed of the fall from 88.5 to 90 to 91 has taken everyone by surprise. The triggers are known. It is largely the FPI selling day in and day out. It is either, 1,000 crores, 1,400 crores, or on a bad day, it goes all the way to 3,000 crores. But it is always a sell number. And that relentless selling is, the overall reason. The sentiment is again bad because the trade deal is not like round the corner. No one's speaking about it as if it's, month end or next month or something. That's also hurting sentiment. But aside from sentiment, it is this actual outflow of dollars by people selling shares, buying dollars and remitting it out. Now, importers were kind of comfortable when it was a 3% fall because it's the average depreciation the rupee faces year after year. But post this November fall, importers have been caught unprepared, unhedged. They've always been unhedged, largely unhedged. And now importers are buying in a hurry. So that's the added pressure. So you have the big FPI sellout, and now it is, not hot money selling. It's people like Prudential whose IPO ends now, and they're going to take their money. They would have perhaps already sold it in spot for all you know, because the delivery is only day after tomorrow. The pressure of sell like this is adding to adding against the rupee. The Reserve Bank is not seen defending any level, and the governor made it very clear on the monetary policy day yet again. He's walking the talk since then. perhaps the Reserve Bank's view is that as long as people are determined to go out like a Prudential, they're not going to change their mind because of a different value of the rupee. Why give them an exit at an attractive level? Let the market take its own course. So for the market, the sentiment changes that the Reserve Bank is not going to help. So it's really a one-sided market. It's now very difficult to call levels unless you actually see FPI buying of shares. We are all waiting for that day.
Very difficult to call levels, as Lata very rightly put it so. And thank you for breaking that down for us on the currency. Now, this fall in the currency is despite the fact that the trade deficit for the month of November fell sharply because exports grew very strongly by 19%. Now, exports also to the US had also increased. Now is that was supposed to be one factor, right, Lata, to ensure that the rupee doesn't slide further? The trade deficit was a concern that came in narrower than what the street was anticipating.
I agree with you. And therefore, let us count our blessings. The fall of the rupee from 88.50 started on November 14th, 15th, when we got the October trade data, which was very bad, a $41 billion deficit. So the expectation was when the November data came at a very pleasant 24.5 billion, no, hugely lower. The expectation was that the rupee will find its feet. It found its feet for all of half a day and recovered by about 10 pice. But we must not forget that the real economy is showing some very big positives, probably because the rupee has fallen. You know, what we have seen is that goods exports have risen by 20% year on year, and they are up 11% month on month, you know, November over October. Probably this is because the rupee is at a more attractive level. Our exports are selling better. Now, the key growth sectors have been electronics, which were doing well anyway. Electronics goods are up 39% year on year. And the number of 4.8 billion in a month is unprecedented. It's a new high. Gems and jewelry, which we thought will be impacted by the US tariffs in a big way, are also up 28% year on year. Either they're able to sell more to the US or they have found other markets. Textiles are struggling, but still up 7.9% year on year. Again, looks like they have found other markets. The best news from the export numbers came from marine exports, shrimp exports, which were seen badly impacted by the US tariffs. It is very clear from the data that they have found higher sales to China, and that's again added to this, you know, huge 19% rise in exports that we have seen in November. On the import side also, there's positive news. The two big items, gold and silver, are much less in November than they were in October. In fact, gold imports are at a 4-month low, silver imports at a 3-month low. Gold imports are also down year on year by 59%. The other positive, which has always continued, is services exports. That's up about 12% year on year. They've been on that position for a bit now, for many years now, growing by about 10-11% every year. And that, so if you take goods and services together, our monthly deficit outgo is only $7 billion. It's not much. It's just that it is not the trade deficit that is the problem. The problem is the financial market. The problem is the financial outgo. Nothing to do with the real economy and everything to do with the rate at which shares are priced. People are finding it attractive to sell at these levels. Hyundai found it attractive, LG found it attractive, Prudential finds it attractive, a whole lot of FPIs are finding it attractive to sell at these levels. So it's a financial issue, it's not a real economy issue.
So financial issue, not a real economy issue. Thank you so much for taking us through those details, Lata. But earlier, we also spoke to Rajiv Batra of JP Morgan for his perspective on the weakening rupee. Take a look.
The base case does not take into account a massive rupee depreciation, which has just started overall, but a much more calibrated one, which keeps you in the range of around 81, 89 to 91 or max 92 over there. That is still welcome because it also gives entry point to the new investors also who think that this is the right level. You are right at the trough in terms of an INR and you get a good entry point per se.
That was the currency, the big talking point all through the morning. Now, insurance laws, the amendment bill, which received the Union Cabinet's nod last Friday, has been introduced in the Lok Sabha today, which allows 100% FDI in the sector and a lot more. Now, the bill will be up for a discussion at 4 p.m. this evening. Yash is joining in with more on this. Yash, tell us more.
Well, the bill, of course, will come up for discussion in the Parliament at 4, but we do have the details in terms of what has been proposed of that particular bill, and some very important points coming out. The first and the most important, 100% FDI being proposed by the government in the insurance sector. If I just have to pick, does it do good, does it do bad? So it's negative for incumbent players, especially health insurance companies, because there's a possibility that new players, large players, foreign players might come in with their large capital, and the first choice is likely to be health insurance space. So that is one point. The second one is that the bill, empowers IRDAI to set limits on commission. This is a very important element which has been spoken about in the bill. This is negative for distributors in general and positive for insurance companies. The government has empowered IRDAI to set limits on commission, remuneration and rewards to insurance agents as well as intermediaries. Apart from that, the government has also said that it proposes that insurers should submit details of the expenses of management, publicly at regular intervals. The next one, IRD has been empowered to set investment regulations. This is positive for all insurance companies, but especially for life insurance companies. The government has proposed to give investment regulations to IRDAI, provided 50% of the total investment goes in government securities. This would include, of course, the central government and state government, and the balance 50% IRDAI will have the power to allow insurers to invest in the choice of their asset, of course, with the approval of IRDAI. This could be equity as well to increase the returns for insurance companies. For general insurance companies, 25% to be invested in central and state government securities. The balance, the IRDAI will have the liberty to give permission to general insurance companies to invest in different asset classes. The next one, insurance amendment bill will allow the merger of insurance companies into non-insurance companies. This is particularly positive for Max Financial Services because they've been trying to merge Max Life into them for a very long time. Of course, this is positive because this will lead to a simplification of the structure at Max Financial Services, also remove the holding company discount out of Max Financial Services. The next one is reduction in capital requirements for reinsurers to 1,000 crore as against 5,000 crore right now. This is negative for GICRE simply because capital requirements being reduced will bring more reinsurance players into the country, increasing the competition in the sector. Now, one very important element which seems to have been dropped between the consultation paper and the final bill which has been tabled is open architecture. Open architecture for individual agents would have allowed agents to tie up with more than one life, more than one general and more than one health insurance company. That seems to be taken out of the bill. Positive for LIC.
All right, Yash, many thanks for those details. But on that note, it is time for us to head into a short break. But more news and updates coming up on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. The market's firmly in the red. Nifty and Sensex 0.5% lower. The mid-cap index seeing cuts of over 550 points, all of them near the low points of the day. But moving on to the ongoing crisis at Indigo, Indian Pilots Guild, Federation of Indian Pilots, have moved the Delhi High Court seeking contempt action against DGCA for granting exemption from FDTL norms to airlines. We have Ashmit Kumar joining us for more on this. Ashmit?
Well, clearly this is a concern being raised by the Pilots Association, two of them to be particular. They've moved the Delhi High Court. What they're flagging essentially is that the FDTL norms, which is the flight downtime provisions that are there in the rules in the DGCA as a part of the CAR, that has not been complied with, and they are targeting the DGCA officials here, saying that these rules were in fact agreed upon by all the stakeholders concerned. That's the airlines, the DGCA, the regulator, the pilots. This was something that was agreed upon, that there was a prescribed timeline that had to be followed, that timeline has not been complied with, finding fault with the conduct of the DGCA, saying that now, especially in light of the recent crisis that we saw on account of Indigo, they're saying that this was a crisis of creation of Indigo itself, that this is something that should not have been permitted by the DGCA, that the exemptions that have now been provided, the extension of the timeline that has been provided to Indigo to come on board with the FDTL norms is also something that the DGCA could not have done, and that this is in contempt of earlier court orders, and that to that end seeking action with respect to DGCA officials. DGCA on its part saying that this is something that they had to do to ensure continuity of services, that they're not happy about grant of an extension, that they do have the powers to do so, but their hands were tied. They were left with no option. They had to do this going forward. But they are pushing the airlines for ensuring that there is faster compliance with the FDTL norms, and that even this extension is subject to periodic review. So clearly, DGCA is standing firm on its position. For now, the Delhi High Court agreeing to hear the pilots' concerns, issuing a notice to the DGCA, asking for a response to this contempt petition. This case, we understand, next will be heard in the month of April of next year, 2026.
Ashmit, thank you for that update there. Take a short break. More news and updates on the other side. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
No significant change in the benchmark index from where we began the show. Still 140 points down, still fighting to hold the lowest point of the day, which was 25,870. So 25,885 is where the index continues to remain. And the bigger part of the drag, though, or not ensuring that any recovery comes by, is also the US futures. The Dow futures is down 170. The Nasdaq futures are down 250. So still the concerns over AI continue to linger there. And all eyes this evening will be on the jobs report for the month of November. That will be released at 7 o'clock this evening. Take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Ekta Batra. Good afternoon, Ekta. Well, we continue to consolidate at the 25,900 mark. Second consecutive day of selling for our own markets as well. Midcaps, they are underperforming, and advanced decline ratio absolutely in favor of declines today.
Hi Sonal, yes absolutely. Actually the texture of the market is not looking good at all. We have the Nifty which is below 26,000 as we speak at the low point of the day. For the mid-cap index also it's lost around 1% and there's a clear underperformance which is coming through in terms of the broader markets. And as you can see, the advanced decline ratio is on the declining side, significantly on the declining side at this point in time. But nonetheless, let's take you through all of the top stories that we're tracking and we'll get to all of the discussions that we have lined up as well. Stocks come under pressure as the rupee slips with the declines outpacing advances. Metals, IT, financials and energy are big drags while telecom and consumer durables eke out some gains.
The rupee breaches 91 to a dollar despite lower than expected trade deficit in November as a delay in concluding a trade deal with US and continued foreign investor selling continue to be a drag.
Motilal Oswal issues a buy rating on Arvind Fashions with a target of 725 rupees per share. The stock price is 3%.
All right, those are top headlines that we are tracking. The move in the rupee and in the mid-cap segment continues to be on our radar. The small caps too are seeing a big fall today, 1% lower on that one. And the rupee has been steady at the 25,890 mark since the time we started our trade. FMCG though is a bright spot today, Ekta. That one is in the green as we speak.
Yes, absolutely. The FMCG stocks are managing to hold up a little bit in today's trading session. Maybe some amount of buying coming through. Tata Consumer Products, for example, is up around 1% at this point. Trent is not doing too badly. Asian Paints, so a couple of these consumer plays seem to be standing out at this point. But let's get to Hormuz. This is our mid-cap movers segment. We're going to kick off the show with that. We have Hormuz to take us through all of the broader market stocks which are buzzing around in today's trade. Hormuz.
It does not look good for either the Nifty or the broader markets for that matter, and you're seeing selling across the board, barring the FMCG stocks, of course. Even they too have come off slightly from the highs of the day. But you start off with some of the losers in the broader markets and you would see that there is no particular segment that is seeing those kind of losses. Man Industries is down 5.5%. Stallion India, one of the best performing IPOs of the year, continues to witness some profit booking. Embassy Developments too down 5% in today's session. Metals as a segment has been sulking. They did fairly well last week, but they are now witnessing some profit booking at higher levels, be it SAIL, NMDC, JSPL, all of them seeing losses of anywhere between 2 to 3% in today's trading session. It is also not good going for a lot of the QSR names, and all of these three names on the list here, be it Jubilant Foods, be it Devyani or be it Sapphire Foods, all of them are trading at a 52-week low in today's trading session. Losses of anywhere between 1.5% to 3.5%. Stocks that are bucking the trend, if you would call it that, on strong volumes as well. Praj was up yesterday, up today as well. Kirloskar Oils doing well. 5-Star Business Finance doing well. All of them have come off the highs of the day, but somehow managing to hold on to those gains on significant volumes. And a pocket that has been bucking the trend all through the morning has been the fertilizer names. The fact does not have enough free float in the market, but still up 5%. Chambal Fertilizers is doing well for itself, and RCF has come off slightly from the highs, still holding on to gains of 1.5%.
All right, take that point. Some of those stocks in the green in an otherwise weak market. Thank you so much, Hormuz, for joining us with all those details. Let's now welcome Shrikant Chauhan from Kotak Securities for a technical check. Shrikant, good afternoon. Thank you so much for joining in. What do you make of the moves that we are seeing on the market today? Any important levels that we should be watching out for?
Good afternoon, Ekta. Good afternoon, Sonal. For Nifty, it has remained stable for the last 3 hours. It is not crossing the level of 25,900. There, if we see, the open interest is increasing heavily. And on the downside, 25,850 is going to act as major support, as there also we are seeing good amount of put writing. So broadly, I am of the view that till the market is not crossing 25,925 during the day, we can expect range bound sort of activity, and maybe the market may close around 25,900 only. But if it manages to cross the level of 25,925, then we can expect furthermore short covering, and may the market close around 26,000 sort of levels. But today it's a day of event. A lot of things are going to come in the US markets, I mean to say, on the data side. And because of that, maybe the market is remaining in the range. But ideal pattern is clearly indicating us that at important levels, the market is finding support. And whenever there is slight improvement in the market, we are seeing upward activity. So broadly, I am bullish on the market, and strategy should be to buy on dips.
Okay, strategy should be buy on dips. But just Shrikant wanted to understand that I'm sure you're getting a lot of queries from your clients about the rupee depreciation and, how exactly could you probably play the markets on account of that, or maybe that, how exactly should you probably approach the markets in the context of this rapid rupee depreciation that we've seen. So just give us a sense in terms of what you're recommending and advising.
See, for the time being, we are consistently keeping a close watch on the overall performance of the rupee. But the way it is depreciating, it is little bit concerning. It has crossed all its important level. I'm going to say it is falling on a regular basis. And now the next level to watch out for would be maybe 91.50, 92. Ideally, we are asking our clients to look for adding those particular companies which are more defensive, like FMCG, pharma, or even we can say IT companies. For the time being, we are not keeping any specific view on the overall trend of the rupee. But yes, the way it has depreciated, the possibility is that it is heading little lower from current levels.
All right, Shrikant, thank you so much for joining in with your thoughts and the market outlook as well in terms of charts. With that, we'll slip into a short break. When we come back, we'll get you a special discussion on the Insurance Amendment Bill on the other side with our experts. Stay tuned for that.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still tuned into Mid-Cap Radar on CNBC-TV18. Let's get talking about the big development which has taken place. The Insurance Laws Amendment Bill, which received the Union Cabinet's nod on Friday, has been introduced in the Lok Sabha today. This allows 100% FDI in the sector and much more. We have with us Thomas Devasya, who's the former member of non-life insurance at IRDAI, and Nilesh Sathe, who's the former member at IRDAI, to discuss more on this. Gentlemen, thank you very much for joining in and talking to us. Mr. Sathe, I'm going to start by talking to you about the FDI in insurance, which has now been, increased to 74%. There wasn't much of a change which took place when, the limit went from 49 to 74%. But now that it's risen to 100%, what is your sense in terms of the incremental foreign inflows in terms of deals that we could expect?
No, immediately, I don't expect incremental flows so soon, because all said and done, after the Act is amended, the regulations will have to be framed by IRDA. That will take about 6 months, because 6 months is the time limit which is prescribed for IRDA to frame regulations. So within 6 months, it should be done. And only thereafter, the things will be clear. Second is when it has been increased from 49 to 74% 5 years before. During these 5 years, not many foreign insurance companies have entered the market. Actually, not much of foreign inflow in capital has come. But again, that does not mean that with 100% it will not come. Actually, it has not come for many reasons. One is Indian partner was a must earlier. With 100%, now they don't have to search for Indian partner. They can start their own business at 100% FDI. So this is one big advantage. And as a result of which, there will be many insurance companies which have operations in many jurisdictions all over the world. They may think of tapping Indian market because India is a growing economy. So they would definitely like to tap market here. Penetration is low. The scope is more, the per capita income is going up. Hence, I expect in the next 5 to 7 years, there will be sizable amount of inflow into FDI, inflow of FDI into insurance. And at least 5 to 10 insurance companies should start their operations on 100% FDI.
Okay, all right. So you will see some more interest coming in from foreign companies now that the limit has been raised to 100%. But as you pointed out, it will take around 6 months for the regulator to formulate those rules and put all of this into execution as well. Take that point. Mr. Devasya, the other big point has been the capping of commissions that has come by for platforms. Do you think this is a structural change which could impact some of the other players, platform companies, something like a PB Fintech that is listed as well? But again, this is also a business that they have around insurance, right? It'll be positive for insurers, but do you think it's a big structural negative for some of the players in the industry?
Depending on what's the business mix. Okay, but capping of commissions is very much warranted in the entire distribution system because ultimately it's a cost to the consumer. And we cannot afford to see insurance premiums rising, especially in a context of very low penetration, very low disposable incomes with regard to the retail sector or the household sector. And also for the purposes of, the concerns that we have on global competitiveness of, manufacturing sector. So limits have to come in. While limits have been, released in a manner that there was only a global limit, there was no individual policy or line of product limit. So it's necessary, it will affect, but it's overall for the health of the industry.
Okay. Well, Mr. Sathe, I just wanted to actually put that question across to you with regards to the commissions as well. What is your sense in terms of the fact that there is this capping of commissions when it comes to platform companies? And what do you think would probably be the impact, say, if you had to discuss this 6 to 12 months from here on?
Yeah, again, in this also, there will be 6 months for coming out with regulations. This is number one. Second is, it is not that in the past, there was no ceiling on what commission rate you can pay on a variety of products. It was subsumed in expense of management regulations for reasons best known to IRDA. But even at that point of time, I was of a view that that should not have been done, because the capping of commission, it ensures that nobody can exceed those limits. So why it was done, I don't know. But good, at least now there will be a capping. And probably now it may be product-wise capping, like for term insurance, it may be at 15%, 10%, whatever IRDA deems fit. Or for ULIPs, it may be 15%. For term, it may be 20%, whatever it is. But it is good that the capping will be there for commission. That will also help IRDA to check and control whether somebody is violating those. Because under any pretext or under any some different name, if at all the companies are paying to distributors something beyond what is prescribed, now that can be checked. And it is very good, because that will bring the cost also down, manufacturing cost of product also down, and it will help the customers ultimately.
Right.
So it's a good move.
Okay.
Positive move, in my opinion. To what extent the distributors may get impacted, time will tell, number one. But again, to what extent they should be given commission is also one area which was very vague in the past. Now it is good that it has been proposed.
Mr. Sathe, so it would ultimately, as you both pointed out, it would bring down the cost of product or cost of insurance down for consumers ultimately, and that will help penetrate the market a lot more, and it will be good for the consumers at the end of the day. Last question before we let you go. Mr. Devasia, I wanted to understand if you think government missed out on the opportunity of bringing composite insurance license. Do you think if that had come, it could have actually helped broaden the pie a lot more?
Oh, no, I doubt so much. See, composite insurers is basically, I believe it's more on the conceptual level, because finally there are very clear delineations with regard to how financial resources are managed, how governance happens. So composite is not so critical with regard to the expansion of the market. Yes, it will enable certain entities to have economies of scale by pulling in certain functions at a common level, while driving distribution also uniformly. But given the market that is open here, awaiting services, I believe composite insurers as such is not a game changer or something that will immediately trigger exponential growth. I believe the focus of the bill here is to address whatever is immediately required. And I can see that they have done a lot of cleanup in the legislation, including clarifying definitions with regard to intermediaries, and they've also kept open any other line of business that may be prescribed in the future. And they've created general insurance, health insurance, reinsurance, and they've added this point additionally into the amendments.
All right, gentlemen, we leave it on that note. Thanks very much for joining in and giving us all of your perspective with regards to the insurance bill. We need to actually turn our focus back to the markets, because there's a little bit of a recovery which has taken place from the day's low. The day's low, remember, stood at around 25,870. So we are 50 points off that day's low at around 25,920. So let's see whether there's any kind of formidable recovery that takes place. We'll take a short break, but up next we'll get you a lot more on the markets, a lot of stocks in focus. Stay tuned.
Fly Emirates, fly better.
Welcome back. You're still tuned in a mid-cap radar. We are above the 25,900 mark. A wee bit of recovery, but we'll see whether that sustains or not. For now, the mid-caps continue to see an underperformance, but the Nifty Auto Index, that has turned into the green. So we'll watch out for the recovery that's taking place in the markets. But we'll take your leave now. Stay tuned. A special discussion on Rupee when we return. That's the big story that we are tracking today.
Cool.
Another day, another record low. The Indian currency fell yet again today to cross the psychologically important mark of 91 rupees to the dollar. It has taken the currency only 10 days to fall from 90 to the dollar to 91 rupees to the dollar. In fact, since November 15, the rupee has fallen by nearly 3% from 88.5 to 91 to the dollar. Continued selling of Indian shares by foreign funds and buying dollars to remit them away out of the country is the chief reason. Data shows that lately foreigners are also selling out of Indian bonds. Sentiment on the rupee is also weak as a trade deal with the US remains elusive. What has taken the market by surprise is that the rupee has fallen despite the trade data released yesterday showing that exports in November actually rose by 19% year-on-year and by 11% month-on-month. The rupee is one of the worst performing currencies this year, having fallen nearly 6%, while most EM currencies have risen versus the dollar. To understand where the rupee may find support and whether special steps are needed from Reserve Bank or the government, I have with me a panel of economists and fund managers. I have economists Upasana Bharadwaj, Chief Economist at Kotak, and Sakshi Gupta, the Vice President Senior Economist at HDFC Bank. I also have Hemant Mishra, Founder and Chief Investment Officer at S-Cube Capital, Singapore, and Neeraj Seth, Founder and Chief Investment Officer at 3R Investment Management. So, fund managers and economists, thank you very much, all of you, for joining me. Let me start with you, Neeraj, as a person who would be watching this to make your investments. Doesn't it surprise you that despite good trade data, probably a shrunken trade deficit, the rupee continues to fall? Is it shocking?
I think there's some element of a surprise here, though I would highlight that if you look at the flows, they have not been supportive in the last few months. And on top of it, you also have seen an ongoing delay, in fact, some level of fatigue driven by the constant delays in the tariff situation or the trade deal. And lastly, we have change in terms of the stance of RBI with regards to the currency, which has gone away from keeping some level of not levels but more of volatility under control to more market-driven approach. And I do think it's just a combination of these factors playing out right now.
Mm-hmm. Sakshi, what have you made of the trade impact? The way in which the trade deficit has shrunk in November compared to October, do you expect a surplus, a current account surplus in the fourth quarter? Will that be the time when we may find the rupee finding its feet?
Right, Lata. So absolutely, you're correct. I mean, this data was a big surprise for us, especially the performance on the export side, right? The kind of growth that we have seen. And to me, it's surprising that even to the US, our exports are actually growing in double digits, despite the 50% tariff. So if this trend kind of continues over the next, 3 or 4 months, then we are estimating that in Q4, as it is, there is a seasonal, element which tends to move the balance of payment into surplus, which we have seen over the last couple of years. And I think even on the current account front, we could end up with a marginal, surplus.
Okay. Upasana, what's your sense? Isn't the trade data supposed to have some impact? The current account shrinking. Have you incidentally brought down your current account deficit number forecast for the year?
No, actually, Lata, we were expecting a moderation in the subsequent months on the trade deficit numbers. Obviously, the 42 billion deficit that came about was largely on account of imports from bullion. And we were expecting that moderation to come about. So we were looking at an average trade deficit to moderate towards $27 to $30 billion in the rest of the year. So I think this moderation largely, of course, has come about because silver and gold together have the imports have reduced. And at the same time, we have seen a month-on-month pickup in exports. And I think, of course, like Sakshi mentioned, we are surprised with the fact that the exports to the US are continuing. But at the same time, we should observe one more trend that is building up. And that is that our imports from the US are also increasing. So the trade surplus, which is $1 billion or so now. So that is the trend that we are observing. But yes, having said that, on on a net basis, while we are not seeing an improvement with the trade with the US, but exports have picked up as well, and that is why there's a sharper than our expectations of the November trade deficit narrowing. But I think overall we do not really expect too much of a change. We are looking at a 1.4% current account deficit for the full year, and as you mentioned before, the balance of payment hopefully will turn surplus in the subsequent quarter, and that should provide some stability in the external sector balance.
Okay. Hemant, I came to you last for a reason. If the very good trade numbers is not having an impact on the currency, and, in fact, as both the economists point out, exports to the US are growing in double digits at 11%. If that is the case, Hemant, would a trade deal also make a difference? After all, it has not affected the exports so much. So even will signing make a difference? It looks like the FPIs are anyway legging it out. And that seems to be the big reason. So basically, okay, we keep blaming the trade deal, but even if it came, will we be relieved?
Actually, Lata, my take is all three will make a difference. So one is the trade number yesterday was a big surprise. I got it wrong. I wasn't expecting it to be moderating to that extent. But I think as the previous panelist just said, the markets are still expecting a current account deficit for this quarter. And if you look at the current account deficit starting from the first quarter of this year, where you had a minor surplus, actually not minor, around 1.3%, and then you became neutral, then you became negative, and for this quarter we are looking at 1.5% to 2%. So there's been a steady deterioration there. And talking about the trade deal, I think that's the big sentiment negative. I think what it does is it takes a big overhang out of the markets. On the portfolio flows, whoever I speak to, and just last week I was on a roadshow in the Middle East, I think the expectation is Indian markets are now fairly valued. The rupee, I must confess, is now a bit of a concern. But, assuming the fundamentals turn around, and when I talk about the fundamentals, I'm primarily talking about the current account deficit number. If that stabilizes, our BOP then looks a lot more stable. Then I would expect portfolio flows to pick up. So I'm expecting a significantly different scenario in Q2 of, and when I talk Q2, I'm talking calendar year, Q2 of 2026 for both the rupee and the equity markets.
Oh God, that's quite far away. The rupee has fallen 3% in 3 weeks. If we have to wait 6 months, it looks like waiting for a very long time. Neeraj, when are you expecting any realistic stability and recovery in the rupee?
So I think it comes back to a combination of, in the near term, the flows and sentiment. And if you do get, first of all, any positive news on the trade deal, I think that is going to be a sentiment positive. And from a flow standpoint, I'm in the camp that given the levels where the equity markets are, where the INR is, that going into January, we should start seeing at least the first derivative turning, which is you shouldn't see the same level of outflows from the FPIs, and then slowly stabilizing and turning towards an inflow. Assuming you do see, obviously, improvement on the domestic side in terms of the growth in earnings. Okay. But I'm a little more optimistic going into next quarter that we should see a stabilization here.
Okay. Well, maybe now the next question to you is like asking a barber if someone needs a haircut. But do you think it's time that the Indian government actually woos FPIs? The constant complaint we get on the channel is that you are the only country which taxes us, others don't tax our capital gains. Is that a turning point, or will we get FPI flows even without it?
Well, to some extent, the FPI flows historically came despite whatever constraints existed. These constraints.
But at that time, our earnings growth was much better. Our stock market performance was much better.
I would put a slightly bigger point here, Lata. I think this is important. If the government steps back and focuses on the broader capital markets reforms, including simplification and maybe some of this reducing this tax burden on the foreign investors, and this is across debt and equities, I actually think there is a strong case for the FPIs to come back. Now, we're living in a world where there's a competition for capital, and you've seen Japan, Korea, China, a number of other countries performing well and pulling in capital from a global investment flow perspective. So if you want to fight for the capital, you've got to have a stronger playing base for that.
the best word I liked over there, debt and equity, you said. Hemant, on that point, there are now financial experts making the point that India has treated fixed income very badly. Capital gains on fixed income is your, income tax level of taxation, 30, 33. For HNIs, it would be 38, 40%. Whereas long-term capital gains on equity is only 12.5%. Asset allocation in India is based on taxes, not on risk or age or, other relevant characteristics. We have overpriced our equities by the tax skew. So change that is, this is a voice in the wilderness. It's not the majority opinion. But do you think we are overpricing our equities with our tax skew and therefore the FPIs are not coming? They're actually selling out.
I think that's a fair question, but in my view, Lata, that's part of the answer. So yes, the tax aspect generates a skew in favor of equities. And I do think it's also deliberate for it to favor equities and also for money to go back into the banking system rather than into domestic securities. And by that, I mean domestic debt securities. But I think the big opportunity for India Inc. Continues to be the offshore market. There is a dearth of dollar bonds in the global markets. And Lata, you and I have discussed this. India is one of the rare Asian countries where there's more appetite than paper that's available. And that's manifested in the very tight credit spreads that Indian companies get when they tap into the global Eurobond markets. So there is an appetite both in rupee terms and in dollar terms, and the country needs to make up its mind to monetize that. But there is a gap there currently.
Okay. Indian companies are seriously delevered now. So the question of even raising domestic paper doesn't arise. Banks like Sakshi and Upasana will tell you are lending to retail. They don't find enough corporate borrowers because corporates are, have enough money. Anyway, the important point is what levels are you looking for in the rupee at this point in time, and what steps do you want from the Reserve Bank? Those questions after the break. Welcome back. We're discussing the fall and fall of the rupee, and we've been speaking with economist Sakshi Gupta of HDFC Bank, Upasana Bharadwaj of Kotak Bank. We're also speaking with two important fund managers, Hemant Mishra of Cube Capital and Neeraj Seth of 3R Investment. Gentlemen and ladies, thank you very much for your patience. Let's just discuss what is expected of the Reserve Bank. Upasana, the Reserve Bank's hands-off approach, has that added to the fall? Would you say that's a good approach probably because the rupee depreciated, we saw the trade deficit declining beyond our wildest expectations in November? So is that a good strategy? The price is working to reduce the deficit.
Lata, one, I genuinely believe that, when natural forces are prevailing, let rupee depreciate. And it obviously in this kind of an environment when there's so much of, uncertainty with regard to tariffs, it does help you cushion the, in terms of competitiveness. So clearly allowing rupee to depreciate is something which should continue. At the moment, I don't think that it is so alarming. Yes, we are seeing decently rapid, depreciation in the currency, but I don't think we're yet in an alarming stage. Why? Because, we have an inflation environment which is fairly benign. So, till that is the situation in the next 6 to 9 months, I think RBI has the cushion to allow rupee to depreciate and manage this fundamentally manage the situation. So that is one. Secondly, obviously, we need to monitor the situation wherein RBI, it's not that they're not intervening, they are intervening in a much more, with less intensity than what they were doing earlier. And this is the right approach at this point. That's how I would consider.
No, fair point. Actually, it's just in popular narrative that the rupee fall is seen as negative. Actually, that's the best defense for Indian corporate sector in terms of, less competition from imports, cheaper way to export. In every which way, a cheaper currency is almost like a rate cut for the corporate sector. But Sakshi, there comes a point where the rapidity of the fall can be, growth diminishing. We are far away from that point, you would say. It's not hurting growth or capex intention. Nothing, you think?
Lata, I don't think, we are at the point where, we are in an episode like 2013 where there is complete panic and, runoff that we are seeing. I think that also the movement in the rupee actually reflects, kind of the tariff differential and the sentiments that are there because, we don't have a, trade deal. So from a macro perspective, I agree with Upasana that, look, it is giving you some amount of, competitive advantage. Secondly, I think from the RBI perspective, we must also remember that this is not just because, you want to build competitiveness, but there is a limit to how much you can intervene because now it has consequences for, domestic liquidity. It has consequences for the pace of transmission, cost of funds, etc. And, all these things are not going to suddenly turn favorable as we move into the beginning of 2026. I think the pressure on liquidity will just rise.
I take your point. At the moment, they have other instruments to give liquidity, which they withdraw every time they sell dollars. So I am a little surprised. Hemant, anything that the Reserve Bank can do better, or do you think the hands-off policy is the right one to follow at the current macro juncture?
So my view, Lata, there is the RBI's policy is not quite hands-off. While they might say that, I think what they mean is they're not trying to defend a particular level of the rupee. They will let the market take the rupee to a fair level, but they will not allow undue volatility. And I think that's been the philosophy all along. And as the recent IMF paper also highlighted, India's now in some ways a crawling arrangement.
Yes.
I think what concerns me is what you rightly mentioned. It's depreciated 3% in a very short period of time. It's almost linear and one way. And, as an FX market participant, that's something that I don't like. I would always want to see two-way interest. And I think that's something that the Reserve Bank of India might want to be cognizant of. But letting the rupee find a level which is aligned with the changed macro, because the fundamentals have changed, the current account deficits look a tad different from what they were, is only the right thing to do.
Okay. Fair enough. At the moment, it is not hurting the macros. though I agree with you that this singular linear fall can kind of destabilize importers. The panic can become a little self-fulfilling, which it seemed like yesterday and earlier this morning. Neeraj, the important point is at what point do FPIs turn buyers? Are they on the anvil? We saw Goldman Sachs, I think even Morgan Stanley, maybe even Jefferies, was it, who are turning positive on Indian shares. Goldman Sachs was underweight up until October, and now they've turned overweight on Indian shares. Are you seeing that inflection point in earnings? Even Q2 earnings, Nifty EPS growth was, like in mid-single digits. Are you seeing the earnings inflection and therefore FPIs come in a month, 2 months?
So first of all, I think from an earnings standpoint, the government has taken a number of actions going back to the GST cut, reforms and other things. So I do expect as we go into the next quarter, you should see a little more acceleration in the earnings side. From an FPI standpoint, in fact, one important point I would highlight, we talked about it in the past, if you do see any more of a wobble around the AI as a theme globally, and if you see the broadening of the markets from a participation standpoint, that will be positive for India because India missed that rally from a sector perspective. So I do think as you go into the next quarter, that broadening is a potential theme that will actually play out, which is good for a number of markets that haven't participated in the whole AI and AI-related thematics in 2025.
Okay. No, that's a fair point. We've all been praying for that AI trade to unwind, hoping that that will make us a little more attractive. I want 2 answers. Please keep them monosyllabic on, where you see the level of the rupee. The questions, and let me start with Sakshi. At what time, I mean, in a month, 2 months, do you see the rupee stabilizing? What is the range for the rupee for the next quarter or so? Time and range.
Right. So I would expect some stabilization in Q4, FY26, I think beginning January. And my range for the rupee would be between 90 to 92.
Upasana?
Yes, I would agree. I think next quarter should see some stabilizing, but mid-January and beyond probably, not immediately. And
level would be?
I would also say that 90 to 90.
Okay, 90 to 92.
92 and a half on the top.
Okay, got it. Hemant?
So most of the weakness is behind us, but until the trade deal gets signed, there'll be pressure. Once it gets signed, I would expect the rupee to drop below 90, 89.91.
Okay. Oh, 89.91. That's even better. Neeraj?
So I actually think it takes a little longer from here because the trade deal is first of all nowhere in clear sign of when it gets resolved. So I think rupee still has going into a year and a little bit more pressure, which means the range might be between 91 and 92 or 92.5 in the next 3 months.
Okay. So 92, 92.50 is what we can see. And if Neeraj were right, then we have to wait a little more for the rupee to stabilize. Let's see how things pan out. We have to be prepared. That's it on this special coverage of the rupee. Thank you very much, Sakshi, Upasana, Hemant and Neeraj for joining us. After a break, it'll be time for Closing Bell.
headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index down almost 1% in today's trading session. We have Hang Seng that's trading with cuts of 1% as well.
20 days, 26,031, almost unchanged from where it was as of Friday's close. The Nifty Bank 20 days, 59,292, and we're very, very around these levels. The Nifty starting about 0.25% lower. The Nifty Bank is down about 0.33%.
Environment is not conducive for a risk-on trade. We can see what's happening in the dollar environment. People are nervous this week.
This will open up market further and will be good for the customer segment as a whole.
The only important level to watch out for on the way down now would be closer to 25,800, where the 50-day moving average comes in.
Another day, another low for the rupee. It now looks like it is importers who are panicking.
Government has empowered IRDAI to set limits on commission, remuneration and rewards to insurance agents.
Continue to consolidate at the 25,900 mark. Second consecutive day of selling for our own markets as well.
Well, that is the day so far. Markets, of course, were looking better even, I think, about 10, 12, 15 minutes back. They've taken a plunge. We're down about 170 points on the Nifty, and it's tough to say whether, what is the head and what is the tail. I'm talking about the Nifty and the Rupee on the other side. But I think one feeding into the other and in a negative kind of way. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. And Nigel, of course, is joining us from the newsroom floor. Guys, good afternoon.
Hi, good afternoon, guys. I mean, I'm sure we'll spend a lot of time talking about the rupee, but for a second, I just want to look at global screens as well, including US futures. And all futures are down as of this hour in anticipation of that jobs report. And the jobs report that will come out for October is expected to show more weakness in the labor market than what we had in the September report. So watch for that. There's, in general, a lot of global caution in the markets, but then we have our own bag of woes, thanks to the currency.
Absolutely, and I think 91 passed, right?
Yeah.
When I was actually, I was in some other show, I didn't see it, and I said, I came up and I said, well, 91 plus, right? So just kind of ease through very, very quickly and almost effortlessly. So 1/3% weaker against the dollar, that is the rupee currently as we speak right now. Let's just quickly run you through what's lined up here before we go any further. So most sectors are under pressure. I don't think any sectoral index is even in the green. Bank Nifty is down 3/4, mid-cap is down about 1%. The insurance, I mean, there's the rupee, and the other big story, of course, is the insurance amendment bill in the Lok Sabha. And FDI, 100% FDI in the sector, but also IRDAI's powers enabling them to set limits on commission. Of course, I mean, some stocks aren't happy. Axis Bank is a top Nifty loser, and we'll tell you why in just a bit from now. We've got, the rupee, which is in focus. Lata will join us in a bit. And something which we will keep discussing. The jobs number, maybe we can get a preview going. I mean, we've got the headline number, which is 50,000 jobs, is addition is the consensus expectation. But maybe in terms of how the market is positioned for it in the US, that is something which we can focus on as we go on. How should you position yourself in the last hour? Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. So what, 25,850 as things stand right now. Is this, I mean, the next leg lower, which takes us back to 25,700, right? Which was the recent low.
Actually, that's the question which I've been wondering upon, whether we break 25,700 this time or we again, get back into the range. For the time being, I think the signs are neutral, so we'll just keep ourselves on hold and see if there's any kind of reversal sign from lower levels. But on the stock side, I have one buy and one sell. Gas Authority is a sell with the stop at 170.25. Look for a target of around 160 to 161 over here. And on the buying side is KEI Industries. It's having a quiet day, but yesterday's breakout candle is still positive, so it could still, move up. So buy here with a stop below 4,100 for targets of 4,250.
Much for that. Sectorally, realty and metals are the hardest hit today. Both those indices are down nearly 1.5%. Look at real estate names: Brigade 2.5%, Prestige lower by 2.5%, Anantraj reeling under pressure, that's down close to about 2%. And Eternal is another one where UBS today has come out with a note saying that there has been a loss of market share for Zomato versus Swiggy in the month of November. So Eternal's order volumes fell by 4.4% in the month of November, while Swiggy's volumes went up by 0.1%. So that's putting pressure on Eternal. But Swiggy too, of course, is weak with the rest of the market. But let's talk about the big story. That's the insurance amendment bill has been tabled in the Lok Sabha. Yash is now joining in to tell us about, the contours of what's been tabled, what's there in it, what's been left out, and the impact on stocks.
Well, that's correct. So it's been a long wait of almost 4 years for the sector for these amendments to get approved. Of course, they were tabled before the parliament today. There is a discussion at 4 p.m. today on all the amendments proposed by the government. I'll go and talk about, some of the important ones that are a part of the bill. 100% FDI in the insurance sector. FDI is being raised from the current 74% to 100% through automatic route. Of course,
right.
Interesting to...
Right. All right. Yash, coming back to you. Well, the big news that's come on the screen is NCLT has approved Vedanta's demerger plan. And this has been in the works for very, very long. So that's the only data point we got. But clearly the street likes it. Just to give you a few details, why is this important? It unlocks value for them. Every investor can play the segment that they want. Valuations as it is are fairly attractive at around 5.5 times. And the aluminium business, that's going to be the big driver from here on. So the demerger getting a thumbs up is extremely good news. We'll have to wait by to see whether or not there is anything, in terms of any kind of contours or anything. But otherwise, demerger approval is good. And Nuvama had written a note. According to them, the fair value was around 680 rupees. But the demerger, according to Nuvama's note, in November itself, it could add nearly 80 rupees odd. So the demerger getting a green signal, that's good news. We'll have to wait by to see if there are any kind of caveats. As of now, I don't have any further details. But the NCLT has approved Vedanta's demerger. And this is something that the street has been waiting by for many, many quarters. It was expected in the quarter one. Then it got shifted to quarter two. And now in quarter three, it's finally got that green signal. Explains why the stock has taken off as we speak. And for Vedanta, they are favorably placed because they have aluminium as well as silver in their portfolio. So that's, that's really the good news that's come in there. We'll wait, but I think we have got Rakesh Arora who's joining in as well. Is Rakesh with us? All right. Hi, Rakesh. Good afternoon. We have been talking about this for very, very long, Rakesh. Finally, Vedanta, well, they have got that demerger approval. We're still waiting by to see whether or not there's anything with regard to the corporate guarantee, whether there's any more caveats that have come in. But for the time being, this is a positive move. How would your first take on it?
Yeah, the market has been expecting this for a long time. So I think it is a welcome development from the stock point of view. However, I don't really think too much of value unlocking is possible because bulk of the holding company discount happens because of Hindustan Zinc, and that company is not yet getting demerged. So to that extent, there's a little bit of, but the company would now be able to probably sell off some of the assets which they don't think there's a core. So there could be a little bit of value unlocking on those assets, but overall, still, I would say neutral to positive.
Okay, neutral to positive on that. But Rakesh, the stock still trades, I think, at ballpark close to around 5.5 times the FY27 numbers. So valuations as well in favor, do you believe so? And if they have to sell one of those assets, I mean, which one could it be according to you? And if you could give a rough value, because in the past they flirted with that option of selling the silver, the steel asset, which ultimately didn't happen. So just give us some more color.
Yeah, so steel is one of those. Then there's power, which hasn't really done anything much for them. And maybe even iron ore is not really going any places given the common policies. So all these three of them are non-core, which could be on the table. So management has not really come out with any explicit guidance on it. But I think market has been anticipating this. Apart from this, others are core assets, so I don't see too much of change. My bigger worry is that when these assets were separately listed, there were issues of intercorporate deposits, etc. So, those things might come back. And number two, when you say it is 5.5 times EV/EBITDA, you need to take out the minority interest for Hindustan Zinc, which is one of the key contributors to profits.
Got it. All right. Just stay with us, Rakesh. We have Sanjay Asher as well, who's joining in. Hi, Sanjay. Good afternoon and good to see you in. Well, a quick word, sir, with regard to this demerger, getting the green signal. It's been in the works for very, very long. Do you think there could be any kind of hurdle that can come in the way, or is this the final green signal? And what's the procedure from here on, for them to go ahead with the demerger?
No, this is of course, one can implement it now, the demerger, but if there is an appeal which may be filed against the NCLT order, then obviously one will have to fight that appeal for NCLAT. Otherwise, there are all green signals for the purpose of implementing the demerger.
Okay, all right. So you're saying as of now, there's a green signal unless it is challenged. Is that correct?
That is correct. That is correct.
Okay. So what is the next procedure from here after the NCLT? What are the other approvals they are awaiting?
NCLAT. The NCLAT. If some shareholders or anybody challenges it, in which event, obviously, one will have to fight NCLAT.
Okay, all right, got that. I think, we have Mr. Ranina, not yet. We don't have Mr. Ranina as well. So then, I think in all probability, this gets the green signal. Mr. Asher, just one more word. There was that sticky issue with regard to their oil and gas assets, and they could have possibly have to provide some corporate guarantee or something. Would that be in the document? I mean, how do you see that shape up? Because that was a bit of a sticky issue.
It would be there in the scheme itself, on the provision of the corporate guarantee or any other type of guarantee.
Okay, all right. So we'll have to wait by then, in terms of on clarity on that front. Appreciate you joining in, Mr. Asher. So as of now, I think it's clear, guys. We have the green signal that's come in there for Vedanta, and it's good news because it unlocks value. It helps you, play the business of your choice. They could possibly go ahead and sell one of those businesses as well. So I think with the data points that we have, I think that's sufficient. We'll try to get the Vedanta management, to comment on this. But clearly, a good sign that's come in there for Vedanta's perspective. Thank you, Rakesh. Thank you, Mr. Asher, as well, for joining in. Well, let's get in Mehrbun Irani for a quick comment on this. Hi, Mehrbun. Good afternoon. I don't know whether or not, Vedanta is something that you have been playing in terms of the special situation. But any view on the stock at around 565? To be fair, in the last, I think, 15 trading sessions, the stock is up closer on 7 to around 8%. But this is clearly very good news.
At last it's happened, I would put it that way. I think market men were keeping their fingers crossed for quite some time. We all know that the balance sheet of the parent company is strained in some way. And possibly that demerger, maybe some sale of some asset may happen ultimately to take off that big load which many people have as far as the balance sheet of the parent company is concerned. If you ask me post-demerger, there is going to be value unlocking certainly. And if you just ask me to put a I've just put a mark on it and say as to where the stock can be. I think the combined valuation should be at least 20% higher than what it is today, as simple as that. And some of the assets which they have, let's accept it, possibly Vedanta is numero uno in certain assets which owns. Certain assets definitely are not of good quality, but there are certain assets which they have, especially in silver and aluminium, which I think ranks possibly above most other players in the particular in the industry. So I would give it a thumbs up, certainly yes. And I remember, Nigel, you had asked me this question about a year and a half, 2 years ago about Vedanta, and I said the biggest constraint for me is the bond holders of Vedanta ultimately who are trying to take the company to court. I'm referring to the parent company right now. And I think all this augurs well for the company, for the parent also. There will be value unlocking, there will be sale of some asset, and I think all things will be much, much, much clearer and better than what it was, say, a year ago, where bond holders certainly abroad were concerned about the company's longevity.
Yeah. Mehrbun, hi, good afternoon. And I was looking at a note which Nuvama put out in terms of what is that value unlocking, and you said it will be 20%. Nuvama is kind of in that same ballpark because they said that the unlocking should be to the extent of 83, 84 rupees. It's about 15, 16%, exactly what you're saying. So it's interesting. And of course, a lot of bullishness on specifically their aluminum business going forward. So got your take on Vedanta. Merabun, the other big story of the market, and we'll get Yash back in just a bit on this as well, is this insurance amendment bill, which has finally gone through. So in terms of capital, 100% FDI. Now, I don't know, does it increase competition or chances of competition? So should it be viewed as a slight negative for the listed incumbent, smaller players? Or do you see it as a positive? What are your takeaways? Insurance stocks, life, non-life, do you like anything?
No, honestly, no. I think definitely as far as reforms go, this government is going to work very fast on reforms, because even as the budget is coming, which is 45, 50 days away, I think nobody, including the media, is talking about it, because as far as fiscal constraints goes, everybody now knows about it. There's only going to be reforms, and this reform certainly is positive. But coming to competition, I think competition will certainly increase. It's nice to say that this is an industry in which the penetration is very low. It will keep on growing. This is the same thing people went on talking about the food business. So all this is fine. The business will grow, the market will grow, but the competition will intensify. There will be certain caveats here and there as far as restrictions been put to agents' commissions. So I think at the moment it is very difficult for me to state that whether it's going to be negative, but I don't think it is positive by any standard. That is the way I'm looking at it, whatever I've heard. You all are speaking about it for the last 2.5, 3 hours. So my only conclusion is I won't just go and buy into some insurance stock because of what has come, but I would be worried about competition which can come into this maybe over a slightly longer time frame.
Merabun, stay on. We want to continue focusing on insurance, but in particular PB Fintech, which is down close to about 5.5%. Yash, what has come out with respect to commissions in the bill, which challenges the business model of PB Fintech, because the street is clearly concerned about this capping of commissions or being regulated?
Well, that's correct. So on one hand, I would say that most of the things, in fact, everything that is a part of insurance amendment bill was expected, but there was this one surprise which came very early on the 4th or the 5th page of the bill itself. And that is, the government proposing to empower the insurance regulator, IRDAI, to set limits on commission. Now, this was seen and understood as a negative for distributors, including, of course, one of them being PB Fintech. Why? I'll tell you. Right now, there's a cap on expenses of management, under which there are two segments, commission and the operational expenses. The regulator is being empowered by the government to set limit on commission itself directly if it wants to, which means there's always this overhang that if the regulator feels that the commission costs are very high and the focus from the regulator, which we've been reporting, is on reducing commissions, it may have the option to put cap on commission itself directly, either along with cap on expenses of management or without it. So that's an overhang which gets built because of this particular statement in the bill itself. The second part, a supplementary statement to the same part, says that the government proposes insurers to submit details of expenses of management. So far, this wasn't happening because under expenses of management, of course, the companies would say that this is what they've spent on commission. Let's say out of 100 rupees, they've spent 70 rupees on commission, but they don't have to give a bifurcation of the balance 30 rupees in terms of how they have spent it. Here in the bill, the government is saying that give a bifurcation of how you spend that 30 rupees also, which means more accountability, more transparency, all of that being seen, difficult for the whole distribution procedure and commission procedure, and hence PB Fintech is down in trade today.
Okay, I guess we'll wait by to see the interpretation and how the clarity emerges on this. In fact, we earlier had a conversation with the SBI Life MD and CEO, Mr. Amit Jhingran, who told us that 100% FDI was most anticipated. Hear out his view on this landmark reform.
So the 100% FDI was the most anticipated thing, as the Honorable FM had already covered it in her budget speech. This will attract long-term capital to the country and also lead to technical upgradation, more innovation. And looking at the penetration level in India and the insurance density, I am sure that this will open up market further and will be good for the customer segment as a whole.
Okay, so those are the two big stories playing out today. One, obviously, the currency, the rupee, what's happening, and the other is this insurance bill that has been introduced in the parliament. By the way, the other big story to watch out for is the fall on Axis Bank, and it's quite telling. It's a 5% drawdown on Axis Bank now, and it's just a one-way slide on Axis. There's been no recovery whatsoever. It opened gap down. Now, this seems to be a result of, at least in part, a Citi note. Citi has come out with a very positive call on ICICI Bank and HDFC Bank, but they've said that the recovery in margins in Axis's case could take a while longer, and they have a neutral view on Axis. We'll get those graphics up. Yeah, there you go. So the neutral view, the target is 1285, which is not too far from where the stock is currently trading, and perhaps the wait for margin normalization gets a little longer, according to Citi.
So, I asked Gaurav, our analyst who tracks it very closely. So he said what the management had said, that if there are no rate cuts, then NIMs would have bottomed out right now. But now if there are rate cuts, then the bottoming out of NIM will take time, which is why, even the management now to Citi is saying that the bottoming out will take 2 more quarters. So in a way you can say maybe it's been delayed, but as he pointed out, it's warranted because now what's changed is the rate cut by the Reserve Bank of India. And apparently the management had said that if there is a rate cut, then NIMs will take longer to bottom out.
Fair enough. Let's ask Mehraboon. Mehraboon, does it warrant a 5% fall, or do you think there's more to this than meets the eye? Axis Bank.
I would say that Surbhi had attended the call for the last 2 quarters of Axis Bank, and there were clear indications from their side. They were not very defensive, if you ask me. Market was disappointed with the margins, but they said the margin recovery will happen. And when that margin recovery cycle is, I think, pushed back right now, I think the market, which had possibly started looking at Axis Bank favorably and had pushed up the stock price, I think it has reasons to correct. So today's possibly setback which has happened in the stock price, maybe because of a brokerage note, that could be one reason. But whenever this margin recovery timeline gets extended after the market starts believing that it will happen, it comes as a disappointment. So I would say I'm not negative on Axis Bank as such, because overall I remain positive on the banking sector, but certainly I would prefer, at the present prices, I would prefer Kotak Bank and ICICI Bank ahead of Axis Bank in the private sector segment.
Thank you, Mehraboon, for joining us today on the show. We need to slip into a very short break. The Nifty is still hovering between 25,850 to 25,900. 150 points lower on the Nifty. Sensex down 500 points. On the other side, we'll invite Deepak Shenoy of Capital Mind to talk about sectors, themes and stocks.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. The screen is red, but Hormus is now joining in. And out of the 4 stocks, I think, Hormus, that you have on your list, 3 are in the green. So which ones are bucking the trend?
You live with some optimism, don't you? And that's what is the case with a lot of these broader market names. And EPAC Durables, another bombed out name. The biggest single day gain and volumes that the stock has seen since its listing. On a day when the mid cap index is down 500, 550 points, the stock is up 15%. The top gainer on the small cap index in today's session. The third straight day of gains. Well over 2 crore shares have been traded on the stock. The 20-day average of around 5.5 lakh shares. And today's volumes now crossing the 600 crore mark. It's well over the 50% mark of its free float market cap. The stock exactly at its 50-day moving average of 299. The 100-day moving average comes up to 338, which is still some distance away. But speaking of bombed out names, the stock is down 56% from the 2025 high, which it hit in January of this year, which was 673, currently at 300 rupees. Amines and plasticizers is another name that has seen double-digit gains in today's session, 16% higher on the stock. The biggest single day gain and volumes that the stock has seen since January of this year. The third straight day of gains here as well. Well over 2 lakh shares traded, 20-day average of 3,300 shares. The 50 DMA is at 202. That's exactly where the stock is. The 100 DMA comes at 212. That's the next level to watch on the upside. And the stock is down around about 30% so far this year, turning out to be the first negative year since 2022. Ola Electric, well, another day, another low, very similar to what's happening with the currency right now. It snapped a 3-day gaining streak today. The top loser on the Nifty 500, 7% lower on the stock. Almost 4 crore shares have been traded today, 20-day average of 3 crore shares. The market cap is now hurtling down towards the 15,000 crore mark. At one point was well close to 1 lakh crore. The stock down almost 80% now from its post-listing high of 157 and well over 50% from its IPO price as well, which was 76 rupees. And lastly, Kirloskar Oil Engines, another stock that's in the green today, 7.5% higher on the stock. It's gained in 3 out of the last 4 sessions. Volumes are the highest in a month. 35 lakh shares already traded, 20-day average of 4 lakh shares. The stock has been above its key moving averages since the start of November and has sustained above those levels and has gained around 17% so far this year and turning out to be the 5th straight year of positive returns for the stock.
All right, Harmas, thanks very much for that. Deepak Shenoy is with us of Capital Mind. Deepak, good to have you with us here. I mean, that flash at the bottom of the screen, right? 90 to 91 and 10 trading sessions on the currency. That seems to be a bit of a bugbear for markets. Apart from everything else, it's become a bit of a bugbear over the last, I think 1 month or so. So just your thoughts. I mean, the general view is that, well, a lot of this is whatever had to happen, at least, more than 50, 60, 70% has gotten done already. So maybe the setup is a little cleaner. I don't know if that's wishful thinking or it'll play out like that. Sometimes it does. Where do you stand, Deepak?
So I think, Prashant, to be honest, I'm surprised that RBI has kind of changed its stance so dramatically on letting the rupee fly, but in both directions. But, the issue is that they earlier didn't allow the rupee to appreciate too much. Allowed a little bit of depreciation. Now they're allowing a lot more depreciation, and I don't think that if there is a lot of foreign inflows that come into our markets, that they will allow the rupee to appreciate a lot. I hope they do. If it's a two-way street, then it's fine because the rupee should be allowed to go in both directions. It seems surprising because with the recent data that's come in for the deficit, the current account deficit, it's just $12 billion. Relatively small for the fact that we have about $700 or $650 billion, and they did a whole bunch of dollar swaps as well to bring in dollars, or they are doing it or the process of doing it, and that would typically bring some kind of stability into the rupee dollar equation. I think some of it is just the RBI not participating at all in terms of when the dollar sales are happening, that they should be offloading dollars. They're not doing enough of it. And another part could be that some of the inflows are probably timed to only come in January, and therefore not as much inflows are happening right now. Typically, December does bring FPI inflows into India. This is one of the few times when it has not. So that's also another factor to kind of consider. I would say, I think if the rupee is allowed to appreciate when the things turn around, then rupee should go back to under 90. But at this point, it does not look like it at all. It does not look like RBI will even allow the rupee to appreciate.
For now, it's 91 on the table for the rupee. Deepak, hi, afternoon. I know you've liked LIC in the past. So share your thoughts on the insurance amendment bill, and is there a trade or an investment one can take on account of it?
So, yeah, I can't talk about specific stocks here, Riva. I think one of the problems now, of course, is that the insurance amendment bill has two things. I mean, one way it's good for insurers. The second way it's probably not so good. Insurance is one of the few areas where commissions are paid up front. I think I haven't seen the full procedure, but I think there was a considerable, there was a course to change that into a trail kind of a mechanism. That would kind of be a little negative for the distributors of insurance policies, but positive for the insurance companies because it changes some of their cash flow metrics. The downside of them would be the insurers are not interested, and that's also something that changes. But I'm not sure if I've seen most of the other elements of the amendment bill here. I only know about this one aspect, and I don't know if that is actually finally going to get passed. But I'm sorry, I don't have much more to say other than this at the moment. Was there something else that was more meaningful?
No, just wanted to get your thoughts in on the insurance bill and what stood out for you.
I think this was the one thing that I was looking forward to see how it changes. Of course, it affects us as a mutual fund company as well, because in the mutual fund world, everything is paid as trail commission. So even if a distributor brings you a customer that gives you, let's say, 100 crores, you can't pay them like a 3% upfront, saying it's for 3 years. You have to pay them that, 1% per year, and then that also on a trailing basis as time goes by. In the insurance, you can pay that pretty much upfront, which is why a lot of people who are intermediaries prefer the insurance route wherever there is a conflict between the two. That kind of changes things. Now the idea was to bring this back on to par. I don't know if that has made it to the insurance amendment bill, but I know this was being talked about. I don't know if it will be passed in its current avatar as well, but I know that this has ramifications for the insurance industry per se. The rest of the elements I'm not quite familiar with. I should probably do some more reading before I comment.
Absolutely, that point is taken, Deepak, but never feel bad. Because while, yes, as an intermediary, as a distributor, maybe it's far more lucrative to sell insurance products, but maybe it's because of some of these reasons why, as we were discussing with insurance sector players 2 days back, penetration levels of health insurance, 1% in this country. Penetration level of life insurance, less than 3% in this country. Penetration of mutual funds, far, far better. And growing at a very fast clip. So anyway, that's a longer term debate for some other time. But since we're talking financials, Deepak, what's your sense on the capital marketplace? Because tomorrow there is a SEBI board meeting and they could take up a whole bunch of reforms. I'm not sure if they say anything about F&O or not, or finally if those TER regulations get pruned or not. But we've seen a fair amount of cooling off on stockbroker stocks, on wealth manager stocks, on exchanges. I mean, something like a BSE itself. How do you find the whole space?
I think, we have to bet on the fact that the whole market will grow here. I don't think we should actually think that the earnings of the current players, including players like us, will continue to be at the same kind of percentage take rate going forward, because as markets become bigger, regulators want you to get more and more efficient in many, many ways. And maybe there will be even more TAR restrictions in the future, brokerage restrictions in the future. There will be, but there will be an active effort to say, listen, if there is so much more volume coming your way, why aren't you guys reducing prices? And if you don't do it, we will force you to do so. At some level, all regulated industries will see players say that. And we've seen this in most other places where there is regulation, whether it is telecom, DGCA or RBI and so on. So I don't think this will be particularly a place to keep retaining margins at the same level. A lot of margins in the capital market plays are at 40 to 75% ROEs. I don't think we should assume that will continue in perpetuity. Though I do believe that the volumes here will make up for it. So your ROEs may come down, but your absolute profits may grow at a much better level simply because the industry is growing strongly. I was talking to somebody recently and they said, when we were at 30 lakh crores, we were talking about how this industry will probably move to 100 lakh crores. This was about 5 years ago. The mutual fund industry was 30 lakh crores. Now it's 80 lakh crores in just a matter of 5 years. And I think it'll probably go to 150 lakh crores in the next 7 years. So I feel that we should be focusing more on players that will benefit from growth, even though there will be a crimping of margins. And this involves companies like AMCs, exchanges, the RTAs, and a lot of players that are coming in. I do expect more competition to come in here and hurt margins a little bit. But more importantly, the growth of this ecosystem is going to increase. Like you just said, a lot more players or a lot more people are now investing into mutual funds, into financial asset classes, and they're using digital techniques which allow all these players operating leverage. The exchange, if it gets double its transactions, does not have to double its costs. Its costs go up by 10%. So that operating leverage kicks in.
Yeah, absolutely. Good conversation, Deepak. Thank you very much for joining us. Good speaking with you here on CNBC-TV18 as always. Thank you. We'll take a quick break. We are back. We get you some trading ideas and, of course, the focus back on the rupee. Lata should be able to join us as well for the quick take on what she's picking up from the market. Stay tuned.
This is worth sharing.
Faster Wi-Fi on the new Emirates A350.
Welcome back. No, this session is not looking like yesterday's move at all. Yesterday, we started with a gap down, but the market then found its way back up. Today, this is decisively weak. It's lower, and there is no hint of buying at lower levels as well. In fact, the Nifty now struggling at 25,850 thereabouts. And the Bank Nifty is also down 0.7%. No respite for mid-caps either. The advance decline ratio, by the way, is quite negative today. You've got 2 stocks declining for every 1 stock that it's advancing. So, no, yesterday we could at least take heart in the fact that second half there was a recovery, there was buying at lower levels. None of that today. Nigel, what about F&O? What cues are you picking up?
Well, actually, you have an expiry-related factor, Surbhi, that's playing out, and that could explain why we're seeing a bit of a downtick. The last 20-30 points downtick is what we are seeing. On a closing basis, at the start of today, as well as mentioned, on a closing basis, you want to defend the 25,850 mark, which is where we are at, and that, incidentally, is where the lower of the day as well is at. Clearly, there is some resistance at around the 26,000 odd mark. So we look at the technical, simple daily moving averages. Well, on the downside, the 50 DMA is important, which is at around 25,750. On the upside, that 26,050 becomes a bit of a range. So, if you're looking at a level, then those 300 points are important, 50 DMA to around the 20 DMA. The problem today is the Nifty Bank, which actually has been leading the fight back. That's not able to fight back today. And the last time I checked, it was below the 20 DMA. It needs to get above that because that's really been the leader of this entire run that we have seen. Just since we're getting into weekly expiry, not highlighting too many stocks, but Bandhan Bank is an important one because yesterday I highlighted it that maybe by today it could possibly exit the F&O ban. The last time I checked, it was at around 80.25%. That's the open interest as a percentage of MWPL. It needs to end sub that 80% odd mark. So it's touch and go out there. Pretty much even Stevens, it can swing anyway, but there's a possibility that Bandhan Bank goes out of the F&O ban today, or maybe tomorrow it's due to move out. So we'll keep an eye on that one. Back to you guys.
Absolutely. Nigel, thanks very much for that. Mitesh is with us with what he'd want you to trade with regards to short-term ideas. We're down 175 points, so basically back to where we started at 230. Mitesh, what do you have?
STBT on Petronet, I think, that's a stock which is marginally showing negative signs on the indicator basis. So keep a stop at about 266.5, look for a target of around 260, and BTST on SRF with a stop at 3,003 for targets of 3,040.
PB Fintech is the big casualty today. Any thoughts there, technically?
So Prashant, I think, this was a stock which was actually doing very well. Last few days we have had some buy calls. The stock kept on getting higher, and I think has given a bit negative candlestick pattern today. Not a very good sign, but I think looking at the way its averages are placed, there is support at about 1805, and then, in the worst case scenario, 1765, 1760. So maybe it might come down to those levels. The medium-term chart isn't weak. So if it comes to about 1760, 65, would venture for a long opportunity.
Okay, all right. So that's PB and the view from Mitesh there. Mitesh, thanks very much for that. Let's go back to the rupee, right? And what's the state of play as we speak right now? New lows on the currency. Lata is here with what she's picking up. Lata, over to you.
The reason for the fall of the rupee is really capital flows. We have seen, persistent, consistent selling by FIIs of all hues. It's a 17 billion sellout year to date. And what we are now picking up is from December 4th, you would have seen the FPI data. Debt FPIs are also selling out. And this month, we have an $800 million plus, probably $850 million sell from the FPI debt owners as well. So that is the fundamental reason. One was expecting that when the trade data came, the sentiment in the market would improve. But it hasn't. It's clearly that the fact that there's, for instance, trade data, good or bad, Prudential at the end of the last day of the IPO would have sold the money it got for, spot today will be delivered day after tomorrow. So that sell would anyway happen. Therefore, we shouldn't be surprised that despite the good news on the trade data, there are some FPIs who are still on exit mode. Now, what has added to the accelerated pressure that we are seeing in the past 3 weeks is most importers were not prepared for a 90-plus situation. Therefore, they're probably mentally okay with a loss, with a depreciation of 3% annually. But more than that has taken them by surprise. And we are seeing importers hedging in a very big way. Almost every banker I spoke with said that, corporates are phoning us and asking for hedges, buying hedges or buying dollars. Likewise, even sovereign wealth funds, etc., who are in India, may not have thought of hedging all these days, but when you see a rapid fall, they also come to the market. That explains the accelerated pace that we're seeing in the last few days, but it's taken people by surprise. The only point is, why is the Reserve Bank not in? My own sense is that they want the rupee depreciation to correct the trade deficit, which apparently has worked. I mean, what is the big difference between November and October? The rupee was cheaper, and therefore perhaps exports did that much better, 10% better than in October. So that is working for the real economy. If the real economy is not hurt, but in fact helped by the rupee fall, perhaps the Reserve Bank cannot be faulted for the stance it is taking. The moment they see real economy, investment intentions, or something seriously destabilizing in the real economy, we should expect them to use some of the arrows in their quiver. But otherwise, I think at the moment it is working for them. It's not even going to increase inflation because inflation is at abysmally low levels. It seems a logically very good step to let the rupee find its own level.
Okay, Lata, thanks very much for that. So, yeah, I mean, lots of connections with what's happening to the currency. And as Lata said, maybe helping exports a little bit and reducing imports a little bit, and that showing up in the trade deficit. Capital flows, the big culprit, big problem point. Jay Bala is going to be joining in, and we'll ask him. I think he has a view on the dollar rupee as well. So we'll bring him in. And of course, stocks and more markets. 190 points lower. So I think we're at the day's low on the index as well now. Stay tuned.
Welcome back. Well, as promised, we have Jay Bala of CashTheKiosk.com who joins us on the show. Hi, Jay. Good afternoon. Markets down. What do you believe? Good time to get in?
Not yet, Nigel. I'm bullish for the medium term. I'm anticipating fresh record highs in 2026. I'm still retaining the view that I held in April 2025 that the Nifty is heading to 29,000. There's no change in that. But like I said in the last 2 weeks, and the short term could get a bit choppy. I'm anticipating the Nifty to drop to somewhere close to 25,100 to 24,400. But this is a seasonally bullish time for the markets. But that's the reason why it's a bit difficult to play this market short. So all you need to do is retain cash and hold off incremental investment for now. So once this dust settles, we can deploy cash for further bullish moves for the market.
Jay, what about stocks? Any trading ideas?
Yeah, like I said, Rima, we need to hold back cash for additional deployment for the moment. We have had picked up Kirloskar in October for CNBC. This stock has already moved 30%, and this is the only stock that looks like we can add on to it. So it's already moved 30%, like I said, from 900. It's currently about 1,200. I would anticipate the stock to take out fresh record highs past 1,450. So the stop loss for incremental addition is 1,070, but you need to be very careful in this addition. You can let go, and even the strong stock you can let go. We would like to, be a little more conservative and trail this further for record highs past, 1,450. Kirloskar Engineering Oil.
Which stocks could head lower? So I understand that you want to still hold on before going long, but are there any obvious shots in the market?
Financials might be the only place you might want to try some short here, but I suspect this is going to be a little bit difficult to play. I know we had called Bajaj Finance as a short last week, and Axis is falling very sharply today. So watch out. You have to be very selective and you have to be very quick. It's don't linger beyond just 2 to 3 days time frame. So shorting might get a bit difficult because the markets are a bit confusing. So, but the medium term is quite clear. The short term part is a bit confusing. That's the reason why it's difficult to play the market short.
Axis Bank, of course, is the big Nifty loser. In fact, just rounding up today's trading action, Jay, thank you for joining in. Axis Bank top loser, down about 5.5%. At the City Conference, Axis Bank basically saying that the NIM recovery will take some more time. So NIM hasn't bottomed out as of now. And that stock ended lower. Metals took a beating, so JSW Steel, Tata Steel under pressure. We should pull up Vedanta after it got the NCLT approval for demerger, which paves the way for value unlocking. The news came in the last 1 hour and the stock ended up close to about 4%. Eternal Swiggy under pressure as Zepto gets ready for its IPO moving forward on that front. And Eternal also seeing a downtick of nearly about 4.5–5%. Financials generally were subdued in trade, so it's not just Axis Bank, but you had softness coming through in a Bajaj Finserv, Geo Financial, Bajaj Finance, Max Healthcare, life insurance companies were also in focus on the back of the insurance bill. On the way up, not too many places to hide, but Morgan Stanley's bullish note on Bharti, where they raised the target price to above 2,400, pushed the stock up. That was a top gainer. And generally, consumption saw some buying. So consumer durables was the only sector which had a gain of close to about 0.5%. And consumption names like Titan, Tata Consumer closed up in the green.
Okay, well, that's the overall picture by the end of it. 175 points down, 25,850 is where we finally ended the session at. Very few places to hide in that sense. Real estate was down, number one losing sector, private banks following. Of course, outsized pressure from Axis today. And of course, the defense index was down as well. So pockets of losses coming through. Well, I think we're done for the day. We will say thank you for staying with us on Closing Bell. But, what we're going to do is wrap up and get you more views, of course, really on the rupee, but also the interplay between, of course, what's happening with the currency and the weakness in the equity side as well. So we've got a good lineup of voices joining us on the other side of this quick break. Stay tuned. Rupee slips to a record low, breaches the psychological 91 mark versus the USD. Continued selling of Indian stocks by foreign funds and dollar buying to remit them come as the key trigger. It has taken the currency only 10 days to fall from 90 to 91 against the USD. And the rupee with a fall of over 6% now, that is in 2025, is the worst performing among Asian currencies.
The market ends near the low point of the day. The Nifty and the Sensex fall 0.5%. Mid-cap see larger cuts. The index falls over 1%. Except FMCG, most sectoral indices end lower today.
Well, big positive coming in for Vedanta later in the trading session. And NCLT has approved the metal giant's demerger plan despite government's objection to the plea over the claims being put to risk. The stock surges 3% after the NCLT clearance came through.
Hello and welcome to this special telecast. We are discussing the fall in the rupee market and, of course, the fall in equities as well. Not a very inspiring day today. And the rupee making fresh all-time lows, racing past those levels of 91. I'm Rupee Upadhyay. With me is Prashant Nair. And it was yet another record low for the currency. The currency slipped past that psychological mark of 91 somewhere in the middle of the day today. And the fall has been very, very rapid. It has fallen from 90 to 91, Prashant, in just 10 trading sessions. This despite some of the trade numbers that came in yesterday, which were fairly encouraging. We've actually seen an 11% month-on-month increase in exports to the US as well, which is, some would say, where the problem really was with respect to our external trade. Prashant.
You know that the break, if you remember, came that Friday, right? Many Fridays back, 88.50 or so.
Yeah.
And then it just went one way, berserk. And I think the mood and everything just changed, that maybe this is a change of stance. So let's not stand in front of, I mean, the RBI is not standing in front of the currency falling. So I guess that, I mean, clear signal to the rest of the market as well in that sense.
And I suppose, I mean, when the psychological barrier of 90 broke, I think at that point, it made a lot of people sit up and take notice. But the move from 90 to 91 at a time when you expect volumes are thinning out, in the market, no fresh macro negatives, I mean, in terms of data, I guess that would have taken a lot of people by surprise.
Absolutely. And this, as we've been saying, puts rupee as one of the worst performing currencies, emerging market currencies this year, down over, actually closer to 7% now this year. So while it, just the pace, right, and this is, that's the table which tells you how far and how much we've fallen. This is 25 so far, 10, 12 days more to go, trading sessions left to go. And if you just sort of stretch the timelines and go back the last 2 decades, it took nearly 20 years for the rupee to fall from 30 to 60 against the dollar. The next major drop from 60 to 90 has taken about 12 years or so. Just, I mean, some historical context. Well, what we're going to talk about, of course, not just the rupee and where it goes from here, but also, of course, the interplay between dollar rupee and, of course, equity markets as well. What is leading what? And sometimes it is tough to say, but it is a bit of a negative feedback loop in that sense. Dheeraj Agarwal is with us of Ambit Investment Managers. Devina Mehra is with us of First Global. We have Rumki Majumdar, economist at Deloitte, and Anandya Banerjee of Kotak Securities is with us as well. Thanks all of you for being with us. So we've got equity experts, currency experts. As I was saying, tough to distinguish, what is the driver, dominant driver, equities or currencies. Who wants to go first? Dheeraj, what's your sense? As an equity man, is this equity outflows? I mean, of course, capital outflows a big reason for the currency depreciation. Just a quick starting thought from all of you. You go first, Dheeraj.
So it's a bit of a circular logic. Reminds me of my old Standard Chartered days when I learned one fine day that all the forex traders were telling their clients that the currency was depreciating because FIs were selling and the equity markets were down, and we were telling our clients that the equity markets were down because currency was under weakness. This was 2013. So it's a little bit of a chicken and egg here. I think FIs have been generally cautious to negative in India, not just in 2025, but also for some time. And the reason is maybe in the last few weeks got to do more with the currency, but it's actually that India's earnings growth has been lagging, notably US's, and now even many of the other countries like South Korea, Japan, etc., where the foreigners have been focusing. And despite strong headline GDP numbers, it's the earnings growth which attracts portfolio money. So FIs have been continuous sellers this year, $18 billion. The additional pressure on the rupee could be in the last few weeks, I think. RBI is clearly more pro-growth, more higher rupee liquidity into the system, more lower rates. And as the dictum goes, you can protect either the rates or the currency. And at this point of time, the RBI is clearly preferring a lower interest rate regime and higher rupee liquidity, and probably choosing to stay away from currency intervention. So two distinct set of events, I think, but at this point of time, they seem a little bit tied at the hip.
Anandya, as Dheeraj is blaming the rupee for the equity fall, are you blaming the equity fall for the equity outflow for the rupee weakness? I think you are. I think it's pretty much the same thing repeated, what Dheeraj started by saying.
Right, absolutely. In fact, see, there are three layers into this. One is, of course, the flows, which we have been discussing now. And the second is the sentiment, the domestic sentiment. Could be the trade deal is the kind of backdrop which is souring this sentiment. And third, the global backdrop. And the global backdrop is now getting very challenging because of the yen carry trade, unwind, the BOJ rate hike. And also, the US long-term bond yields are breaking out now above the level where they were before Fed cut rates. So I think the global environment is becoming challenging. That can put further pressure on the rupee because the outflows can increase.
Yeah, I guess that's the question, right? The tail wagging the dog or the other way around. In some sense, it's perhaps the perfect vicious circle, as they say. But Runki, let me come to you, because the funny part in all of this is that none of the macro indicators have given any reason for this kind of a precipitous fall, including the latest trade numbers. I mean, imagine with all the drama around exports to the US, trade deal, whatnot, our exports to the US are actually up 10.5% this year. Year to date, that's April to November, the latest numbers. So from a macro perspective, if there's no macro trigger, is this just purely market technicals and the flows situation?
I'm absolutely confident that there's nothing to do with the macroeconomic fundamentals. Fundamentals have been the strongest. In fact, we were looking at some of the numbers in terms of GDP, inflation, current account, fiscal deficit, and right before the budget, we were comparing for the last 10 years. This is the only time when we have seen most of the parameters actually in green, where none of the concern signs were there. So clearly, it is nothing to do with the economic fundamentals. More of the fact that there's so much of global uncertainty weighing on investors' mind. There is a possibility of uncertainty in the US, which might actually have an impact on flights towards safer haven. And that is also kind of impacting money flowing out from emerging countries, and India being one of them. The other issue is India was expected to have the US deal as soon as possible, which is not yet there. We will soon get it, but it's still weighing on the minds. But to be fair, I think even though FIIs are flowing out, it's like 15-year level high outflows that India has ever seen. So clearly that's an impact. But the domestic participation is still very strong. And look at the volatility we have seen in FII, and that has probably been outweighed by the domestic participation and the mutual fund participation. So that is a positive news. That tells you that there is still confidence within India and its own fundamentals.
So in that sense, if this is nothing to do with macroeconomic fundamentals, it's the market excesses, it's the worry about the trade deal, sentiment, flows, etc. Fundamentally, where should the rupee be? Back at 89?
There's a possibility, but very rarely has a currency appreciated back so much. So, and RBI is also not intervening. So most likely it will probably stay around, but I think a further fall will sentimentally have an impact on FII outflows. So somewhere I think RBI will have to take a call and decidedly step in to contain the fall.
Yeah. So we'll see if there's any change in stance with respect to how the central bank is looking at it. Devina, let's bring you into the conversation. Now, from an FPI perspective, if I was a foreign investor, I mean, first I have to get returns. And let's say corporate earnings at least deliver 12-13% finally this year. Then I have to pay long-term capital gains at 12.5%. Then there is 6-7% currency depreciation. So it's a real question for FPIs, isn't it?
Yeah, and India has been very poorly performing, relatively speaking, market this year. But before I come to that, I mean, up to the conversation up to now, two things have been missed out. One is that dollar itself has been extremely weak against most currencies this year. So while we are talking about the rupee depreciating against the dollar, if you look at rupee versus other currencies, the situation is much worse. And this is a real thing because many Indian parents, for example, think that now the visa situation in the US is a bit fluid, the US is not as welcoming, so maybe I should send my kids to Europe to study. And the news is that you started the year with the euro at 88.5 rupees, in fact, slightly less than that, and now you're close to 107. So there is a 20% depreciation vis-a-vis the euro versus the Swiss franc, similar. Pound also, it is much more than what it is for the dollar. So actually, by looking only at the dollar, you are understating what has happened to the rupee. So the rupee has actually depreciated a lot more if you look at the basket of currencies. So that's one. But the rupee has always depreciated. I always give this number that when I started working, the dollar was 12 rupees. And the course of less than a career, it's a 90% depreciation, which is why I always make the case that all your eggs should not be in the India basket. That's one. The other is the interest rate. So interest rate, if you look at, currently, because if you compare with the situation, let us say 2 years ago, in a lot of, or 2 to 3 years, if you see that a lot of countries had very low interest rates. Now interest rates have risen in the West, and now we've had cuts. So with the result that the differential, that extra rate that you get or extra return that you get by coming to India, that differential is now in the 2% range, 2 to 2.5%. The norm has been 5% plus, the high has been 7% plus. So if you look at just the theory part, as your relative interest rates are not as attractive, you will attract less capital flows. I mean, that's even the theory of it. And therefore, your currency will depreciate. And for the moment, at least the RBI is not intervening. Though, I mean, the RBI's rate cut, the Indian market itself has not really taken it to heart. So if you look at since the last rate cut by the RBI, the bond rates in India have strengthened. A lot of the state issues and the PSU issues have not gone through debt issues, I meant. So even in the Indian bond market is not taking that as the benchmark interest rates in some senses, you can say. So those are the additional factors. Again, relative interest rates being low means your India is now a lot dependent on remittances. So again, interest rates, if they're not that attractive for the NRIs, you will also have some decrease in the flows from that side. So that's, I mean, just tracking FPI flows is not very meaningful in my view, but I have given that data too many times to repeat it, that there's very little correlation between the FPI flows and market moves on a month-to-month basis, however long back you go back. And again, even from the time the FPIs came in 94 to 2003, a new slew of money came in, the market had a 9-year period of no return. So, so that's a different thing to track. But it is not, as I said, the rupee has actually done a lot worse than what appears from this 1991.
No, absolutely. And I'm glad you put up those stats as well, because while we look at the 7% depreciation versus the dollar, it's startling, the depreciation versus a lot of the other major global currencies. And we have the FPI stats, on the screen, selling off over $18 billion so far. And then the question is now what? I mean, we were discussing this when we were within the vicinity of 90, and then you said that if 89 goes and 90 is almost a certainty. But now 91 coming so quickly, I mean, it really appears the market is overshot on, on the way up. So what is the word now? Is there still a lot of dollar demand? What can we expect before the final year-end holidays begin and the trading desks finally start to thin out?
Right. See, the best part about sort of a market-driven exchange rate is it always does its excess on both the sides. Now, right now, the rupee sentiment is quite bearish. It's hard to find a bull in the market. That doesn't mean it's just going to bottom out. But what's happening behind the scenes is the US economy is decelerating dramatically. It's a K-shaped economy, floated just with the AI and the data center theme. The consumer is under stress, sinking. So this is something even the Fed is watching. How long can they absorb the hit from the rising bond yields? Even Trump faces an election risk next year. So he is getting very jittery. Fed cut rates, but he wants Fed to cut rates aggressively. So what I think is going to happen looks like in 2026, I think in the USD, Anna, the USD part will play out, which means if you just, we discussed how the rupee has done against a bunch of currencies. So Indian rupee has not just been depreciating against the dollar, it has underperformed every other currency except for the Turkish lira. Now that kind of a wedge in performance did not happen since 2013. Then the ground situation in India was worse. So definitely it means when I take that into consideration, rupee is definitely becoming undervalued. Of course, things can become far more undervalued in the short to medium term. But looking into the next 12 months with the situation in America, where they will be forced to print money, they have already announced a backdoor QE. And I presume Donald Trump will try to force the Fed to do more because the yields are rising. He will not like it. And he would like to spend also a lot. So
no, Anindya, that's 12 months. But before we talk more about 12 months, actually, I was asking more about the next 2-3 weeks. Because these days, the near term can play out almost equivalent to years. So just to complete that point, short term, next 2 to 3 weeks till 15th of Jan, when everybody gets back from their holidays, what should we expect?
So I think short term, the situation looks bad for the rupee because, as I said, the yen carry trade can unwind further after the BOJ hike, the expected hike. So yes, the next 2 weeks of December or the first week of Jan, we could see a further sell-off in the rupee because of the outflows.
Yeah, no, absolutely. The many mainstream economists, of course, have made the view. By the way, Anindya, to the point, right, which the fact that interest rate differentials, I think Devina also mentioned. We had a very senior Asia Pac head from Bank of America with us. And I asked him, what's the one non-consensus view he holds? So he said his view is dollar will appreciate in 2026. The consensus view was that the dollar should fall. But he said, well, that's the one thing that he expects, which is of course non-consensus. I don't know, and if that were to play out, then this rate differential story is not going. It's a problem still, right? It will remain a problem in that sense. If we get a trade deal, Devina, a quick question to you: if we get at least this 25% penal tariff goes away, do you think we will, a lot of sentiment, of course, is price dependent in that sense, especially on the equity side, maybe on the forex side as well. You think we'll get a bit of a snapback?
I think a lot of it is built in, but of course, on the FX side, maybe you will get some short-term impact, but whether it will be any meaningful rollback of the move you have seen, that I doubt. And on the equity side, mostly it is priced in, but equity side, I do see the news flow to be better in terms of the earnings. And as it is, even on PEs, we are not at the extremes. I expect the Q3 earnings to come in better. And also, if you look at just simply, India has been one of the worst performing emerging markets this year. So normally I see the giant wheel turns, and most time you find the markets at the bottom go towards the top in the next year. So we know that there's always that possibility, but that's aside from the currency side.
Rumi, just one point. You started by saying, and I think it's macros are stable, etc. The persistent strength in yields. What does that tell you, Rumi? Should we pay attention to it?
The bond yields for India?
Yes.
Yes, it should. In fact, that helps in interest differentials with the US dollar as well. Right now, we are around 2.42 bond yields, and that differential helps in keeping some of some of the foreign investors interested in India. And that should hold up. To be honest, if that also kind of limits the RBI's next move to go for a policy rate cut, unless the US Fed decides to go for a rate cut, because right now, pretty much across the world, the bond yields are up, is one of the highest.
No, my question more, Rumi, was, is that an indicator of, I mean, maybe some worries around state finances, etc. as well, both at the state level and central level?
Not exactly, because we are at around what? We are around 6.6, 6.7, which is one of the lowest that we have seen in a long time, right? So clearly, it is range bound. Fiscal, I think the government will make sure that it meets its fiscal target this year, because that is one of the very important indicators to foreign investors that government is in control of its finances. That way, at least the government can anchor investors here. And right now it's more FII. FDI gross flows are still pretty strong, and it is kind of moving up as well. So I think that is something which the government will not let slip away. And I think the yields will also remain pretty much range bound there.
Dheeraj, it's a sober end to 25, right? Although something can change last 10 days. But it's the setup looks maybe a little more cleaner next year. Maybe is that as we turn the chapter, mentally all of us are attuned to maybe things changing somehow for the better, right? And maybe it will. A lot of stuff has already happened, so maybe a cleaner kind of start, but nothing explosive in that sense, right? A tough year and maybe a little bit easier, 26 in that sense. Would you concur from an equity point of view?
I would totally agree with that. In fact, I've been also of the view that the earnings in the second half will look better than the first half. But will it be as strong as what the consensus analyst estimates in FY27 is, which is currently pegged at 17% growth? I seriously doubt. So once again, heading into FY27, we will see earnings cuts to the tune of maybe 3, 4, 5%. If we get above 10, I think we should be happy at this point of time. So you're right. The next few months are likely to be better than what the tough few months or the tough year that we have seen so far, but nothing explosive. I don't think we are racing away. I think this continues to be a tough range-bound market with a slight upward bias, and which largely means it stays a stock picker market. However, while there is less linkage or more linkage between equities and rupee, I've heard this term before that Indian rupee is a little bit of an equities-driven currency. So once the equities start doing well, the rupee tends to stabilize. May not appreciate meaningfully, but tends to stabilize. So the near term, the pressure is visible, may continue. But I think longer term, if the markets turn up, which will be driven by earnings, rupee should also stabilize.
Yeah, a bit of that proverbial chicken and egg, isn't it? But we really hope that the jinx and the vicious circle somewhere breaks, and may 2026 be better than the year that's wrapping out. Thank you so much, ladies and gentlemen, for joining in. Very helpful conversation. Gives us important context at this point. And let's see what the remainder of 2025 has in store. With that, it's a wrap on this edition of this special show. Thank you very much for watching. It's a goodbye from Prashant and myself. News and updates continue on CNBC-TV18.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The rupee slips to a record low, breaches 91 against the dollar for the first time ever. Sustained FPI selling and uncertainty over the US trade deal weigh on sentiment. The rupee is down 6% this year, which is the biggest fall among emerging market currencies. The Sensex and the Nifty decline after a broad-based sell-off. The Nifty drops below 26,000. Mid-cap sees sharper cuts. Finance Minister Nirmala Sitharaman tables the insurance amendment bill proposing 100% FDI in the sector. The regulator can set limits on commission for agents and intermediaries. Composite license not part of the bill. Opposition parties oppose the legislation, saying it will weaken state-run LIC. The government tables a new bill to replace the MGNREGA, India's flagship rural employment scheme since the last 2 decades. Guarantees 125 days of wage employment per household instead of 100. Also imposes 40% additional financial burden on most states. Opposition criticizes the shift from demand-based to normative funding and the government's obsession with renaming schemes, among others. Big positive for Vedanta. The NCLT approves the metal giant's demerger plan despite the government's objection to the plea over their claims of being put to risk. The stock up 3% after the NCLT clearance comes through. Quick commerce firm Zepto gets ready to go public. Sources say the company is likely to file papers with SEBI this month, hopes to raise $750 to $800 million. Fog in North India impacts travel plans. Over 100 flights impacted at the Delhi airport alone. 13 dead after multiple vehicles collide on the Delhi-Agra expressway as dense fog affects visibility. Delhi's air quality improves marginally but remains in the severe category. Ford will take a hit of over $19 billion, primarily tied to its electric vehicle business, and shift focus to hybrid vehicles. This is amongst the largest impairments taken by a company and a major reckoning for the auto industry's electric ambitions. President Trump files a defamation lawsuit against the BBC demanding $10 billion in damages, accuses the broadcaster of producing false and malicious depiction of President Trump in a documentary a week before the 2024 elections. Australian all-rounder Cameron Green becomes the most expensive overseas player in IPL history. Kolkata Knight Riders break the bank to shell out over 25 crore rupees, but Green will take home only 18 crores after BCCI puts a limit on salary for foreign players. Well, let's go straight to the top story this evening, and that is the rupee. It has slipped to another record low, breaching the 91 mark against the US dollar for the very first time. Now, sustained foreign fund outflows and uncertainty over the India-US trade deal continues to weigh on the money market. The rupee is weakened from 90 to 91 against the greenback in the last 10 trading sessions. In fact, the rupee has declined by 90% against the dollar in the last 50 years. In 1975, one US dollar would cost 9 rupees. In 1993, a couple of years later after liberalization, the rupee weakened to 30 against the dollar. By 2013, the rupee had breached the 60 mark. In the last 12 years, the rupee has seen its sharpest decline, falling from 60 to 91 against the dollar. Latha joins us now with more on the fall in the rupee and its implications. Latha, the way that we've gone from 90 to 91, what do you make of that, as well as what the likely implications will be from here on?
The reason for the fall of the rupee is really capital flows. We have seen, persistent, consistent selling by FIIs of all hues. It's a 17 billion sellout year to date. And what we are now picking up is from December 4th, you would have seen the FPI data. Debt FPIs are also selling out. And this month, we have an $800 million plus, probably $850 million sell from the FPI debt owners as well. So that is the fundamental reason. One was expecting that when the trade data came, the sentiment in the market would improve, but it hasn't. It's clearly that the fact that there's, for instance, trade data, good or bad, Prudential at the end of the last day of the IPO would have sold the money it got for, spot today will be delivered day after tomorrow. So that sell would anyway happen. Therefore, we shouldn't be surprised that despite the good news on the trade data, there are some FPIs who are still on exit mode. Now, what has added to the accelerated pressure that we are seeing in the past 3 weeks is most importers were not prepared for a 90-plus situation. Therefore, they're probably mentally okay with a loss, with a depreciation of 3% annually. But more than that has taken them by surprise. And we are seeing importers hedging in a very big way. Almost every banker I spoke with said that, corporates are phoning us and asking for hedges, buying hedges or buying dollars. Likewise, even sovereign wealth funds, etc., who are in India, may not have thought of hedging all these days, but when you see a rapid fall, they also come to the market. That explains the accelerated pace that we're seeing in the last few days, but it's taken people by surprise. The only point is, why is the Reserve Bank not in? My own sense is that they want the rupee depreciation to correct the trade deficit, which apparently has worked. I mean, what is the big difference between November and October? The rupee was cheaper, and therefore perhaps exports did that much better, 10% better than in October. So that is working for the real economy. If the real economy is not hurt, but in fact helped by the rupee fall, perhaps the Reserve Bank cannot be faulted for the stance it is taking. The moment they see real economy, investment intentions, or something seriously destabilizing in the real economy, we should expect them to use some of the arrows in their quiver. But otherwise, I think at the moment it is working for them. It's not even going to increase inflation because inflation is at abysmally low levels. It seems a logically very good step to let the rupee find its own level.
Well, will we continue to see the RBI stay hands-off, or will there be intervention? We will have to wait to see. Lata, many thanks for joining us. Meanwhile, for the equity markets, a broad-based fall on the Lal Street, with the broader markets witnessing more pain. The Nifty and the Sensex fell 0.5% today, with the Nifty closing below the 25,900 mark, 167 points lower, 500 points lower on the Sensex. The Nifty Bank was down by almost 1%, and the Nifty Mid-Cap down by about 500 points today. The mid-cap index underperforming the blue chips this afternoon. Realty and bank stocks taking it on the chin. But let's talk about the IPO markets. Quick commerce firm Zepto is getting ready to go public. Sources say the company is likely to file its papers with SEBI this month and hopes to raise $750 to $800 million. Shruti is here with more details. Shruti, we were expecting this to happen earlier in the year, but it now looks like early next year.
Absolutely. Grocery delivery startup Zepto is preparing to file its draft IPO papers as early as next week. Sources tell me the company could look to raise $750 to $800 million via a confidential filing route. Now, the move comes amid strong operating momentum. Zepto's last fundraise, announced in August this year, valued the company at about $7 billion. Since then, order volumes and net sales value have risen 45% over the past 6 months, with the platform now handling nearly 2 million orders a day. Sources also tell me the company is working with a clutch of domestic and global investment banks, including Morgan Stanley, Goldman Sachs, Axis Bank and Motilal Oswal. There are also signs of improving unit economics. Burn has moderated, driven by higher store throughput, supply chain automation and lower customer acquisition costs. Sources add Zepto is sitting on a cash balance of nearly 7,000 crore rupees, potentially making it one of the best capitalized new age companies heading to the public markets. Remember, founded during the pandemic, Zepto has emerged as one of the fastest growing players in India's 10-minute delivery segment, competing with Blinkit, Swiggy, Instamart and Tata-backed Big Basket. Over to you.
All right, Shruti, many thanks for joining us. That's Zepto getting ready for its IPO. But the big story from Parliament, Finance Minister Nirmala Sitharaman tabled the Insurance Laws Amendment Bill in the Lok Sabha today. The bill proposes to allow 100% foreign direct investment into the sector. This is not new. It's been on the table for a while. It also imposes limits on commissions for both agents and intermediaries. That caused some concern. The bill seeks to allow mergers with non-insurance companies, but the composite license is not part of the proposed legislation. Opposition parties protesting in Parliament when the bill was introduced, alleging higher FDI will weaken state-run insurer LIC. Here's the Finance Minister introducing the bill.
Many of the points, sir, are very much a part of what the discussion could be on. And therefore, to object to the introduction, at the introduction stage itself, questions the legislative competence, and I don't think there is a question on the legislative competence of the government to bring this into this House. Commissions for LIC agents, very much a part of what we are going to discuss. And in fact, let me even give one point already on that. Fixing commission for LIC agents is already a part of the regulator in the sense that he fixes the upper cap.
Well, that is the Finance Minister. The government also tabled a new legislation to overhaul the MGNREGA, India's flagship rural employment scheme for the last 2 decades. Amidst opposition protests, that is, the new bill, the Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin, mandates an increase in guaranteed employment days to 125 days from the current 100 days. The legislation also proposes a higher financial burden for most state governments. At present, the centre bears 100% of unskilled labour costs and 75% of the material costs. Under the new framework, 40% of the total cost will be borne by all states except the northeastern and Himalayan states and the Union Territory of Jammu and Kashmir. The bill also seeks to alter the process of budget allocation. The central government will provide a fixed allocation and states will lose the flexibility that they currently have to propose budgets based on anticipated demand. There were protests from opposition benches when the Rural Development Minister Shivraj Singh Chauhan tabled the bill. Higher financial burden on states was a key point of contention. Opposition lawmakers have also questioned the decision of the government to rename the bill by dropping Mahatma Gandhi's name and held protests outside Parliament. Rahul Gandhi says the Congress party will fight tooth and nail to oppose the bill.
पता नहीं क्यों जी राम जी नाम आ गया तो ये भड़क गए। महात्मा गांधी स्वयं राम राज्य की स्थापना की बात करते थे और उनके अंतिम शब्द भी हे राम थे। बापू जी का पूरा सम्मान करते हुए राम राज्य की स्थापना, हर गरीब को भरपूर रोजगार मिले, उसकी गरिमा को सम्मान हो, दिव्यांग, बुजुर्ग और महिला, अनुसूचित जाति, जनजाति, उनको और प्रोटेक्शन दिया जाए, इसके लिए ये बिल लेके आए हैं। 125 दिन की गारंटी है, गारंटी।
बिना चर्चा के, बिना इस सदन की सलाह लिए इस तरह से जल्दी में विधेयक को पास नहीं होना चाहिए। गहन जांच पड़ताल और व्यापक चर्चा के लिए इसे कम से कम स्थायी समिति के पास भेजा जाना चाहिए और कोई विधेयक किसी की निजी महत्वाकांक्षा, सनक और पूर्वाग्रहों के आधार पर न तो पेश होना चाहिए और न ही पास होना चाहिए।
And staying with Parliament, the government has also tabled a bill to open nuclear energy sector to private companies. The bill has been called Shanti, or Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India. Now, this bill will allow private companies and joint ventures to build, own and operate nuclear reactors. This will effectively end the government's monopoly in nuclear energy. The government is also proposing to create a unified legal framework and allow 49% foreign direct investment. The new legislation will replace the Atomic Energy Act of 1962 and the Civil Liability for Nuclear Damage Act passed in 2010. The larger goal of the bill is to achieve the 100 gigawatts of nuclear power capacity by 2047. What has sparked a controversy is the clause on liabilities. The bill elaborates operators shall be liable for damage except those caused by grave natural disaster of an exceptional character. Liability is also exempt during any armed conflict, civil war, insurrection or act of terrorism. Up next, a big sigh of relief for Vedanta after the NCLT gives the metal giant's demerger plan a green signal. That and more when we return. You're watching Business 360, a quick check of some of the other headlines that we're tracking for you. A nightmare for commuters across North India as fog impedes visibility, leading to reports of accidents and vehicles piling up on highways. In a tragic incident, 13 people were killed after multiple vehicles collided on the Delhi-Agra expressway near Mathura. Several vehicles caught fire after the collision. The national capital remains in the grip of hazardous air conditions, even as the situation has improved slightly from yesterday. The AQI peaking to 383 early morning today. At least 100 flights were cancelled at the Delhi airport on account of the fog disruptions. Over 58 lakh names have been deleted from the West Bengal draft voter list on the back of the special intensive revision carried out by the Election Commission in the state. The poll regulator released the list earlier today. Out of the 58 lakh names deleted, over 40% have been marked as dead. The revision drive will continue until February 2026, with the final list expected ahead of the assembly elections next year. The Indigo Pilots Guild and the Federation of Indian Pilots have approached the Delhi High Court seeking contempt action against the DGCA over exemptions to flight duty time norms. The court will examine whether the regulator is liable, while the DGCA says it has the power to grant exemptions and that the relief is valid only till February. Vedanta soared 4% after the National Company Law Tribunal approved the metal giant's demerger plan. The green signal came despite the government's objection to the plea over their claims being put to risk. Ashmit is here with the details. Big relief coming in for the Vedanta group with the demerger plan being given the go-ahead. Ashmit.
Well, a big sigh of relief for Vedanta, a big win coming to them from the NCLT. The NCLT waving the green flag, granting the sanction to Vedanta's demerger scheme. Now, this is clearly a scheme where Vedanta was looking to split the company up into smaller, more industry-focused units, and that is a scheme that this NCLT approval paves the way for. Now, what's important is that this journey was not without its hurdles. There were objections raised by the government. The government had raised all of these concerns. One of the concerns that had been raised is that there are claims of over 16,700 crore rupees pending against Vedanta. The government's concern was that the consolidated single entity has a very large asset base, but that the smaller demerged entity will have a much smaller asset base, and therefore that would expose the government's claims to risks. Vedanta had responded by saying that even the demerged entity will have an asset base that would be 1.8 times the total government claims of 16,700 crore rupees. That's one. Another concern that the government had raised was with respect to alleged lack of disclosure. What the government had said is that there are amounts that are locked in litigation. There are disputes currently underway before arbitration, that the total payout by Vedanta could be anywhere between $200 million to over $1 billion, and that has not been disclosed to public shareholders. In response, Vedanta very clearly said that as per the law of the land, they're only required to disclose dues that have been confirmed by way of a court order or an arbitral award, not amounts that are locked in litigation. And there appears to be these arguments by Vedanta appear to have managed to break the ice with NCLT granting its nod for this demerger scheme. We'll of course now have to watch whether or not the government, by way of the MOPNG, chooses to challenge this before the NCLAT.
Ashmit, many thanks. In international news, the Nasdaq is set to file plans with the U.S. Securities and Exchange Commission to introduce a 23-hour trading day for stocks. According to Reuters, the move is aimed at tapping into growing global demand for U.S. equities. Investor appetite for near-round-the-clock trading has surged in recent years, prompting regulators to introduce new rules and approve extended trading proposals from major exchanges. Now, Ford Motor will take a $19 billion hit as it scales back several electric vehicle models amid slowing demand. The automaker will replace the fully electric F-150 Lightning with the new extended range electric model that uses a petrol engine to recharge the battery, and will scrap its next generation electric truck. Ford says it's pivoting aggressively towards gasoline and hybrid vehicles. This is amongst the largest impairments taken by a company and a major reckoning for the auto industry's electric ambitions. Fintech giant PayPal has applied to become a bank in the U.S. If it gets the approval, the move would allow the company to offer loans to small businesses and interest-bearing savings accounts to customers. PayPal, which also owns the popular payment app Venmo, already provides credit lines and has been steadily expanding its suite of banking-like services. The push comes as the fintech firms intensify competition with traditional brick-and-mortar banks. In fact, Amrish Rao of Pine Labs told me just a few days ago that customers trust fintechs more than banks today, given that more of their transactions happen on the fintech layer, and why he believes digital banks will be part of India's future as well if the regulator gives the go-ahead.
I believe that 3x the number of transactions that banks and financial institutions are doing are being done by fintechs in India. There will be serious competition. In fact, right now where I'm saying, when I'm getting to see that 3x the transactions are happening on fintech apps, I genuinely believe that we've already passed that argument. Consumers have given the answer that I'd rather operate with a fintech than operate with a bank or a financial institution. Going forward, if this gets opened up, there is a real chance that banks will then become warehouses of money, while the transaction layer would be with someone else entirely. So yes, I do believe that consumers have actually let it know that they would rather prefer a company which is giving them the best UX.
Well, digital banks, are they here to come? With that, it is time for us to wrap up this edition of Business 360. The news will continue right after this break. Stay tuned to CNBC-TV18. We're back in a moment with plenty more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. In today's edition of Commodity Champions, we put spotlight on gold and silver. As gold created multiple records this year and is expected to scale new highs again as it flirts near record highs. In 2025, well, the gold prices have surged over 60%, while silver has seen a rise of over 120%. Against this backdrop, we speak with Suki Cooper, who's Global Head Commodities Research from Standard Chartered Bank, who gives us an outlook on gold and other commodities as well. Suki, hi, thank you so much for joining in. First of all, it is all about silver because it's doubled up in this year and it has given double the returns what gold has done. Where would you say is the silver prices headed from here?
Silver has been the strongest performer across the precious metals complex. We've seen prices doubling over the course of the year. The foundations for this rally have been laid over many years. We know that the market has been in an undersupplied state and deficit for the past 5 years. So we've seen a lot of the foundations been building over the past few years. But what's really changed this year is the availability of stocks. In previous years, when we've had heavily undersupplied markets, there's been plentiful above ground stock that's been readily available for near-term consumers to be able to consume. But this year, with the concerns around tariffs, has led to regional dislocations in stocks. So we saw COMEX inventories hitting record highs on the 3rd of October. Even in London, we saw a drawdown of available inventory. And we've seen stocks in Shanghai, across the Shanghai Futures Exchange, across the Shanghai Gold Exchange, falling to 10-year lows. So this has meant that there's been a much more tightness in the market that's been prevalent in driving lease rates higher, but also spot prices higher for the silver market. But the other factor that's changed this year is really interesting on the fundamental side is that we've seen some of the industrial demand coming under pressure, but the investor appetite has continued to grow with ETFs exceeding 4,000 tons in terms of fresh inflows this year. And that has extended the tightness in the market, driving prices to these record highs. So going into 2026, we think that there's a couple of factors we really need to keep an eye on. The ETF demand, the investor appetite remains absolutely crucial in terms of continuing to build that upside momentum. But in the nearer term, the market is really keeping an eye on the Section 232 Critical Minerals Report. And that will explain to us whether there'll be further concerns around tariff risks, especially in the US. The market is assuming that we shouldn't see any further implications for the silver market, but if there are, that could add to the upside risk for silver.
Well, there is so much to watch out for in the international market, Suki, but what is your sense on the prices going forward in 2026?
So we think in the near term, there's scope for some correction, especially given how quickly that recent move higher has been, and the fact that it's been accompanied by a lot of retail and investor appetite really pushing those prices higher. So we think there could be some short-term risk, especially given that there's some pressure on the industrial side, there's risk of substitution, but some of the material impact from that substitution may not be felt for a couple of years yet. So we think that there's room for correction, but then going into the fourth quarter of next year, so this time next year, we think that there's scope for prices to average $57 per ounce. So lower than the levels where we are at the moment, but still elevated compared to historical highs.
How are you also looking at gold prices from here, given the fact that we've seen all-time highs this year, 60% of gains as well, which is significant for a commodity like gold? Do you see a similar scenario continuing for gold as you do for silver going forward? Are you expecting a correction?
The gold market, we think, is slightly different in that we do see further record highs for the gold market. We're expecting prices to average 4,488 in 2026, but come this time next year in Q4 2026, we expect prices to average 4,750. So more upside risk, we think, is lingering for the gold market. The main difference in the dynamics is the central bank appetite that is really supporting the gold space at the moment in conjunction with the ETP demand and the broader universe of investors that have expanded their exposure to gold over the course of 2025. So with gold, we see there's scope for potentially more consolidation rather than a deeper correction, but we could see profit taking materializing towards the end of this year and as we enter early part of 2026. But thereafter, we still expect gold to build upon those gains. We think that the fundamental drivers behind this rally, the structural factors remain intact, and those don't look like they're going to dissipate anytime soon. So on the one hand, we have seen a slowing in some of that industrial consumption for the gold market, but the key drivers in terms of central bank appetite continue to grow despite record prices. In conjunction with investor demand continuing to expand as well, we think that there continues to be further upside risk for the gold market. Some of those structural themes, concerns around currency debasement, de-dollarization, concerns around the Fed, scope for more dovish rhetoric, continue to support the gold market. But we think that the investor allocation in gold is still relatively lower than where investors would like to be.
As you speak about the currency debasement and, of course, the kind of debt that the Western world seems to be accumulating, the dollar index has seen an impact of that already in this year. Are you looking at further easing going ahead?
From the dollar perspective, we actually think that there's scope for the dollar to stabilize and even start to rise going into 2026. So we think that that bulk of the weakness is actually behind us. And the dollar-gold correlation has been wavering somewhat in recent months. We saw the relationship starting to strengthen again at the start of this year. And while it's contributed to the gold upside risk, it has by no means been the sole driver. And I think that's what's made this gold rally different. It hasn't been a single factor that has led to gold scaling these record highs, but it's been a number of structural drivers that has really been behind the rally. So the correlation between gold and the dollar index at the moment is relatively low, but still firmly negative at around about minus 20%. So it's still providing a tailwind to the gold market when we see those bouts of weakness, but it hasn't been the primary driver of this rally.
The other thing that also has made all-time highs in this year, Suki, has been copper prices up 36% in this year. How are you looking at the forecast now for 2026?
Across the base metals, we think a lot of this risk in terms of upside momentum is potentially concentrated in the copper market. We've seen the market shifting away from a demand focus more so to a supply focus, and it has been those supply risks that have moved copper on a more sustained basis above that $10,000 per ton level. So going into 2026, we think that the key factors to keep an eye on are going to continue to be around China and its growth risks and stimulus measures that might be introduced, but also the main factor that we need to be keeping an eye on is really those supply risks. And again, while we've seen a lot of supply disruptions materializing, say in Indonesia, it hasn't been linked to just one particular country. It's been a series of supply issues that have helped to build that tightness also in the copper market. And the same factors that we've seen in gold and silver with COMEX inventories building in the US, we've seen elevated stocks since March building in the copper space as well. So that's also led to some regional tightness in the copper market. But we think going into 2026, one of the biggest factors to watch will continue to be on the supply side alongside some of those macro tailwinds.
And with that in light, what is your sense on the target prices number that the copper prices could range within?
For copper, we think that $11,000 per ton level is going to be critical to watch. So those will be the sort of levels where we think prices are likely to be sustained and seeing a lot of momentum.
Suki, what are your concerns regarding the usage of aluminum going forward? Because the copper-aluminum correlation or ratio rather is at a record highs, and markets are looking at aluminum as a proxy because the prices are still, relatively lower than various other metals.
On the aluminium market, again, some of the regional tightness has really come through in the US in terms of the Midwest premium. But yes, in terms of the aluminium, it's more so along the sides on the demand impact that we might see going forward, rather than the supply risks that we've seen materializing, say, impacting the copper market. And it's been a much more diversified picture when we look at the aluminium side. In terms of the renewable energy, that's where we see a lot of the upside risk continuing to materialize for the aluminium market. But in terms of investor positioning, there's more appetite in the copper space than there is in aluminium.
And finally, Suki, a word on the crude oil prices. 3 years of negative returns. Crude is down by nearly 22% in this year. Are you anticipating a bearish 2026 going ahead?
For 2026 in the crude oil market, we think that the low 60 levels are a range that the market has become more comfortable with, certainly looking at the course of 2025. But yes, there's also been a lot of narrative that's focused on the oversupply in the oil market, and we haven't yet seen that bit materializing to the sort of extent that the market was expecting. So going into next year, we think that the market's still going to be keeping an eye on those oil balances, but we still think that a range around about low 60s is more likely to be prevalent. In terms of investor appetite, we've seen much more interest in the metal space than we have across the crude energy. And in fact, our investor positioning index suggests that we've seen some of the lowest levels of investor appetite in oil than we've seen historically.
Oh, well, absolutely. It's been quite a different world when we look at the crude oil prices, higher surplus, weak demand, all of that clearly impacting the prices therein. Thank you, Suki, so much for joining in. So that's the Standard Chartered head of commodities telling us that gold and silver still continue to be places to be in. Even copper, aluminum could see some gains. But when it comes to dollar index and crude oil prices, well, some of the weakness perhaps could continue in the next year. With that, it's time for a short break. On the other side, we will speak to Francisco Blanche, head of global commodities and derivative research at Bank of America Securities. Stay tuned for that conversation. Welcome back. You're watching Commodity Champions. And in the latest report, Bank of America states it's bullish on commodities for 2026, calling it the best run it hot trade. The sentiment is driven by expectations of strong growth, increased government spending, and persistent inflation. A potential surprise could be energy and oil, which may emerge as key contrarian bets alongside metals, as metals are set to benefit from the AI boom. Further, the U.S. President Donald Trump's America First policies are expected to add to inflationary pressures, but are likely to be positive for some of these commodities. Against this backdrop, we speak to Francisco Blanch, Head of Global Commodities and Derivatives Research at BofA Securities. Francisco, hi, thank you so much for joining in. And this actually is the cue coming in from various global banks that the bullishness in commodities that we saw in 2025 could see a spillover in 2026 as well. Do you believe so as well? And according to you, what segments or what commodities basically could see more gains than the others?
Hey, Manisha, thanks for having me in your program once again. So look, we are positive on the commodity complex, probably more positive on industrial metals as well as precious metals than we are on some of the other bits of the complex. But I would say that in the energy space, it's electrons over molecules. So we are constructive on things connected to power prices and AI. So we believe electricity prices in the US Northeast, across Europe, will trade pretty strongly. We also like carbon as a commodity, which is connected to electricity prices. But we just don't like molecules as much. We think there's a surplus of crude oil in the market. There's a surplus of natural gas. So it's a bit of a split economy when it comes to energy. In metals, I think the complex looks robust. You've talked earlier in this earlier part of the segment of the program with copper. We also expect copper prices to rise. We have a $13,000 target for next year per ton. We are also bullish on aluminum. We have $3,000 per ton target, and we are bullish on gold. We believe gold will rise to $5,000 an ounce next year. Oil, a bit more complicated as natural gas, as I said, right? So that's the split.
All right. Francisco, I have to talk to you about silver as well, because what a stupendous run-up we've seen into this commodity from where we're trading right now, and it seems to be holding there. I mean, it has been one linear, one-way rally that silver has given us this time around, 120% plus, and we still have a couple of weeks more to left in this year itself. How are you looking at silver? Because it really seems to be a divided house from here on. What is in-house when it comes to silver forecast going forward?
Sure. We had a $65 an ounce target, so we are pretty close to it right now. So it's moved up very, very quickly. But I would say silver has a structural deficit and therefore a fair amount of support. It has been perhaps a little bubblish, if I may say. We've seen that across several markets over the years, right? And particularly in this past 2025 year, this year we're living, we've seen a number of buckets within the market behaving a bit like silver, whether it is, of course, some of the uranium stocks, or we've also seen some of the AI stocks, and silver is kind of part of that. Remember, one thing that silver has going for it is that it is the best electricity conductor in the world. So it's better than copper. Now, of course, it's a lot more expensive than copper, but it is a great conductor. So it has a lot of industrial applications that are connected to the electricity world.
You've said 65. Are you willing to see targets higher than that? If 65 is taken, are you looking at fresh, newer highs then?
Potentially, I mean, but again, we need to stick to our target right now for the time being. That's how we see it for now in the next kind of 6-12 months.
Okay, Francisco, how are you looking at the other PGMs as well? Because this has been a great year when it comes to platinum, palladium, whether it has been about deficit or strong demand, all factors working in favor.
Yeah, we've also liked platinum for quite a bit, particularly over palladium. But now we're seeing both metals rallying in sync, and that's frankly has been quite a bit of a surprise that palladium really caught up. I think one of the bigger risks for the PGMs and perhaps for some segments of the commodity complex overall is the the potential for peace in Ukraine, right? Remember, a lot of these metals, even the energy segment in particular, I mean, they've been constrained, also agriculture, by the war between Russia and Ukraine. So if we end up seeing a peace deal over the next few months, that's perhaps a downside risk to the commodity complex. But in the absence of peace and with supply being tight, with deficits being relatively pronounced, we live in a world of just in case inventory accumulation for commodities as opposed to just in time. We've moved away from just in time. People want to have commodities in case something happens. And we are seeing those inventories really driving prices around the world.
Well, Francisco, we have seen a lot of fundamentals be on the positive side. As you mentioned earlier as well in a conversation, that it is a lot of money which seems to be getting out of other asset classes and get into tangible commodities. Is it more about money? Is it also about a lot of speculative positions that seems to be supporting commodities?
There is a little bit of a speculative positioning, no doubt. But I would say a lot of the accumulation that we're seeing in inventories, whether you're looking at oil or copper or gold or silver, I mean, a lot of it is driven by this fundamental force, which is this major geopolitical fracture that we have in the world today, with the U.S. concentrating more on the Western Hemisphere, Russia trying to expand its sphere of influence, and of course, there's also China out in the east trying to carve a space for itself. So I think this fracturing geopolitics are one of the key reasons why people are accumulating stocks. And again, if you think about this year, perhaps the one thing that's really tamed the price war has been the threat around rare earth elements, another commodity. So of course, people are piling up rare earth elements. More recently, we've seen the U.S. seizing an ultra-large crude carrier of almost 2 million barrels a day in the Caribbean, right? So we've also seen in the past year tensions between Iran and Israel, and even the U.S. of A, leading to an expansive conflict in the Middle East that fortunately seems to have eased down meaningfully now with the peace deal. But I think these are the reasons why people are accumulating commodities. We live in a very uncertain world, Manisha.
Well, we do, and that doesn't seem to be changing as we get into 2026. So that's a view coming in from Bank of America, both are securities rather, where carbon, electricity they're bullish on. Aluminum, gold, and silver as well could be on the higher side. Copper, aluminum could be doing better as well. And of course, as it comes to crude oil and gas is where Francisco believes that we could be looking at some declines going forward yet again. Francisco Blanch, as always, thank you so much for joining in and making a sense of what 2026 could really shape up as when it comes to commodities. But with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
Hello and welcome to News Centre. I'm Parikshit Luthra. Today we focus on two key bills before Parliament, the Nuclear Energy Bill and the Higher Education Bill. First, let's talk about the bill that aims to open up the closely guarded nuclear energy sector to private players. The Shanti Bill is an acronym for Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India. The bill will effectively end government monopoly in nuclear energy and also encourage more small modular reactors. The government is also proposing to create a unified legal framework and allow 49% foreign direct investment as well. The new legislation will replace the Atomic Energy Act of 1962 and the Civil Liability for Nuclear Damage Act passed in 2010. The larger goal of the bill is to achieve 100 gigawatts of nuclear power capacity by 2047. What has sparked a controversy is the bill elaborating that operators shall be liable for damages except those caused by grave natural disasters of an exceptional character. Liabilities are also exempt during any armed conflict, civil war, insurrection or act of terrorism. There is renewed interest in nuclear power not just in India but around the world. Globally, electricity demand is rising sharply and is set to keep rising through this decade. According to the International Energy Agency, global electricity demand is projected to grow strongly through 2030 and India will be one of the fastest growing electricity markets globally. At the same time, electricity consumption from data centers and artificial intelligence driven computing is expected to more than double by 2030, adding significant pressure on power grids worldwide. Together, these trends underline the growing need for reliable, large-scale and low-emission sources of energy, and that's where nuclear power comes in. The International Atomic Energy Agency has raised its nuclear power growth projections for the 5th year in a row. To take this discussion forward, I'm now joined by Meera Shankar, former Indian ambassador to the United States, and Karthik Ganeshan, Director of Strategic Partnerships at the Council on Energy, Environment and Water. Thank you very much for joining us. Karthik, let me begin by asking you, when it comes to the issue of liability, and especially US companies showing interest in the civil nuclear energy sector in India, we didn't see much interest ever since the signing of the deal because of high liability. With this bill capping liability at 3,000 crores and also paving the way for private entities to enter and invest in the nuclear sector, do you think there will be now concrete interest among US nuclear energy companies?
Absolutely, Parikshit. I mean, this was the clear stumbling block when it came to operationalizing the 123 Act that was signed in 2008 under Prime Minister Manmohan Singh. Clearly, the proof of the pudding will be in how much capacity actually gets deployed now that the Shanti Bill will be tabled and eventually passed into an act. And that will, to a large part, depend on what is the final price that the Indian consumer and, for that matter, the operator of the nuclear power plant in India or the utilities that will be purchasing it will have to pay for it. And if that number is significantly higher than what we are used to, and if we aren't able to place a strategic value on the value of electricity that might come from technology that involves, overseas participation and even sort of, licensing of technology that's currently available overseas, then there's a very likely chance that, we may not see foreign participation. So it also is really dependent on how does the financials of the offering from foreign participants look like, and what is the ability of the decision makers in India to strategically think of what covering for 50 years worth of energy costs and baking that into a contract means. We haven't looked at projects that are that long, especially involving foreign participants in a while. So it'll be new learning, and I think we'll have to wait and watch to see how much interest does it actually garner once we demonstrate how much money we're willing to put down on the table in order to procure electricity. Granted that, of course, that it will thrive, it will make a lot of domestic manufacturing and the industry thrive, but ultimately the price is of electricity, which is a politically sensitive commodity and which we want to sort of be seen as offering at the lowest possible price to all our consumers. So that's something that I think will determine how enthusiastic is the overseas participation in this.
Right. Let me also get in Ambassador Meera Shankar at this point. Ambassador Meera Shankar, civil nuclear energy had been a continued area of cooperation between India and the United States ever since the civil nuclear agreement was signed, which was itself very contentious. Do you see that this will now be a pivotal moment which will enable greater investments from the US into India, maybe Europe to India as well?
I think we have to wait and see because, our discussions with foreign partners on nuclear energy cooperation did not really fructify. And there were various reasons for this. In the US, the nuclear part of the companies, the nuclear technology part had been sold to Japanese companies. So it was GE, which had sold to Hitachi, and then Westinghouse, I think, had sold to Toshiba. So there were, it wasn't really that these were just American companies. We first needed to get Japanese government clearance, and that took a long time because they had their own hesitations. Then there was the whole question of pricing, because the prices were much higher than the Indian market could absorb. And therefore, it would have been non-viable. Then we suggested that they should look at getting some domestic manufacturing done in India through technology partnerships to reduce costs. But they weren't willing to look at that. And from the US side, they had cited the nuclear liability law as a limiting factor, saying open-ended liability for the supplier meant that this was a no-go. Similarly, with the French, if you've seen, their own reactor, the reactor that they were building in Finland, had huge cost and time overruns. So these are not simple issues. And as far as India is concerned, the Department of Atomic Energy is actually the cheapest producer of small nuclear power plants in the world. And their technology is a bit outmoded because it's dependent on heavy water. But, this means that we don't have to be in a hurry to tie up partnerships. And in fact, if you see in space,
all right,
it is
Ambassador Shankar, I'm going to come back.
If I may,
I'm going to come back to you.
Sentence.
Sure.
Finish this, because like ISRO, what they have done is they have developed private partnerships by giving out the technology that they have developed. And what I see is that is likely to be a more, feasible mold for cooperation as far as India is concerned. Now, getting the private sector in is a major aspect of this bill, but we have to see how it goes.
All right, let's also get in Karthik once again. Karthik, do the rules and regulations as envisaged in this bill, do they align with global standards?
Belatedly, yes, right? I think it's taken a while for us to sort of come around to say that we will interpret civil nuclear liability the way the rest of the world does, in the way that liability is limited to certain parties and does not extend to the entire list of suppliers that have likely come in of key components. And they've also limited it to ensure that there is a cap on it, right? Ultimately, and of course, there will be a pool that is created to then facilitate the payments in the event of, cases where actual disasters happen, for instance, like the Fukushima one. But of course, the interesting part is that India is now looking to scale nuclear technology in an era where we are looking at passive safety in a big way, where such disasters that have passed are precluded inherently by the design of nuclear reactors. And India will likely benefit from all of these developments. And it's a good time for us to, I think, get on the same page as the rest of the world in the way we interpret nuclear liability. Granted, India has had a bad experience, for instance, in the case of the Bhopal gas tragedy, which of course resulted in such a conservative interpretation of allowing a foreign entity to sort of go scot-free at that moment. But I think the bill currently addresses a lot of that and brings it on par with the rest of the world. And I would like to say this, though, that it is very important that we actually involve the foreign participants, primarily because we haven't demonstrated the appetite to finance nuclear energy at the scale at which it's required. And it's very likely that the use of the technology that Ms. Shankar also mentioned, which is the indigenously developed one, or at least what has been demonstrated so far, can help us scale the barriers that we've faced so far in getting up to the 5 gigawatts a year, which we will require. We are currently at 9 gigawatts after nearly a 3-decade program. So foreign participation is almost imperative. And what really remains to be seen is, can we think strategically and ensure that we bring in foreign participation, negotiate hard for costs that actually represent the cost of technology, and more important, something that actually cost effective. Yeah.
Right. Karthik, my final question to Ambassador Meera Shankar. Ambassador Shankar, now, when it comes to getting those investments, what more reforms on ease of doing business we need to do in order to attract global players? And despite the fact that this was a continuing conversation with the United States, do you feel that under the current Trump administration, which is all about investing in America, will the US companies look at India in a big way now that this 49% FDI route has been opened up?
Well, they are certainly showing interest, if I may say so, because India would be a large market. And if we are looking at really going to zero in terms of carbon emissions, then nuclear energy has to become a very important part of that basket, because renewables can be intermittent, and to stabilize as a baseload power, you would need nuclear energy rather than thermal, because this could provide that stabilizing source of energy. But, we wasted, I think, almost a decade since the nuclear, agreement was signed, civil nuclear agreement was signed with the US. In negotiating with foreign partners, we did not sanction a single Indian nuclear power plant. And the net result is our own nuclear energy program has been starved of funds. So I think it's something we have to wait and see. I don't know how it will go, because we had identified 2 sites, one for the French possible nuclear reactor, and 1 or 2 sites for the American reactors. But none of the negotiations proceeded. The only ones which did were with the Russians for Kudankulam, where 2 power plants are now operating, 2 are on the verge of commissioning, and 2 more are going to be, in the pipeline. So a total of 6 large projects were commissioned in Kudankulam, but the talks with other partners did not make headway, as I said, for a variety of reasons, including nuclear liability, but costs were a major factor. Unwillingness to share technology was a second, and third was, how to involve Indian partners in that process.
Right.
So the whole
so
idea
lots on the table.
Sorry.
Yeah, so Ambassador Shankar, I've completely run out of time, but thank you very much for explaining to us some of the diplomatic and historical reservations that global players in the US and France had. Let's see if those earlier MOUs and relationships can now be renewed as a result of the changes in law that we are bringing about in India. Thank you very much, Karthik and Ambassador Shankar, for joining us. We're taking a short break, but coming up, the Union government has proposed a new higher education bill in a bid to tackle multiplicity of regulators and approvals. More details on that when we return. Stay tuned. Union Education Minister Dharmendra Pradhan has introduced the Viksit Bharat Shikta Adhishtan Bill in the Parliament, aiming to overhaul India's higher education system. The bill proposes a single overarching higher education commission supported by 3 regulatory councils. The bill has now been sent to a joint parliamentary committee for a detailed review and recommendations. The new 3-council structure will act as the sole regulator for higher education. It will be responsible for outcome-based accreditation, setting academic standards and granting greater autonomy to institutions. Members of the 3 wings will be appointed by the centre through a 3-member search panel. The bill also outlines strict penalties. Institutions violating provisions could face fines ranging from 10 lakh rupees to 30 lakh rupees to even 2 crores, while repeat offences may attract penalties of at least 75 lakh rupees or suspension. Setting up a university without government approval could draw a fine of up to 2 crores. As I said earlier, the proposal has sparked strong protest from the opposition. Several lawmakers warned that it could undermine institutional autonomy and lead to excessive centralization of higher education. To take this now forward, I'm now joined by R. Subramaniam, former Secretary of Higher Education and Social Justice. Thank you very much for joining us, sir. Do you think having an umbrella organization for all the regulatory approvals is the right way forward? Was this reform really needed for the higher education sector?
Parikshit, yeah, it is. It has been debated for a long time. And one of the reasons why we have a very disjointed academic structure in the higher education has been the multiple regulators. This is a problem which institutions have faced, which has depressed the interest of the private sector, and also in many cases it has done little benefit for improving the academic standards. So as you know, in the NEP 2020, this has therefore figured as a prominent recommendation that we need to have a single regulator. So it has been on the table for a long time. I think it is absolutely necessary.
Right. And when it comes to the grant disbursal, this will now, as per the bill, be taken up by the Ministry of Education. Many in the opposition have raised complaints that this is not the right thing to do. The government can't take up the issue of granting money to organizations, to institutions. What do you think is the right way forward? Is this the right step? The bill has now gone to a parliamentary committee.
It is the right step, because even now the grants for the higher educational institutions, especially through PM Busha and schemes like this, is being still made through the ministry, and ministry being responsible to parliament for the expenditure of the grant. I think it is absolutely essential that the grant making power remains with government. I think on that we have no doubt, and government has been releasing money to various institutions, to the state governments under various schemes. I don't think we should find fault on this particular count. There could be many areas where it can be improved.
Where do you think we need improvements or greater deliberations, and why do you think the government found it justified to first refer the bill to a parliamentary committee for greater discussions?
I think it's this is a bill which has to really replace dictatorship with the deliberation. We need to have a regulator who builds consensus, not tries to control, because there are state governments which are spending a lot of money, more money than what central government is spending on higher education, and their views should be heard. So therefore, it is very right thing that further discussion is required on this, and the concerns of the state governments should be brought into the bill explicitly, so that they feel comfortable, because they control nearly 90% of the institutions in this country.
Right. As far as the penalties go in terms of violations, they can go up to almost 2 crore rupees. Closure of the institute can also take place. Is this something in line with global standards? And also the point about getting foreign universities to participate in the Indian education story. Will these new regulations make it more attractive for foreign universities to enter?
Foreign universities have been lining up to enter the Indian market, and there has been a lot of interest of late, especially. But of course, I think for me personally, I feel that it is necessary for Indian universities to set up campuses abroad. because that will only come under educational export, and foreign universities coming into India is an educational import. So to that extent, foreign universities clamor to come to India would be there, but it should be properly regulated, because we don't want any universities to come and set up campus. If there are top line universities ranked in the top 100 in the world, I think they should be welcomed definitely, and they can set up campus. That will also send some sort of a signal to our own top institutions on the global standards. So it is only for that purpose we should really look at getting foreign universities. But definitely a number of Indian universities want to set up campuses abroad, and this regulator should facilitate that, because that is very important for spreading the India's soft power abroad.
All right. Thank you very much, Mr. Subramanian, for joining us to speak about the new higher education bill, which builds an umbrella organization to grant the regulatory approvals to higher education institutions in the country. That's all we have time for here on News Center. Goodbye and thanks for watching.
Welcome to Newsmaker. I'm Yash Jain. A long wait of 4 years for the Indian insurance sector comes to an end with the Insurance Amendment Bill finally being tabled in Parliament today. The bill, which is called Sabka Bima, Sabki Raksha, makes changes around foreign investments, around commission limits, investment regulations, merger regulations in India's insurance sector. In fact, the bill is so important that what's not taken up by this insurance bill has also become a big talking point, and that is open architecture as far as insurance sector is concerned. Now, to discuss the insurance amendment bill and more, we are joined by two individuals, both of them very deeply connected with the insurance amendment bill. We are joined by Saurabh Mishra, who is now partner of financial services insurance leader India at Carney. In his previous stint as the Joint Secretary of Department of Financial Services, he authored the original draft of what is now the Insurance Amendment Bill. We are also joined by Mr. Dinesh Khara, former chairman SBI, but more importantly, the chair of the committee tasked with the responsibility of giving feedback on the Insurance Amendment Bill. First of all, both of you gentlemen, thank you so much for joining us today on such an important day. Mr. Mishra, I want to start with you first. I think we'll have some time before we can have Mr. Mishra join us as well. But to start the discussion with Mr. Khara, there were certain recommendations, certain suggestions, feedback, which the committee that you are, of course, chairing on Insurance Amendment Bill had provided to the insurance regulator. Now, what you see as the Insurance Amendment Bill which has come through, does it largely resemble the feedback and, your takeaways that you had given to the insurance regulator, or does it fall different from those feedback?
I think I would like to comment upon the contents of the insurance bill per se. And I would say that when it comes to inviting 100% of the capital for the insurance sector, this will go a long way, particularly, when we look at it, if at all FDI is something which is of interest to India, perhaps this would have been the best of the sector, where we could open up the sector for 100% investment by the foreign investors. For two reasons. One, of course, we have already seen that almost 80,000 crore worth of money has come into the insurance sector, when it was actually up to 74% of the capital could have been brought in by the foreign investors. So I think with the opening up of the sector, and I would say that maybe the potential to invite the foreign direct investment will go up significantly. So that is a very major plus. The second aspect is that, when it comes to introducing newer product lines, the innovation which is there across the globe can be put to application here in India also with the help of these foreign insurance companies. So I think that is the other major plus. And particularly when we look at it, when it comes to the penetration level, from 3.7% odd penetration which is there as compared to GDP, and as far as insurance is concerned, and we have started talking about the insurance for all by the year 2047. We actually need to bring in the newer vehicles. And I think on that particular count, this bill is a very welcome development.
Thank you so much. Mr. Mishra, before you joined, I was just, addressing you as someone who had authored the first draft of this bill. Now, 4 years ago, how you had imagined the Insurance Amendment Bill to be, exactly the constituents that you had put in that draft, and today, what has come through in the form of this bill being tabled in front of the Parliament, is it largely on the lines that you would have expected it to be? And what are some of the differences that you would point out where you think, we could have gone and added those points as well?
Thanks, Yash, and thank you for inviting me on this forum. First and foremost, my sense is that the bill largely keeps intact the spirit which was behind it when we talked about an overall excitement in the market in terms of investors coming in terms of the financial protection by way of insurance being the primary vehicle being utilized, and obviously to top it all, how can we then take it forward in terms of unleashing some of the innovations, technology, and risk models that the insurance need to present itself? So I think it largely captures each one of those elements. The areas of FDI in 100% availability will obviously unleash some of those players who are kind of waiting in the wings once they wanted to get the full empowerment with regard to their investment, their capital, but equally in terms of how they want to operate into the risk of insurance, they want to operate into the product of insurance, and they want to also operate into the technology around that. So to my mind, that is a big positive. The other part, which is equally important, is the Section 27 of the Insurance Act 1938, which hitherto kept most part of the securities which as Chief Investment Officer and his entire office operates into from the insurer perspective, which was largely categorized or mandated as approved securities, that gets unleashed to give the CIOs of insurance companies the power to write the story in terms of better returns, something which insurance has traditionally been criticized vis-a-vis their competing long-term savings products and so on. So I think CIOs have a great play, which fills back the efficiency of investment and back to the policyholder in terms of what can be expected on that.
Mr. Mishra, you rightly pointed out, of course, the investment regulations and the way the game changes there will be very big element to watch out for. But before I come to that, I want to start with the headline of the bill itself. 100% FDI being allowed, as far as the insurance sector under automatic route is concerned. Now, what will be very crucial would be the regulations under 100% FDI. In your sense, how should the regulations be designed to ensure that foreign players do get a free hand in terms of operating into the Indian space, but at the same time safeguarding a very, very sensitive sector like insurance for policyholders?
Thanks, Yash. So I think first thing first, we called out Section 27E remains unchanged, which talks about that any money which is invested by the insurers stays with them, and the only route to get it back in terms of the rewards out of the investment that they've done for a long-term sector like insurance is by way of the dividends through the profits which they earn in a very in a regulated environment through the IRDAI. So that is a huge protection or a clear-cut guidance that the premiums which are invested here remains in the country no matter what. The other piece about the empowerment which is given to the insurers and through their chief investment officer or the insurance investment policy that is written at the board level as well for their vetting and so on, is about the fact that now the actual investment can go much beyond the GSEX and the state SEX, which obviously are mandated to a certain extent and necessary for the long-term capital growth story of India. But a large part of it will also start getting the regulation, which can be about the traditional investments, the alternative investments, obviously with the very clear regulations around those areas so that the policyholders' money remain in tandem with the way the outcomes happen from the maturity of the long-term proceeds like life insurance. Even for the health insurance sector, there is a clear-cut ALM sensitivity which needs to be managed. So to that extent, I think the regulation needs to nuance those aspects so that the cash flow remains equally important, and so does the underlying investor protection or policyholder protection, as we call it.
Correct. Mr. Khara, I want to come to you with two important points. One is open architecture for individual agents, which has been dropped. On the other hand, proposal to allow merger between insurance and non-insurance companies, which has been taken up and approved. On both these counts, the committee, which was, of course, appointed by the regulator on open architecture, we understood that the committee was of the view that the choice should be with the agent if he wants to tie up with more than one life or one health or one general insurance company. At the same time, we understood that the committee was of the view that if merger between an insurance and a non-insurance company is allowed, it could have undesirable consequences. Things have gone in different directions on both these two important points. How do you view these two important points now that the bill is out and approved?
No, well, it comes to insurance agents, I think the regulations already permit, IRD already permits almost about 8 or 9 companies. They can 8 or 9 companies can actually join hands and distribute their product through a particular bank. So I think on that particular count, there is enough flexibility which is already available. And but having said that, I must also mention that when it comes to insurance agencies, you know, it's a very important component of the distribution network. And the older companies have certainly invested into this distribution channel, whereas the younger ones are not really investing into this distribution channel at all. But we are all aware that when it comes to insurance, very often it involves a lot of marketing also on the part of the people who are there to sell the product. So actually, it involves a lot of convincing, a lot of education on the part of the beneficiary. So it's a channel which needs to be built. So I think in all fairness, if at all a particular company has invested into creating this channel, so he has, he can actually decide in terms of what they would like their insurance agents to do. So I think on that particular count, it's a welcome suggestion. But having said that, it has when it comes to distribution network to be broadened, the IRDA already permits that. Almost about 8 such banking institutions they can tie up with. So this will be really maintained. So the other piece is the merger of the non-insurance with the insurance. There also, I believe, the regulation can come in where they can probably lay down that, if at all any such thing happens, what are the precautions which needs to be taken and how they will ensure that the liabilities of the non-insurers should not really get into the insurance companies. There can be a firewalls which can be created to really address this concern also.
Absolutely. As of course you pointed out, a lot of these regulations which are to be taken will require very finer, detailed guidelines and framework to ensure that they are implemented in a very safe way, so that there is no adjoining risk which arises either through merger or the proposal of open architecture being dropped. But on that note, we'll take a very short break. But let me just thank Mr. Saurabh Mishra as well as Dinesh Khara for their important views, for their very enriching views as far as the insurance amendment bill itself is concerned. On the other side of this short break, we would be joined by two industry veterans, companies which will be responsible for taking these insurance amendments forward and implementing them in the industry on ground as far as the sector is concerned. Welcome back to the discussion on the Insurance Amendment Bill. Now, in this segment, we're joined by two large insurers, one private and one public. We're joined by Tarun Chugh, the MD and CEO of Bajaj Life Insurance, and R. Doraiswamy, the MD and CEO of LIC. Tarun, to start with you, the bill is certainly big, about 66 pages. But is it beautiful for the insurance industry? Does it bring you everything that you wanted to see yourself growing onto that journey towards 2047 insurance for all?
Thank you for having me, Yash. I think the bill is near perfect, if you ask me, in terms of the things we asked. And I'll just maybe clarify where all, particularly. The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. Second, the bit on the composite license, though, is not entirely clarified, but it does give that point number 5, where IRDA maybe has given some rules to clarify as to what are these entities going to be. I guess IRDA is looking for various ways in which they can mesh together their existing business and their new businesses. So that will new companies that will come in. So maybe a life insurance company, will it be really finding it synergistic to do all of general insurance? I'm sure they must have found a lot of doubts there, because even we feel that there may not be an entire need for doing that. So maybe what businesses go with which ones is what will help understand from when IRDA clarifies all these bits. On the fact that the investment guidelines have been made a lot easier is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get early investment, and not just do they gain, but even we gain at the same time.
Correct.
There are quite a few other situations where they are talking about more clarifications and guidelines to come from IRD. So they've got a lot of things to do there, really.
Absolutely.
Including the commission ask, which they will come up with some clarifications. The industry awaits that. And of course, the strengthening of the Life Council, the EC of the Life Council, is also a welcome sign.
Well, absolutely. You pointed out all the important things, and I'll come to each one of them. But before that, Mr. Doraiswamy, thank you so much for joining us this evening. The big news for LIC is, of course, that open architecture has been dropped. LIC gets about 92% of its new business premium from individual agents. As far as open architecture is concerned, what was the risk that could have come if it was to be introduced? How big of a risk has been averted since it's not a part of the bill? And what were your arguments to the government to not bring open architecture when the consultations itself are going on?
Good evening, Yash, and thanks for having me on this show. I look at this bill as a very, very progressive act from the government. They have taken a very good step towards taking life insurance, or for the matter, insurance for all by 2047 possible by doing this this bill. I'm sure a lot of things have been done. You talked about open architecture. Yes, we have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at. But looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies, and going and presenting the right product to the customer. It was not going to be an easy task. So from the individual agent's point of view, it was not an easy task to tie up with more than one life insurance company. And it was always expected that an agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said. We are a very large organization with more than 14.8 lakh agents serving us. Most of them are more than agents to us. Though the relationship is that of agent principal, they have been getting a lot more benefits for standing for a longer time with us. And it benefits the organization as well as the end customer that the agents will continue to represent one life insurance company.
Absolutely. One question as far as the commission limits are concerned, and this question is to both Tarun and Mr. Doraiswamy. IRDAI has been empowered by the government to set limits as far as commission is concerned. Also, insurance companies have been asked to detail their expenses of management. I want to understand both of your views, starting with Mr. Doraiswamy. Do you think that the commission levels in the insurance sector are very high and needs to be brought down, and there is a chance that limits could come back on commission again from currently where they are at expenses of management level?
Yes, you are aware that there was a commission regulation earlier, and IRDA had put caps on commission depending upon the types of product, the line of business, as well as the premium paying term of the policy. They were already there. It was subsequently relaxed, and the insurance companies were given the liberty to have their own commission structure, but falling well within the overall expenses of management limit that was fixed by the regulator. Now the Act enables, or rather puts a provision where the regulator can come back with a cap on the commission, or they can even have a clear directive as to what kind of commission structure should be there for different lines of business within life insurance as well as for all forms of insurances. That is a very good step in the direction towards the customer welfare. That's very important. Two, what will happen? There is going to be a lot of transparency that is expected to be brought about in the current bill that has been introduced. I'm sure this entire thing will be in the interest of the industry, particularly in the interest of the customer. The customer will be very clear as to what he is buying and how much is going to be the expense under that product that he is buying. That is going to allow him to make a very informed choice of taking a product. Yes.
Absolutely. Final word to you, Tarun. Do you think commissions are very high? As IRDAI chairman, we understand, has also been saying, and we also understand that there's a committee which has been formed, and the industry could very well move towards deferred commission model. Could you help us understand that particular objective?
Yeah. See, it's a good discussion to have whether the commissions are high or not. Fact is that if you look at the way commissions are defined is the issue. Usually commissions are defined more as the first year commission, and the renewals are very, very little over a period of time. So while you keep getting the money over a period of time, if you do the sum of parts of all of the money received by an advisor, it actually over a period of 5 to 10 years is not entirely so high, I believe. But yes, if there is regulation where kind of it is mandated that they're more deferred than upfronted, it will be lesser of an eyesore is the way I see it. I think it is more optics there as well. Because all said and done, Yash, globally, commissions are more upfronted because the product is difficult to understand, explain, and service. And that's how it is being structured. India's commissions are actually lower than most. But having said that, I welcome the fact that there is a overall commission discussion that is going to restart, and the chance of it being deferred should be welcomed as well. Let's see how the transitioning happens. The issue is always in the first year transitioning, and I think people have their own business models. You just see how the IRDA helps the industry or handholds the industry in this regard.
Well, absolutely. You know, it's been a short discussion with the two gentlemen, but a very, very valuable one. And thank you so much for that, Mr. Duraiswamy, as well as Mr. Tarun Chugh. But on that note, it's time to conclude this very interesting discussion on the Insurance Amendment Bill. Thank you so much for joining us, all our viewers. News and updates will continue on the other side of the short break.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The rupee slips to a record low, breaches 91 against the dollar for the first time ever. Sustained FPI selling and uncertainty over the US trade deal weigh on sentiment. The rupee is down 6% this year, which is the biggest fall among emerging market currencies. The Sensex and the Nifty decline after a broad-based sell-off. The Nifty drops below 26,000. Mid-cap sees sharper cuts. Finance Minister Nirmala Sitharaman tables the Insurance Amendment Bill proposing 100% FDI in the sector. The regulator can set limits on commission for agents and intermediaries. Composite license not part of the bill. Opposition parties oppose the legislation, saying it will weaken state-run LIC. The government tables a new bill to replace the MGNREGA, India's flagship rural employment scheme since the last 2 decades. Guarantees 125 days of wage employment per household instead of 100. Also imposes 40% additional financial burden on most states. Opposition criticizes the shift from demand-based to normative funding and the government's obsession with renaming schemes, among others. Big positive for Vedanta. The NCLT approves the metal giant's demerger plan despite the government's objection to the plea over their claims of being put to risk. The stock up 3% after the NCLT clearance comes through. Quick commerce firm Zepto gets ready to go public. Sources say the company is likely to file papers with SEBI this month, hopes to raise $750 to $800 million. Fog in North India impacts travel plans. Over 100 flights impacted at the Delhi airport alone. 13 dead after multiple vehicles collide on the Delhi-Agra expressway as dense fog affects visibility. Delhi's air quality improves marginally but remains in the severe category. Ford will take a hit of over $19 billion, primarily tied to its electric vehicle business, and shift focus to hybrid vehicles. This is amongst the largest impairments taken by a company and a major reckoning for the auto industry's electric ambitions. President Trump files a defamation lawsuit against the BBC demanding $10 billion in damages, accuses the broadcaster of producing false and malicious depiction of President Trump in a documentary a week before the 2024 elections. Australian all-rounder Cameron Green becomes the most expensive overseas player in IPL history. Kolkata Knight Riders break the bank to shell out over 25 crore rupees, but Green will take home only 18 crores after BCCI puts a limit on salary for foreign players. Well, let's go straight to the top story this evening, and that is the rupee. It has slipped to another record low, breaching the 91 mark against the US dollar for the very first time. Now, sustained foreign fund outflows and uncertainty over the India-US trade deal continues to weigh on the money market. The rupee is weakened from 90 to 91 against the greenback in the last 10 trading sessions. In fact, the rupee has declined by 90% against the dollar in the last 50 years. In 1975, one US dollar would cost 9 rupees. In 1993, a couple of years later after liberalization, the rupee weakened to 30 against the dollar. By 2013, the rupee had breached the 60 mark. In the last 12 years, the rupee has seen its sharpest decline, falling from 60 to 91 against the dollar. Latha joins us now with more on the fall in the rupee and its implications. Latha, the way that we've gone from 90 to 91, what do you make of that, as well as what the likely implications will be from here on?
The reason for the fall of the rupee is really capital flows. We have seen, persistent, consistent selling by FIIs of all hues. It's a 17 billion sellout year to date. And what we are now picking up is from December 4th, you would have seen the FPI data. Debt FPIs are also selling out. And this month, we have an $800 million plus, probably $850 million sell from the FPI debt owners as well. So that is the fundamental reason. One was expecting that when the trade data came, the sentiment in the market would improve, but it hasn't. It's clearly that the fact that there's, for instance, trade data, good or bad, Prudential at the end of the last day of the IPO would have sold the money it got for, spot today will be delivered day after tomorrow. So that sell would anyway happen. Therefore, we shouldn't be surprised that despite the good news on the trade data, there are some FPIs who are still on exit mode. Now, what has added to the accelerated pressure that we are seeing in the past 3 weeks is most importers were not prepared for a 90-plus situation. Therefore, they're probably mentally okay with a loss, with a depreciation of 3% annually. But more than that has taken them by surprise. And we are seeing importers hedging in a very big way. Almost every banker I spoke with said that, corporates are phoning us and asking for hedges, buying hedges or buying dollars. Likewise, even sovereign wealth funds, etc., who are in India, may not have thought of hedging all these days, but when you see a rapid fall, they also come to the market. That explains the accelerated pace that we are seeing in the last few days. Well, it's taken people by surprise. The only point is, why is the Reserve Bank not in? My own sense is that they want the rupee depreciation to correct the trade deficit, which apparently has worked. I mean, what is the big difference between November and October? The rupee was cheaper, and therefore perhaps exports did that much better, 10% better than in October. So that is working for the real economy. If the real economy is not hurt, but in fact helped by the rupee fall, perhaps the Reserve Bank cannot be faulted for the stance it is taking. The moment they see real economy, investment intentions, or something seriously destabilizing in the real economy, we should expect them to use some of the arrows in their quiver. But otherwise, I think at the moment it is working for them. It's not even going to increase inflation because inflation is at abysmally low levels. It seems a logically very good step to let the rupee find its own level.
Well, will we continue to see the RBI stay hands-off, or will there be intervention? We will have to wait to see. Latha, many thanks for joining us. Meanwhile, for the equity markets, a broad-based fall on the Lal Street, with the broader markets witnessing more pain. The Nifty and the Sensex fell 0.5% today, with the Nifty closing below the 25,900 mark, 167 points lower, 500 points lower on the Sensex. The Nifty Bank was down by almost 1%, and the Nifty Mid-Cap down by about 500 points today. The mid-cap index underperforming the blue chips this afternoon. Realty and bank stocks taking it on the chin. But let's talk about the IPO markets. Quick commerce firm Zepto is getting ready to go public. Sources say the company is likely to file its papers with SEBI this month and hopes to raise $750 to $800 million. Shruti is here with more details. Shruti, we were expecting this to happen earlier in the year, but it now looks like early next year.
Absolutely. Grocery delivery startup Zepto is preparing to file its draft IPO papers as early as next week. Sources tell me the company could look to raise $750 to $800 million via a confidential filing route. Now, the move comes amid strong operating momentum. Zepto's last fundraise, announced in August this year, valued the company at about $7 billion. Since then, order volumes and net sales value have risen 45% over the past 6 months, with the platform now handling nearly 2 million orders a day. Sources also tell me the company is working with a clutch of domestic and global investment banks, including Morgan Stanley, Goldman Sachs, Axis Bank and Motilal Oswal. There are also signs of improving unit economics. Burn has moderated, driven by higher store throughput, supply chain automation and lower customer acquisition costs. Sources add Zepto is sitting on a cash balance of nearly 7,000 crore rupees, potentially making it one of the best capitalized new age companies heading trading to the public markets. Remember, founded during the pandemic, Zepto has emerged as one of the fastest growing players in India's 10-minute delivery segment, competing with Blinkit, Swiggy, Instamart and Tata-backed Big Basket. Over to you.
All right, Shruti, many thanks for joining us. That's Zepto getting ready for its IPO. But a big story from Parliament. Finance Minister Nirmala Sitharaman tabled the Insurance Laws Amendment Bill in the Lok Sabha today. The bill proposes to allow 100% foreign direct investment into the sector. This is not new. It's been on the table for a while. It also imposes limits on commissions for both agents and intermediaries. That caused some concern. The bill seeks to allow mergers with non-insurance companies, but the composite license is not part of the proposed legislation. Opposition parties protesting in Parliament when the bill was introduced, alleging higher FDI will weaken state-run insurer LIC. Here's the Finance Minister introducing the bill.
Many of the points, sir, are very much a part of what the discussion could be on. And therefore, to object to the introduction, at the introduction stage itself, questions the legislative competence, and I don't think there is a question on the legislative competence of the government to bring this into this House. Commissions for LIC agents, very much a part of what we are going to discuss. And in fact, let me even give one point already on that. Fixing commission for LIC agents is already a part of the regulator in the sense that he fixes the upper cap.
Well, that is the Finance Minister. The government also tabled a new legislation to overhaul the MGNREGA, India's flagship rural employment scheme for the last 2 decades. Amidst opposition protests, that is, the new bill, the Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin, mandates an increase in guaranteed employment days to 125 days from the current 100 days. The legislation also proposes a higher financial burden for most state governments. At present, the centre bears 100% of unskilled labour costs and 75% of the material costs. Under the new framework, 40% of the total cost will be borne by all states except the northeastern and Himalayan states and the Union Territory of Jammu and Kashmir. The bill also seeks to alter the process of budget allocation. The central government will provide a fixed allocation and states will lose the flexibility that they currently have to propose budgets based on anticipated demand. There were protests from opposition benches when the Rural Development Minister Shivraj Singh Chauhan tabled the bill. Higher financial burden on states was a key point of contention. Opposition lawmakers have also questioned the decision of the government to rename the bill by dropping Mahatma Gandhi's name and held protests outside Parliament. Rahul Gandhi says the Congress party will fight tooth and nail to oppose the bill.
पता नहीं क्यों जी राम जी नाम आ गया तो ये भड़क गए। महात्मा गांधी स्वयं राम राज्य की स्थापना की बात करते थे और उनके अंतिम शब्द भी हे राम थे। बापू जी का पूरा सम्मान करते हुए राम राज्य की स्थापना, हर गरीब को भरपूर रोजगार मिले, उसकी गरिमा को सम्मान हो, दिव्यांग, बुजुर्ग और महिला, अनुसूचित जाति, जनजाति, उनको और प्रोटेक्शन दिया जाए, इसके लिए ये बिल लेके आए हैं। 125 दिन की गारंटी है, गारंटी।
बिना चर्चा के, बिना इस सदन की सलाह लिए इस तरह से जल्दी में विधेयक को पास नहीं होना चाहिए। गहन जांच पड़ताल और व्यापक चर्चा के लिए इसे कम से कम स्थायी समिति के पास भेजा जाना चाहिए और कोई विधेयक किसी की निजी महत्वाकांक्षा, सनक और पूर्वाग्रहों के आधार पर न तो पेश होना चाहिए और न ही पास होना चाहिए।
And staying with Parliament, the government has also tabled a bill to open nuclear energy sector to private companies. The bill has been called Shanti, or Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India. Now, this bill will allow private companies and joint ventures to build, own and operate nuclear reactors. This will effectively end the government's monopoly in nuclear energy. The government is also proposing to create a unified legal framework and allow 49% foreign direct investment. The new legislation will replace the Atomic Energy Act of 1962 and the Civil Liability for Nuclear Damage Act passed in 2010. The larger goal of the bill is to achieve the 100 gigawatts of nuclear power capacity by 2047. What has sparked a controversy is the clause on liabilities. The bill elaborates operators shall be liable for damage except those caused by grave natural disaster of an exceptional character. Liability is also exempt during any armed conflict, civil war, insurrection or act of terrorism. Up next, a big sigh of relief for Vedanta after the NCLT gives the metal giant's demerger plan a green signal. That and more when we return. You're watching Business 360, a quick check of some of the other headlines that we're tracking for you. A nightmare for commuters across North India as fog impedes visibility, leading to reports of accidents and vehicles piling up on highways. In a tragic incident, 13 people were killed after multiple vehicles collided on the Delhi-Agra expressway near Mathura. Several vehicles caught fire after the collision. The national capital remains in the grip of hazardous air conditions, even as the situation has improved slightly from yesterday. The AQI peaking to 383 early morning today. At least 100 flights were cancelled at the Delhi airport on account of the fog disruptions. Over 58 lakh names have been deleted from the West Bengal draft voter list on the back of the special intensive revision carried out by the Election Commission in the state. The poll regulator released the list earlier today. Out of the 58 lakh names deleted, over 40% have been marked as dead. The revision drive will continue until February 2026, with the final list expected ahead of the assembly elections next year. The Indigo Pilots Guild and the Federation of Indian Pilots have approached the Delhi High Court seeking contempt action against the DGCA over exemptions to flight duty time norms. The court will examine whether the regulator is liable, while the DGCA says it has the power to grant exemptions and that the relief is valid only till February. Vedanta soared 4% after the National Company Law Tribunal approved the metal giant's demerger plan. The green signal came despite the government's objection to the plea over their claims being put to risk. Ashmit is here with the details. Big relief coming in for the Vedanta group with the demerger plan being given the go-ahead. Ashmit.
Well, a big sigh of relief for Vedanta, a big win coming to them from the NCLT. The NCLT waving the green flag, granting the sanction to Vedanta's demerger scheme. Now, this is clearly a scheme where Vedanta was looking to split the company up into smaller, more industry-focused units, and that is a scheme that this NCLT approval paves the way for. Now, what's important is that this journey was not without its hurdles. There were objections raised by the government. The government had raised all of these concerns. One of the concerns that had been raised is that there are claims of over 16,700 crore rupees pending against Vedanta. The government's concern was that the consolidated single entity has a very large asset base, but that the smaller demerged entity will have a much smaller asset base, and therefore that would expose the government's claims to risks. Vedanta had responded by saying that even the demerged entity will have an asset base that would be 1.8 times the total government claims of 16,700 crore rupees. That's one. Another concern that the government had raised was with respect to alleged lack of disclosure. What the government had said is that there are amounts that are locked in litigation. There are disputes currently underway before arbitration, that the total payout by Vedanta could be anywhere between $200 million to over $1 billion, and that has not been disclosed to public shareholders. In response, Vedanta very clearly said that as per the law of the land, they're only required to disclose dues that have been confirmed by way of a court order or an arbitral award, not amounts that are locked in litigation. And there appears to be these arguments by Vedanta appear to have managed to break the ice with NCLT granting its nod for this demerger scheme. We'll of course now have to watch whether or not the government, by way of the MOPNG, chooses to challenge this before the NCLAT.
Ashmit, many thanks. In international news, the Nasdaq is set to file plans with the US Securities and Exchange Commission to introduce a 23-hour trading day for stocks. According to Reuters, the move is aimed at tapping into growing global demand for US equities. Investor appetite for near round-the-clock trading has surged in recent years, prompting regulators to introduce new rules and approve extended trading proposals from major exchanges. Now, Ford Motor will take a $19 billion hit as it scales back several electric vehicle models amid slowing demand. The automaker will replace the fully electric F-150 Lightning with the new extended range electric model that uses a petrol engine to recharge the battery, and will scrap its next generation electric truck. Ford says it's pivoting aggressively towards gasoline and hybrid vehicles. This is amongst the largest impairments taken by a company and a major reckoning for the auto industry's electric ambitions. Fintech giant PayPal has applied to become a bank in the US. If it gets the approval, the move would allow the company to offer loans to small businesses and interest-bearing savings accounts to customers. PayPal, which also owns the popular payment app Venmo, already provides credit lines and has been steadily expanding its suite of banking-like services. The push comes as the fintech firms intensify competition with traditional brick-and-mortar banks. In fact, Amrish Rao of Pine Labs told me just a few days ago that customers trust fintechs more than banks today, given that more of their transactions happen on the fintech layer, and why he believes digital banks will be part of India's future as well if the regulator gives the go-ahead.
I believe that 3x the number of transactions that banks and financial institutions are doing are being done by fintechs in India. There will be serious competition. In fact, right now when I'm getting to see that 3x the transactions are happening on fintech apps, I genuinely believe that we've already passed that argument. Consumers have given the answer that I'd rather operate with a fintech than operate with a bank or a financial institution. Going forward, if this gets opened up, there is a real chance that banks will then become warehouses of money, while the transaction layer would be with someone else entirely. So yes, I do believe that consumers have actually let it know that they would rather prefer a company which is giving them the best UX.
Well, digital banks, are they here to come? With that, it is time for us to wrap up this edition of Business 360. The news will continue right after this break. Stay tuned to CNBC-TV18. We're back in a moment with plenty more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Quick commerce firm Zepto gets ready to go public. Sources say the company is likely to file papers with SEBI this month, hopes to raise $750 to $800 million.
InsurTech platform Turtle Mint has received regulatory approval from SEBI for its public issue. Turtle Mint confidentially filed DRHP with the regulator in September. While the size of the public issue would be clear after the startup files its updated DRHP, the issue is set to be in a range of $200 million to $250 million.
Quintrans, a deep tech engineering startup, has raised $750,000 in a pre-seed funding round led by Capital A. The proceeds will be used to establish an in-house manufacturing and advanced testing facility in Pune, accelerate R&D across electromagnetic actuation, and build the core engineering and operations team required for commercial rollout.
Beverage startup Swizzle has raised 2 crore rupees in seed funding round led by angel investors. The capital will be used to expand distribution across quick commerce, vending machines and mass retail.
Arya AG has reported a strong first half for FY26 with profit before tax rising 39% year-on-year to 32 crore rupees. The integrated grain commerce platform also posted 28% growth in net revenue to 451 crore rupees, driven by steady momentum across its storage, fintech and commerce businesses.
Those were the headlines that we're tracking for you this evening. But on What's Brewing today, Shruti, you're tracking the story. Quick commerce firm Zepto is all set to, go file for its DRHP, right? Which is likely to happen in this month. It's around $700 to $800 million.
That's right, Arundhati. Grocery delivery startup Zepto is preparing to file its draft IPO papers as early as next week. Sources tell me the company could look to raise $750 to $800 million via a confidential filing route. The move comes amid strong operating momentum. Zepto's last fundraise, announced in August this year, valued the company at about $7 billion. And since then, order volumes and net sales value have risen 45% over the past 6 months, with the platform now handling nearly 2 million orders a day. Sources also tell me the company is working with a clutch of domestic and global investment banks, including Morgan Stanley, Goldman Sachs, Axis Bank and Motilal Oswal. There are also signs of improving unit economics. Burn has moderated, driven by higher store throughput, supply chain automation and lower customer acquisition costs. Sources add Zepto is sitting on a cash balance of nearly 7,000 crore rupees, potentially making it one of the best capitalized new age companies headed to the public markets. Founded during the pandemic, Zepto has emerged as one of the fastest growing players in India's 10-minute delivery segment, competing with Blinkit, Swiggy, Instamart and Tata-backed Big Basket. Continuing with our focus on what's brewing today, we bring you a startup stepping out of stealth with a clear ambition to reimagine the everyday devices we live with. Everyday Design and Technology, or EDT, is a new generation consumer appliances brand that has just launched with a $1.4 million pre-seed fundraise. Now, the round is led by Sauce VC and backed by a marquee lineup of consumer and manufacturing leaders. EDT says its appliances go beyond function, blending thoughtful design, safer materials and intuitive technology for modern homes. So can EDT build a global appliance brand from India? Joining me now is Naya Sagi, the co-founder and CEO of EDT, a recognized consumer tech builder, now taking on the challenge of building physical products for global markets starting from India. Naya, welcome back to Startup Street. EDT has come out of stealth. What kind of early demand are you seeing for your first product, Luma? Also, you've said EDT was born after conversations with over 350 consumers. What was the one insight that surprised you the most and ultimately defined the brand?
Shruti, it's such a pleasure to be back, and feels like you've tracked every milestone of mine personally and of ours now with EDT. Yes. The early demand for Luma has been fantastic. We have 1,000 plus on our wait list, which is insane. We've actually also not just had the early sort of sense check from 350 consumers, which is where we started. We've also built out a community of more than 5,000 global tech and design tastemakers, and also regular consumers like mothers like me, a double income, no kids homes and households, and also early jobbers. So with that, I think the big insight we've gotten from this very large catchment of folks in the wait list and our community, and one very, very big surprising thing is that people actually don't want more features. They actually are suffering from something we call internally as decision fatigue. Yes. They want their lives simpler. They want products without manuals, and they want just seamless, intelligent human designs in their appliances.
And
that is a
talk to
big
us, Luma.
insight. Luma is actually a very good example of how we built a product that is super seamless, intelligent, and a safer option for you. At the heart of it, it is an air fryer. Something that we saw in modern homes that was extremely popular is an air fryer, because people are now gravitating to more fitness, health, less oil, less fat in their daily, food decisions and choices. At the same time, if you look at an air fryer, it's kind of reimagined the category of a traditional multifunctional appliance. You can bake, roast, grill. In ours, you can also reheat, so no use of a microwave. You can also toast, and of course, you can air fry. But what we have really innovated on, Shruti, is that we've actually said that, frankly, a coating is a coating is a coating. And at high temperatures, coatings disintegrate, right? And they actually create this whole problem of microplastics and toxins in your food, which is not good for you. And therefore, where we have innovated is, number one, of course, the Luma is modular in design. It looks beautiful, but it's also made of glass, which is the safest material known to man into cooking, right?
Absolutely.
And that's how we've done it in a very, I would say, differentiated and nuanced way from the comps out there.
Okay, you're positioning EDT as accessible premium, Naya. How do you deliver great design, safer materials and intuitive tech without pricing yourself out of the mass consumer market? And are Indian consumers truly ready to pay for better for you hardware?
You know, Shruti, what surprised us again was that Indian consumers are not price conscious. They're actually value conscious. And I think that has been said ad nauseum in the D2C and sort of consumer founder networks for the last almost 5-7 years now, right? The market is actually, by the way, also in the category of appliances shifting to a more premium, more a consumer that's more nuanced, wants products that actually work and have longevity and reliability and trust, right? So what we have done is we've said that we don't want to create a luxury brand here. We want to create a brand that is truly priced fair for the design, the materials, and the innovation, the technology innovation we're bringing into market. And therefore, when we're pricing it at the mass premium / masstige range. What we are finding is a great response to the pricing we've come out with, because when you are able to communicate the benefits of your product and you're able to go to market with truly a differentiated product which serves the need of consumers, there is a willingness to pay. And by the way, just as an offside, 25% is the CAGR of growth on the mass premium / premium range of appliances. So it's actually a growing category across the industry, not just, of course, for us.
Okay, Naya, you've launched in India first, but are already eyeing the GCC and the US markets. What gives EDT the confidence that its products can travel globally from day one? And how soon do you plan to go international?
So, Shruti, right now we're more about depth versus breadth. We're really focused on the India geography. But that said, we always launched EDT, and you know this from the very beginning, with a vision that now is the time that Indian brands, Indian products, and Indian founders can go global. And therefore, when we are building out our products right from scratch, in the choice of materials, in the choice of certifications, in the choice of problem statements as well. If you think about modularity in modern homes, modularity in design, smaller footprints, safer materials, intelligent tech, and beautiful aesthetics, the products are poised already to be global products. We will probably take our global foray about 12 to 18 months from now, not earlier than that for sure. We don't want to be distracted. But the point is that our products are built for a global audience from get-go.
Okay, let's get to the funds that you've raised recently. You plan to invest in R&D and build a design-led innovation process. Hardware is capital intensive, but it's also a very crowded and fiercely competitive market dominated by legacy brands. Naya, what would you say is EDT's biggest differentiator?
Shruti, our biggest differentiator is, number one, that we are actually community-led and community-created, right? We're not for everyone. We don't intend to be. If I look at most commodity brands, well, they are for the largest common denominator. That is not our aim. We are looking for a modern, to meet the needs of a modern home, of a modern family, of a modern household, right? That lives in a very specific context, is globally influenced, and is looking for a safer, healthier outcome for their lives. in their daily lives. I mean, we basically say we make every day extraordinary, right? And we're looking for people who lead extraordinary lives to serve.
Absolutely. One final question, if you could answer in quick 20 seconds. Looking ahead to 2026, what does the roadmap look like, Naya? Can you share any target on revenue or product launches? And when can we expect to see more from EDT's home, kitchen and beauty portfolio?
There's a lot coming up, Shruti, but like I said, this year is going to be depth over breadth. We're focused on launching our Luma right. The entire experience is not just about launching the product, but also the after-sales experience and the service, right? And the entire end-to-end sort of consumer journey and the community journey that EDT promises as part of its mission. After that, we're going to be launching 4 to 5 very specific products across our portfolio of home, kitchen, and personal care. And it'll be done in a phased way so that every product gets the time and attention it needs to be a distinctive product that serves the need of the consumers that we are out to serve. So that is our plan. I can't comment on revenue milestones at this stage, but there will obviously be updates soon.
Sure. And we'll keep a track of that, Naya. Many thanks for joining us on Startup Street today and wish you the very best with all the growth plans.
Thank you, Shruti. Thanks for having me.
Moving on from fertility to the future of at-home diagnostics, Ineto started with a simple but powerful idea. If hormones shape so much of our health, why should testing stay locked inside clinics? Today, the company has analyzed over 30 million hormone data points, supported tens of thousands of pregnancies, and is now moving well beyond fertility. Backed by $29 million in a Series B funding round led by Bertelsmann India Investments, Ineto is building a broader hormone and health diagnostics platform powered by AI-engineered antibodies, technology that could redefine how diagnostics are designed and delivered globally. So what's driving this next phase of growth and how big can this platform really become? Joining me now to discuss this further are Ayush Rai, the co-founder and CEO of Ineto, and Swati Murarka, the principal at BII. Thank you so much for joining us on the show today. Ayush, let me start by coming to you, right? What was the core insight that sort of led you to build Ineto, and why did you choose fertility as the first wedge to solve a much larger problem in hormone diagnostics? Take us through what you have on offer.
Thanks, Arundhati. So we started as a technology company from India. So we worked with global corporate giants that did build medtech and realized that most of the big medtech does not build anything for the home. But then most of the conditions we have need regular monitoring. But then the enterprises are really focused on lab equipment. So we believe that Ineto started as a platform to build dozens of diagnostic tests on your phone, with the first one being a fertility hormone test, because fertility is where the consumer is younger, there's very, very high need, the people who need it really want it. And then we saw an opportunity to build a global business sitting out of India.
Sure. And, you've raised this $29 million in Series B, right? Taking your total funding to about $45 million. How will this capital sort of be deployed to scale up over the next 18 to 24 months?
Arundhati, we are already fairly sizable. So, over 30 million hormone tests have been taken, and we are the largest player in fertility testing in the US. And the number of pregnancies reported by Ineto is almost equal to the whole IVF industry in the US put together, right? And we think we are just getting started. So we are going to use this money to, one, is double down on what is already our leadership position and expand globally. The second thing is we are very high precision manufacturing. We operate at the highest end of precision that you can imagine. So we are going to invest in CapEx to build our own manufacturing and scale up our manufacturing. And the third thing is R&D, which is the biggest portion of the fundraise. So we believe that the underlying technology for building tests that were impossible before at home using AI-based antibodies is now unlocked. And we can build tests that were impossible before with this new technology.
So R&D and manufacturing being the key where you'll spend those funds. But, Swati, let me bring you into this conversation, right? Bertelsmann has backed consumer, health tech and education leaders at scale. What sort of stood out to you about Ineto that convinced you this was a category-defining diagnostics company rather than just a fertility brand?
Thanks, Arundhati. Look, let me give you a statement and you judge yourself on that. So, on an average, 5 million women in the US try to conceive every year. 3% of that start their journey with Ineto. And this is a product built from India, such global cutting-edge tech. It's a very powerful statement in itself. So when we backed Anito, we are a lot excited about what the company is building, what Ayush and Varun are off to. The promise of AI has been to bring paradigm shift in how we perceive healthcare, and Anito is building just that. Customized insights at the home of any consumer that is trying to use Anito. That's very powerful, and that's also evident in their growth, right? 30x over 3 years. A product which is backed by FDA and has 20 patents to its name. So it's a really IP-driven product. And here we are building out of India. And also the one important thing to note, Arundhati, would be that healthcare involves trust, it involves long-term thinking, and that's what we at Bertelsmann India bring. So we bring in patient capital and we bring in long-term thinking, which this category and this sector requires, and that's evident in the kind of investments that we do. We truly believe that Anito one day will be at every home in the US, in the Western world, coming to India, and that's what we are backing.
So building in India for the world for a problem that everybody needs at scale at this point. But at-home diagnostics, Swati, is a very crowded and regulated space globally, right? So from an investor lens, what gives Anito that edge?
Anito is very R&D led, Arundhati, as Ayush just mentioned. The R&D gives them a moat over producing superior products, and the demonstration of that has been in user feedback. We went through communities of women and they swear by the product, and the NPS is so high compared to any other product which is getting built out there. So we constantly believe that while starting with fertility, they will move on to bringing more products, more hormones, and more at-home testing. And it is a crowded space, but there are tests which were never even possible, which Anito can enable at home. That's the promise of AI that Anito is bringing, and that is truly cutting edge, very new age, and it's possible only now because that AI compute power is only available to us now, which is the promise, and that is the differentiation that Anito brings to the table.
Absolutely. And Ayush, you're now moving from a fertility monitor to a broader at-home hormone and health diagnostics platform, right? Spanning testosterone, thyroid, vitamins, and a whole lot more. So what does the product pipeline look like, and which new categories could sort of drive the next phase of growth for you?
So we believe that tests like testosterone, menopause tracking, or thyroid, etc., were impossible before at home. Everybody believes that if you had the ability to do all your tests at home, people would do that, right? That's not the problem. The problem is that the underlying tech never existed. We believe that now we have the tech that allows us to build these tests at home, including menopause monitoring, testosterone monitoring at home, and hormones like thyroid. So our immediate pipeline is around these areas, and that opens opportunity is like hundreds of millions of dollars worth of revenue pipeline that this new tech and the new immediate product pipelines opens up for us.
Speaking of those hundreds of millions of dollars that it sort of opens up for you, what about, where's your current demand at? What are your revenues looking like? Where do you hope to close this year, and what's the global expansion plan?
Arundhati, without commenting on revenue, I would just help you appreciate the scale of our operations, right? We have the world's largest data set of fertility hormones, over 30 million data points. We are the largest in the fertility testing category. And like I mentioned, the number of pregnancies in Anito's reports is of the order of the entire IVF industry in the US put together, right? So without commenting on absolute revenue, I'm just trying to give you a flavor of the scale, right? And we are just getting started. So we believe that Anito's opportunity of building an at-home diagnostic platform that can do dozens of tests is bigger than any startup India has ever seen, because we operate in a global environment. So imagine 100 million households paying you $1,000 a year. That's the TAM here.
So that's how big the tap is. Swati, in 20 seconds, the big sectors to watch out for in 2026.
The usuals, healthcare, education, fintech, platform businesses. But I'm keeping an eye on AI applications, anything which is personalizing and customizing at great price points. And of course, the Bharat opportunity that Bertelsmann keeps talking about.
Ayush, Swati, thank you so much for taking time out and being here with us on Startup Street.
Thank you. Thanks, Arundhati.
On that note, it is time for us to head into a short break. But coming up on the other side, Border Plus, a global talent mobility platform, is expanding into Saudi Arabia and the wider GCC less than a year after launch. We put Mayank Kumar, the co-founder and CEO, on the hot seat to know more about the company's growth plans. Stay tuned. Welcome back to Startup Street. On the hot seat today is a startup scaling international nurse mobility at speed. Border Plus, a global talent mobility platform, is expanding into Saudi Arabia and the wider GCC less than a year after launch. With the region projected to need over 50,000 additional nurses by 2027, Border Plus is betting on transparent, skill-first and compliant migration pathways to bridge a critical workforce gap. Already active in Europe, Border Plus is now partnering with hospitals and care providers across the GCC, onboarding its first nurse cohorts from January 2026 and setting up operations in Dubai to support on-ground execution. Joining me now is Mayank Kumar, the co-founder and CEO of Border Plus, and with me, my colleague Arundhati. Mayank, welcome back to Startup Street. Now, Border Plus is expanding into Saudi Arabia and the wider GCC less than a year after launch. With the region projected to need over 50,000 additional nurses by 2027, you're onboarding your first GCC-focused nurse cohorts from January next year and have set up operations in Dubai. Tell us what's driving this demand and how acute is the talent gap on the ground today?
Yeah, first of all, Shruti, Arundhati, thank you for having me here today. No, I think you answered the question yourself, Shruti, because you spoke about the demand shortage. I'm not going to talk about numbers, but the demand gap that we're talking about is more structural in GCC region, and it's not a cyclical demand. And the reasons are very clear. And what's driving it today is that there's a massive infrastructure push that is happening. I think if you track Vision 2030, Saudi alone is adding thousands of hospital beds. Every regular interval, more sort of infrastructure is getting developed. The second thing is demographic is aging, and there is a rise in chronic lifestyle diseases that leads to more sort of nurses and more healthcare staff needed for the region. And I think the third one that is happening is that there's a local workforce constraint. So there aren't simply enough number of locally trained nurses entering the system at scale. And that's where Border Plus comes in. And just an on-ground reality, Shruti, to the question that you asked, that currently hospitals are running with about 15 to 25% shortage in the nurse vacancies. So which is directly leading to more burnout and not being able to grow as rapidly as what they would like to do. So we feel that this isn't a future problem in the GCC, it's a present one, and it needs scalable solutions right now.
So it's a current problem in the GCC, but hi Mayank, you know, you're already active in Europe, right? Especially Germany. What did that market sort of teach you, and how different is the GCC opportunity as you expand across Saudi Arabia, the UAE, Qatar and beyond? How do you sort of ensure consistency in standards while navigating very different regulatory environments?
No, I think it's chalk and cheese, Arundhati, completely different markets altogether. Germany was our sort of starting point and it's a proving ground for us. It taught us one important lesson, which you mentioned. I think that compliance was a critical part, but it taught us that migration fails when you treat migration as a transaction instead of a journey. And therefore, for us, we focused a lot in Germany, specifically when looking at the market with deep compliance work. We focused a lot on language proficiency, cultural integration, onboarding cycles, etc. And these are very long cycles compared to GCC, which are shorter cycles. And therefore, when we get into GCC, we realize there are two big differences. One is that it's a much shorter cycle, so the speed matters here a lot more. Health systems want nurses to be deployed much faster. And the second one is that every country regulation is different. While there's similarity to Germany, but we feel that every market, whether it's Saudi, UAE, Qatar, every market requires a different licensing plan, and we need to sort of follow the standard out there. So we feel that our approach is a lot more global, where we focus on skill training, ethical recruitment, nurse readiness, but we need to localize for compliance. So for us, we feel the balance between quality and local compliance is what will allow us to scale rapidly and responsibly as well.
Sure. Mayank, you know, healthcare migration has long struggled with opaque processes and ethical concerns. You position Border Plus as transparent and skill first. So if you could elaborate on how Border Plus is different from traditional recruitment agents operating in the healthcare migration space.
Yeah, I think it's a fair question, and it's a market that exists for a very long time, and people have seen unethical behavior in this ecosystem. So for us, Shruti, we feel we are different in multiple ways. One is that we don't optimize on volumes and commissions. We optimize on outcomes and trust, and that's our focus area. That how do we bring in a lot more trust and focus a lot more on outcomes. There are three ways in which we differ. We focus a lot on skilling our candidates. So we spend a lot of time at our centers across India, as well as in Philippines and in São Paulo in Brazil, where we train our nurses in-house. And that's one of our focused area of effort from our side. We are not just body shop platform where we connect individual to a job. Our economics are very transparent, so there's no hidden charges, nothing that the employer does not know, nothing that the candidate does not know. And our platform it's a platform business per se, not a brokerage business. So it's not just about placing the nurse, but it's about helping the nurse once they have been placed in terms of documentations, visa requirements, post-arrival support.
Sure.
We're also working on AI tools to help them settle in well in the ecosystem.
So it's sort of all-round support, but if you could quickly tell us how you're sort of working with hospitals and long-term care providers to ensure compliance, speed and quality on both sides of the migration corridor.
Yeah, tough one, Arundhati, but has to be sort of done in the right way. But we feel we don't see them as clients, we see them as partners. So we see them as partners for the growth with these hospitals. On the compliance, we align on licensing, on examinations and documentations. So there are no surprises in the journey. On the speed, we pre-train nurses on actual hospital demand. And I think the last one you mentioned about quality is where we track outcomes, not just about placement, but outcomes on retention, performance feedback, and the nurse satisfaction once they land. So we feel that for hospitals, it means fewer risk and better patient care from day one itself.
All right, one final question. Quickly, if you could answer that. What's in store for 2026 in terms of revenue growth, impact created? And you've started with nurses. What other segments are you looking to expand into next?
Yeah, so can't leave Startup Street without getting the revenue question in. But for us, I think 2026 is going to be a lot about scaling with discipline. We are going to focus on revenue driving growth and just focus largely on Germany as well as the GCC market. We feel the focus will be largely on healthcare and nurses, so we don't want to expand beyond the nursing and healthcare ecosystem, but we may want to look at allied healthcare roles like caregivers, technicians, and maybe looking at other healthcare related professions altogether. Hopefully, Shruti, on this platform, we can say that we should try to touch a 10-figure revenue mark, and let's see at what time it takes, but 2026 should be an age of scaling, an year of scaling for us, and if we do this right, we don't just scale a company, we strengthen the healthcare system globally.
So 10-figure revenue mark is what you're eyeing and you're looking to scale globally in 2026. All right, Mayank, thank you so much for taking time out and being here with us on Startup Street.
Thank you. Thanks, guys.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. Another day, another record low. The Indian currency fell yet again today to cross the psychologically important mark of 91 rupees to the dollar. It has taken the currency only 10 days to fall from 90 to the dollar to 91 rupees to the dollar. In fact, since November 15, the rupee has fallen by nearly 3% from 88.5 to 91 to the dollar. Continued selling of Indian shares by foreign funds and buying dollars to remit them away out of the country is the chief reason. Data shows that lately foreigners are also selling out of Indian bonds. Sentiment on the rupee is also weak as a trade deal with the US remains elusive. What has taken the market by surprise is that the rupee has fallen despite the trade data released yesterday showing that exports in November actually rose by 19% year-on-year and by 11% month-on-month. The rupee is one of the worst performing currencies this year, having fallen nearly 6%, while most EM currencies have risen versus the dollar. To understand where the rupee may find support and whether special steps are needed from Reserve Bank or the government, I have with me a panel of economists and fund managers. I have economists Upasana Bharadwaj, Chief Economist at Kotak, and Sakshi Gupta, the Vice President Senior Economist at HDFC Bank. I also have Hemant Mishra, Founder and Chief Investment Officer at S-Cube Capital, Singapore, and Neeraj Seth, Founder and Chief Investment Officer at 3R Investment Management. So, fund managers and economists, thank you very much, all of you, for joining me. Let me start with you, Neeraj, as a person who would be watching this to make your investments. Doesn't it surprise you that despite good trade data, probably a shrunken trade deficit, the rupee continues to fall? Is it shocking?
I think there's some element of a surprise here, though I would highlight that if you look at the flows, they have not been supportive in the last few months. And on top of it, you also have seen an ongoing delay, in fact, some level of fatigue driven by the constant delays in the tariff situation or the trade deal. And lastly, we have change in terms of the stance of RBI with regards to the currency, which has gone away from keeping some level of not levels but more of volatility under control to more market-driven approach. And I do think it's just a combination of these factors playing out right now.
Mm-hmm. Sakshi, what have you made of the trade impact? The way in which the trade deficit has shrunk in November compared to October, do you expect a surplus, a current account surplus in the fourth quarter? Will that be the time when we may find the rupee finding its feet?
Right, Lata. So absolutely, you're correct. I mean, this data was a big surprise for us, especially the performance on the export side, right? The kind of growth that we have seen. And to me, it's surprising that even to the US, our exports are actually growing in double digits, despite the 50% tariff. So if this trend kind of continues over the next, 3 or 4 months, then we are estimating that in Q4, as it is, there is a seasonal, element which tends to move the balance of payment into surplus, which we have seen over the last couple of years. And I think even on the current account front, we could end up with a marginal, surplus.
Okay. Upasana, what's your sense? Isn't the trade data supposed to have some impact? The current account shrinking. Have you incidentally brought down your current account deficit number forecast for the year?
No, actually, Lata, we were expecting a moderation in the subsequent months on the trade deficit numbers. Obviously, the 42 billion deficit that came about was largely on account of imports from bullion. And we were expecting that moderation to come about. So we were looking at an average trade deficit to moderate towards $27 to $30 billion in the rest of the year. So I think this moderation largely, of course, has come about because silver and gold together have, the imports have reduced. And at the same time, we have seen a month-on-month pickup in exports. And I think, of course, like Sakshi mentioned, we are surprised with the fact that the exports to the US are continuing. But at the same time, we should observe one more trend that is building up. And that is that our imports from the US are also increasing. So the trade surplus, which is $1 billion or so now. So that is the trend that we are observing. But yes, having said that, on a net basis, while we are not seeing an improvement with the trade with the US, but exports have picked up as well. And that is why there's a sharper than our expectations of the November trade deficit narrowing. But I think overall, we do not really expect too much of a change. We are looking at a 1.4% current account deficit for the full year. And as you mentioned before, the balance of payment hopefully will turn surplus in the subsequent quarter, and that should provide some stability in the external sector balance.
Okay. Hemant, I came to you last for a reason. If the very good trade numbers is not having an impact on the currency, and, in fact, as both the economists point out, exports to the US are growing in double digits at 11%. If that is the case, Hemant, would a trade deal also make a difference? After all, it has not affected the exports so much. So even will signing make a difference? It looks like the FPIs are anyway legging it out. And that seems to be the big reason. So basically, okay, we keep blaming the trade deal, but even if it came, will we be relieved?
Actually, Lata, my take is all three will make a difference. So one is the trade number yesterday was a big surprise. I got it wrong. I wasn't expecting it to be moderating to that extent. But I think as the previous panelist just said, the markets are still expecting a current account deficit for this quarter. And if you look at the current account deficit starting from the first quarter of this year, where you had a minor surplus, actually not minor, around 1.3%. And then you became neutral, then you became negative, and for this quarter, we are looking at 1.5% to 2%. So there's been a steady deterioration there. And talking about the trade deal, I think that's the big sentiment negative. I think what it does is it takes a big overhang out of the markets. On the portfolio flows, whoever I speak to, and just last week I was on a roadshow in the Middle East, I think the expectation is Indian markets are now fairly valued. The rupee, I must confess, is now a bit of a concern. But, assuming the fundamentals turn around, and when I talk about the fundamentals, I'm primarily talking about the current account deficit number. If that stabilizes, our BOP then looks a lot more stable. Then I would expect portfolio flows to pick up. So I'm expecting a significantly different scenario in Q2 of, and when I talk Q2, I'm talking calendar year, Q2 of 2026 for both the rupee and the equity markets.
Oh, God, that's quite far away. The rupee has fallen 3% in 3 weeks. If we have to wait 6 months, it looks like, waiting for a very long time. Neeraj, when are you expecting, any realistic stability and recovery in the rupee?
So I think it comes back to a combination of, in the near term, the flows and sentiment. And if you do get, first of all, any positive news on the trade deal, I think that is going to be a sentiment positive. And from a flow standpoint, I'm in the camp that given the levels where the equity markets are, where the INR is, that going into January, we should start seeing at least the first derivative turning, which is you shouldn't see the same level of outflows from the FPIs, and then slowly stabilizing and turning towards an inflow. Assuming you do see, obviously, improvement on the domestic side in terms of the growth in earnings. Okay. But I'm a little more optimistic going into next quarter that we should see a stabilization here.
Okay. Well, maybe now the next question to you is like asking a barber if someone needs a haircut. But do you think it's time that the Indian government actually woos FPIs? The constant complaint we get on the channel is that you are the only country which taxes us, others don't tax our capital gains. Is that a turning point, or will we get FPI flows even without it?
Well, to some extent, the FPI flows historically came despite whatever constraints existed. These constraints.
But at that time, our earnings growth was much better. Our stock market performance was much better.
I would put a slightly bigger point here, Lata. I think this is important. If the government steps back and focuses on the broader capital markets reforms, including simplification and maybe some of this reducing this tax burden on the foreign investors, and this is across debt and equities, I actually think there is a strong case for the FPIs to come back. Now, we're living in a world where there's a competition for capital, and you've seen Japan, Korea, China, a number of other countries performing well and pulling in capital from a global investment flow perspective. So if you want to fight for the capital, you've got to have a stronger playing base for that.
The best word I liked over there, debt and equity, you said. Hemant, on that point, there are now financial experts making the point that India has treated fixed income very badly. Capital gains on fixed income is your income tax level of taxation, 30, 33. For HNIs, it would be 38, 40%, whereas long-term capital gains on equities is only 12.5%. Asset allocation in India is based on taxes, not on risk or age or other relevant characteristics. We have overpriced our equities by the tax skew. So change that is, this is a voice in the wilderness. It's not the majority opinion. But do you think we are overpricing our equities with our tax skew and therefore the FPIs are not coming? They're actually selling out.
I think that's a fair question, but in my view, Lata, that's part of the answer. So yes, the tax aspect generates a skew in favor of equities, and I do think it's also deliberate for it to favor equities and also for money to go back into the banking system rather than into domestic securities, and by that I mean domestic debt securities. But I think the big opportunity for India Inc. Continues to be the offshore market. There is a dearth of dollar bonds in the global markets, and Lata, you and I have discussed this. India is one of the rare Asian countries where there's more appetite than paper that's available, and that's manifested in the very tight credit spreads that Indian companies get when they tap into the global Eurobond markets. So there is an appetite both in rupee terms and in dollar terms, and the country needs to make up its mind to monetize that. But there is a gap there currently.
Okay. Indian companies are seriously delevered now. So the question of even raising domestic paper doesn't arise. Banks like Sakshi and Upasana will tell you are lending to retail. They don't find enough corporate borrowers because corporates are, have enough money. Anyway, the important point is what levels are you looking for in the rupee at this point in time, and what steps do you want from the Reserve Bank? Those questions after the break. Welcome back. We're discussing the fall of the rupee, and we've been speaking with economist Sakshi Gupta of HDFC Bank, Upasana Bharadwaj of Kotak Bank. We're also speaking with two important fund managers, Hemant Mishra of Cube Capital and Neeraj Seth of 3R Investment. Gentlemen and ladies, thank you very much for your patience. Let's just discuss what is expected of the Reserve Bank. Upasana, the Reserve Bank's hands-off approach, has that added to the fall? Would you say that's a good approach probably because the rupee depreciated? We saw the trade deficit declining beyond our wildest expectations in November. So is that a good strategy? The price is working to reduce the deficit.
Lata, one, I genuinely believe that, when natural forces are prevailing, let rupee depreciate. And it obviously in this kind of an environment when there's so much of, uncertainty with regard to tariffs, it does help you cushion the, in terms of competitiveness. So clearly allowing rupee to depreciate is something which should continue. At the moment, I don't think that it is so alarming. Yes, we are seeing decently rapid, depreciation in the currency, but I don't think we are yet in an alarming stage. Why? Because, we have an inflation environment which is fairly benign. So, till that is the situation in the next 6 to 9 months, I think RBI has the cushion to allow rupee to depreciate and manage this fundamentally manage the situation. So that is one. Secondly, obviously, we need to monitor the situation wherein RBI, it's not that they're not intervening, they are intervening in a much more, with less intensity than what they were doing earlier. And this is the right approach at this point. That's how I would consider.
No, fair point. Actually, it's just in popular narrative that the rupee fall is seen as negative. Actually, that's the best defense for Indian corporate sector in terms of, less competition from imports, cheaper way to export. In every which way, a cheaper currency is almost like a rate cut for the corporate sector. But Sakshi, there comes a point where the rapidity of the fall can be, growth diminishing. We are far away from that point, you would say. It's not hurting growth or capex intention. Nothing, you think?
Lata, I don't think, we are at the point where, we are in an episode like 2013 where there is complete panic and, runoff that we are seeing. I think that also the movement in the rupee actually reflects, kind of the tariff differential and the sentiments that are there because, we don't have a, trade deal. So from a macro perspective, I agree with Upasana that, look, it is giving you some amount of, competitive advantage. Secondly, I think from the RBI perspective, we must also remember that this is not just because, you want to build competitiveness, but there is a limit to how much you can intervene because now it has consequences for, domestic liquidity. It has consequences for the pace of transmission, cost of funds, etc. And, all these things are not going to suddenly turn favorable as we move into the beginning of 2026. I think the pressure on liquidity will just rise.
I take your point. At the moment, they have other instruments to give liquidity, which they withdraw every time they sell dollars. So I am a little surprised. Hemant, anything that the Reserve Bank can do better, or do you think the hands-off policy is the right one to follow at the current macro juncture?
So my view, Lata, there is the RBI's policy is not quite hands-off. While they might say that, I think what they mean is they're not trying to defend a particular level of the rupee. They will let the market take the rupee to a fair level, but they will not allow undue volatility. And I think that's been the philosophy all along. And as the recent IMF paper also highlighted, India is now in some ways a crawling arrangement. Now, I think what concerns me is what you rightly mentioned. It's depreciated 3% in a very short period of time. It's almost linear and one way. And, as an FX market participant, that's something that I don't like. I would always want to see two-way interest. And I think that's something that the Reserve Bank of India might want to be cognizant of. But letting the rupee find a level which is aligned with the changed macro, because the fundamentals have changed, the current account deficits look a tad different from what they were, is only the right thing to do.
Okay. Fair enough. At the moment, it is not hurting the macros. though I agree with you that this singular linear fall can kind of destabilize importers. The panic can become a little self-fulfilling, which it seemed like yesterday and earlier this morning. Neeraj, the important point is at what point do FPIs turn buyers? Are they on the anvil? We saw Goldman Sachs, I think even Morgan Stanley, maybe even Jefferies, was it, who are turning positive on Indian shares. Goldman Sachs was underweight up until October, and now they've turned overweight on Indian shares. Are you seeing that inflection point in earnings? Even Q2 earnings, Nifty EPS growth was, like in mid-single digits. Are you seeing the earnings inflection and therefore FPIs come in a month, 2 months?
So first of all, I think from an earnings standpoint, the government has taken a number of actions going back to the GST cut, reforms and other things. So I do expect as we go into the next quarter, you should see a little more acceleration in the earnings side. From an FPI standpoint, in fact, one important point I would highlight, we talked about it in the past, if you do see any more of a wobble around the AI as a theme globally, and if you see the broadening of the markets from a participation standpoint, that will be positive for India because India missed that rally from a sector perspective. So I do think as you go into the next quarter, that broadening is a potential theme that will actually play out, which is good for a number of markets that haven't participated in the whole AI and AI-related thematics in 2025.
Okay. No, that's a fair point. We've all been praying for that AI trade to unwind, hoping that that will make us a little more attractive. I want 2 answers. Please keep them monosyllabic on, where you see the level of the rupee. The questions, and let me start with Sakshi. At what time, I mean, in a month, 2 months, do you see the rupee stabilizing? What is the range for the rupee for the next quarter or so? Time and range.
Right. So I would expect some stabilization in Q4 FY26, I think beginning January. And my range for the rupee would be between 90 to 92.
Upasana?
Yes, I would agree. I think next quarter should see some stabilizing, but mid-January and beyond probably, not immediately. And
level would be?
I would also say that 90 to 90.
Okay, 90 to 92.
92 and a half on the top.
Okay, got it. Hemant?
So most of the weakness is behind us, but until the trade deal gets signed, there'll be pressure. Once it gets signed, I would expect the rupee to drop below 90, 89.91.
Okay, 89.91, that's even better. Neeraj?
So I actually think it takes a little longer from here because the trade deal is first of all nowhere in clear sign of when it gets resolved. So I think rupee still has going into a year and a little bit more pressure, which means the range might be between 91 and 92 or 92.5 in the next 3 months.
Okay. So 92, 92.50 is what we can see. And if Neeraj were right, then we have to wait a little more for the rupee to stabilize. Let's see how things pan out. We have to be prepared. That's it on this special coverage of the rupee. Thank you very much, Sakshi, Upasana, Hemant and Neeraj for joining us.
The 10th Global Economic Summit and the 6th World Trade Expo came together on one platform in Mumbai under the theme Accelerating Global Trade, Fostering Partnerships, Connectivity and Resilience. As the summit progressed, the exhibition and conversations explored opportunities that are shaping the future of global commerce. A candid fireside chat followed, featuring insights from the Executive Director of Muthoot Microfin on India's rapidly evolving microfinance ecosystem, in conversation with the Senior Director of AIAI.
How do you see financial inclusion shifting from access to real ownership in Bharat?
Initially, it was just having an entry into the financial market, right? Now things have changed so much that people want choice, people want to see the access what they are using with the financial product, right? So for example, if you look at our microfinance business, where the customer is focused on how she needs to repay the amount, what the amount she has to save up at the end of the month, and when she has to repay it, right? And also we have added few initiatives like how she can save up going forward to create a alternate source of money for her family. That is on the microfinance side. And if you come to our gold finance or Muthoot FinCorp, where we give working capital. So if you look at it, from earlier time where gold loan was used as an emergency loan, things have shifted from emergency loan to a working capital loan, where customers are using these products to enable themselves to look at creating a working capital loan to enhance their products. And through this, we could also start providing MSME loans or LAP, where they can go to the next level of expanding their business.
Okay, the next question is, how is technology changing the way people understand and manage their money? Obviously, now technology is taking over. Whether we have to pay, we don't have to always have our cards or cash with us. If we have a GPay, Paytm, PayU, I think there's so many other gateways started.
As an organization which is focused on the development of Bharat, we believe all-inclusive growth is the way forward for a country like India. And with technology, we want to bring that inclusiveness in the best way possible. And if you take each of our organizations like the Microfin, which works literally at the bottom half of the pyramid, we kind of educate these customers how to start saving up, basic savings products. We teach them how they need to digitally repay. So most of these customers have just maybe graduated themselves to starting using to how to repay and all that. And obviously India Stack has helped. That is the Google Pay and all those JAM facilities which we see. And more as we go deeper, we are educating them to use digital means more responsibly. And the whole phygital capability which we have built helps these customers to put a face to these, the digital aspect of it. So what we kind of focus on is enhancing our phygital capabilities through our platform, which is Muthoot FinCorp One, where we have a digital avatar plus a physical avatar.
Next, the High Impact Panel discussed the future of global trade through the lens of AI and fintech, highlighting how new technologies are expanding access, improving efficiency, and enabling more inclusive participation in global markets.
Firstly, I think if you think about trade, and when you think about in your context, what you have been able to do, what do you feel is really the trade today, given the trade barriers and the tariffs that we have had situations in around the world? And when you think about really the data protection